Hello everyone and welcome to QuintEdge. Dhruv Rahul this side. I am an ACCA affiliate. Now in this video, you'll get a comprehensive coverage of all the important topics in ACCA FR, Financial Reporting. So what I suggest is, while you are watching the video, you make notes along with me and also practice questions with whichever material you are referring to. So yeah, all the best for your exams. See you in the classes.
Let's say there's a company. In that company, office is in India, and as well. Now, this is the problem a lot of companies or individuals, or let's say in accounting terms, they were facing. Because if the main office is in India, then the statements would be obviously produced in Indian accounting standards, right? Singapore, the bank is in Singapore. They need finance, okay? So they want the statements in their accounting standards. All right. And in UK, they might be following gap. Okay. So in provision to that, when they want to file income taxes, so on and so forth. So there was an issue. So there was lack of consistency, all right, among the different channels. Okay. So say India, it will be uh, a bit different. So because of that, there was a consistency problem. So what the world recognized that the accounting world, the finance world, that we are facing these issues. So what they did was previously they formed in the 1970s Accounting Standards Council. All right. Okay. So what they were planning to do that we will issue standards based around the conceptual framework that will solve reporting problems. Got it? And because of that, and why to solve? Because intended user. Who are the intended users of the financial statement? Could be the investors, creditors, potential investors. Now, if they are reviewing the financial statements, any information in that statement should be relevant and faithful. Got it? So for any inclusion, this was their agenda. But in 2001, what happened? As time changed, they formed International Accounting Standards Board. All right? In the 2001. Now, the goal of this board was to once again issue standards only. But is it that simple? No. It is like they will form standards around the conceptual framework. Now you may ask, what is the conceptual framework? So if in a case it doesn't happen, that if in case there is some standard and or there is some confusion, say what should be doing in terms of accounting if any particular standard is not tackling that. So conceptual framework, as you can see, it's a framework. It gives you that definitions, the basic definitions that you can relate to, and then solve the accounting issue. So you might add, for example, asset. In the conceptual framework, the definition of asset is a present economic resource controlled by the entity that will provide future economic benefits. All right. This was the case. Now see, this is the conceptual framework. Okay. Now IASB. Okay, IASB is overseen by. Sorry for the interruption. Okay, so where was I? Oh, International Accounting Standards Board. Now this is overseen by IFRS Foundation. Okay. So is it going to be that simple to issue any standard? No. So there is a flow. Like IASB will set the agenda. And then there would be interpretation committee. They will take in all the views. Okay. And then finally, after doing all this, IASB will issue the standard. Okay. Now IFRS Foundation aims for the harmony of accounting standards. Okay, so that is why. Now the difference for IFRS are the new ones and IAS are the a bit older one. Okay, so the aim is basically to have consistency among for the users of financial statements. Okay, now IAS and IFRS, they are principle based. Okay, so what is exactly is principle based? So they do not have rigid rules like over 90%, for example. Then would be finance lease. Okay, for example. So what's going to happen if it's a rule based? Whoever is making the entry, the business will stick to 89% because you just have to tick. But Principle base, what does it mean? It acknowledges the economic substance. Okay. As you can see here, if you can see, if 89%, I mean, the benefits of the lessee is getting 89% of the benefits, the asset is substantially transferred. Substantially. Hmm. So in this case, it would be considered as a finance lease. Why so? Because IFRS follows principle-based accounting. Okay, no textbook approach. So that is how around the framework we get IFRS, IS, and that is the entire base for financial reporting. Okay, we are doing ACCA. ACCA has, why is ACCA recognized in 180 plus countries? Because the syllabus is based on IFRS. If you talk about the recent amendments, that is of IFRS 80. Statements of these, that is basically the financial statements. The revised version. Okay. As the latest amendment. Previously it was IS1, presentation of financial statements. Got it? So right now we will begin with IAS 60. Okay. Property, plant, and equipment. All right. Now, if I tell you the term asset, I can see they are majorly divided into, one is property, plant, and equipment. This could be termed as long-term assets. Got it? And then we have inventory. Inventory is dealt under IAS2. And we have financial assets. And that is dealt under IFRS 9. Okay, financial assets and liabilities. So that is how asset, present economic resource controlled by the entity. Now, if we talk about PP, that will deal under IAS 16. Got it? What is IAS 16? Long-term asset, a tangible non-current assets controlled by the entity that gives probable future economic benefits. That sits under the conceptual framework and the IAS definition as well. Okay. So we'll formally begin with IAS 16. What is IAS 16 concerned with? Long-term assets, like plant and equipment, machinery. Okay. Now, what's the whole sole purpose of bifurcating these assets? Now, let's say you bought a machinery. Okay. So machinery, is it going to be your daily expense? Nah, because probably, let's say, depending on the size of the company, the machinery might cost you $5 million. Okay. Now you thought of investing in that machinery because it enhances your production. Okay. So that is going to give you future economic benefit, right? That machinery. Yes. And also, because it is going to give you future economic benefits, you have invested that amount. So that is why we route it through, first of all, route it through balance sheet. And if we want to route it through balance sheet, what does that mean? We are capitalizing it. Got it? And if we are capitalizing based on the consumption pattern, we want to systematically allocate the cost. Okay, that how much the machinery is costing me over the period of time. Okay, let's say I write it off. Write off this 5 million as one of expense. It is definitely gonna distort my profit. Okay, and it doesn't make sense as well because I am going to use the machinery for its useful life. So IS16 has, okay, how you systematically allocate the cost, how you revalue it, okay, and all the other provisions as well. That is what IAS 16 is about. Okay, so we'll just, yeah. Hmm. So if you can see what is happening, what's the core philosophy behind IAS 16? Preventing profit distortion. Like, what's our objective in the conceptual framework as well? To ensure faithful representation and systematic allocation of cost. All right. And what's the core logic behind expenses? A long-term asset immediately would distort profit as discussed, and capitalization creates a mechanism to hold the cost and release it as benefits as come. And in further down the lecture, we are going to discuss about depreciation. All right. So let's say I capitalize that particular asset. Hmm? So I'll be deducting P&L. I'll be depreciating it, depreciating it, depreciating it. Okay. So that is how I'm going to consume that machinery. But what is the machinery giving me? It is giving me revenue generation over the years. That is why I purchased the machinery in the first place. Okay. Most IAS 16 errors arise not from misapplying rules but from misjudging when economic benefits actually arise. Okay, so keep that in mind. Now comes, what is the scope of IAS 16? When you talk about IAS 16, what is considered in IAS 16 and what is not considered? The tangible assets, tangible non-current assets held for production or supply, rental or admin use, or more than one period. Factory, machine, office building, bearer plants. Like, we'll discuss IAS 41, that is biological assets. In that, it is explicitly stated that bearer plants are dealt under IAS 16. Otherwise, the rest of the things comes under biological asset and is dealt under IAS 41. What's out of scope of IAS 16? Held for sale. IFRS 5, asset held for sale, and discontinued operation. So in that case, if you have a machinery, okay, and that qualifies under IFRS 5, then depreciation immediately stops because our intent changes with the machinery, right? So that is basically out of the scope of IAS 16. Asset How am I recovering the asset? Not by using it, but through sales. So depreciation stops immediately. And what is again out of scope? Biological at risk, living animal plants. They are dealt under IS 41 and not IAS 16. Got it? Why is held for sale excluded? Once an asset is for sale, it is no longer consumed through operation. Therefore, depreciation becomes irrelevant. The focus shifts to valuation. Okay, at the lower of carrying amount and fair value less cost to sell. That will be discussed in IFRS 5 moving forward. Okay, the recognition criteria. What is recognition? When either will be constructing the asset or purchasing the machinery. Okay, so when does it classify as IAS 16, and after that we'll be accounting it as per IFRS 16. So these are the costs. I'll be having an invoice. Let's say for machinery, I'll be having an invoice. So I have to check whether probable I have future probable benefits, and can I reliably measure the cost? If these two criteria are satisfied, then I can put that in SOFP under IAS 60. Statement of financial position. I can recognize that as property, plant, and equipment. And then further deal with what are the provisions with IAS 60. Probable future benefits. Is it like more likely to, generate me cash flows? Reliable, do we have an cost per sheet? Okay. And if this criteria is not satisfied, immediately expend it. See, prototype equipment. Let's say there's a prototype equipment used only for testing. Probability of benefit is low, then will expense it. But in scenario B, testing complete, used in active production, then capitalize. Capitalizing is basically meaning in getting it into the balance sheet and then depreciating it. Okay. Now comes judgment area, capital expenditure versus revenue expenditure. Okay. Let's say you bought a car, and you drove it for 5 years. After that 5 years, you replaced it engine. So tell me, is it going to enhance the car's life moving forward? Yes. So that is a criteria. Like further expenditure that you do on that asset, is it going to improve, enhance the asset useful life, increase capacity, improves efficiency? Yes, it's gonna give me better mileage. So that comes under capital expenditure. And what is capital expenditure? I'll be debiting my asset account. Got it? And crediting cash, whatever. Let's say it classifies as a capital expenditure that is enhancing my asset. So I'll be debiting the machinery account, let's say, and crediting cash account or payable account, whatever may be the case. Okay. Like installation cost, major engine upgrade. In terms of jet engines, let's say you're replacing the engine, it is enhancing its life. So that is a capitalization expense. Okay. And revenue expenditure maintains existing benefits. Now, in the same example for the car, let's say it was a routine maintenance. After certain kilometers, you have to, service the car, and it costed around $5,000. Let's say it was an expensive car. So what do you say? Should I expense it or capitalize it? Yeah, does make sense. If let's say, for example, if I totally distort the profit, yeah, makes sense. That's the whole point. Relevant and faithful representation. Now, what are the revenue expenditure? Like daily operations, routine servicing restores to original standard. Example, cleaning consumables, minor repairs. Important thing to note. Materiality. I mean, if you say that I have, expensed a repair cost of $5 million. You have big operations and you think that, oh, $5 million, I need to capitalize it. But no, this is not the case. Materiality does not override the nature of the expenditure. A very expensive repair is still an expense if it only maintains the asset. Until and unless it is not enhancing the asset, you have to expense it. Got it? Now comes component accounting. What does component accounting says? That there are certain complex assets. Let's say airplane. Hmm? So airplane has a body, it has jet engines. Okay. Okay, the body might be having a 20 years useful life. All right. And jet engine 5 years. Okay. So based on that, I will be doing the accounting for the body differently and for the jet engine differently. That is what component accounting is. Let's say for this example, this airplane, the body costs 100 million, useful life is of 25 million. So basically, depreciation would be 100 divided by 25 if I'm using the straight line method. So $4 million per year. Got it? This is for the body part. Now the jet engines. They cost 20 million, but they only last for 5 years. So 20 by 5, that is also 4 million per year. So the total depreciation that I'll be booking for the year would be 8 million. All right. See, what's the problem? If we depreciated the whole $120 million plane over 25 years, that comes out to be 4.8 million years, the expense would be too low. Okay. The engines would be physically consumed in 5 years, but still sit on the books for another 20. The solution, separate recognition, total depreciation 4 for the body and 4 for the engine. That gives me 8 million per year. This ensures the carrying amount reflects physical reality. Got it? Now comes initial measurement. See, either you purchase the asset, so there are going to be two scenarios. Purchase, okay? The base price. You can say the invoice. Or you might also construct the asset. Hmm? Okay. So in both the cases, you're going to incur costs. Okay. For the purchase, you'll be purchasing, let's say, a machinery for 2 million. That's basically your invoice amount. So in both the cases, you are incurring a cost. Now the question arises, what cost needs to be capitalized and what needs to be expensed? And as discussed, what does capitalization mean? Let's say I have $2 million worth of machinery. The direct, for example, direct installation cost. If I did not do that, the machinery would be working for of 500,000, which means I will be recognizing the machinery at $2.5 million. Got it? So any costs that are directly attributable and that were necessary to bring the machinery or property, plant and equipment in present condition needs to be capitalized. Okay. So for example, the staff training cost. Okay. Not necessarily needed. It's not concerning the machinery. Opening ceremonies, launch parties, no, never. Advertising and promo, no. Admin and general overheads, not production overheads. Keep in mind, staff relocation. All these are not concerned with the machinery. They will be expensed off. Got it? And what would be included? Purchase price, less trade discounts, I mean the consideration paid, import duties and non-refundable taxes. These are all necessary. If I haven't paid that, it won't be get passed. Delivery and handling, also necessary to bring the machinery in the present useful condition. Installation and assembly, professional fees like architect and engineers. If they haven't planned it, the machinery won't be there. Present value of dismantling cost coming into that. So, okay, these all cost needs to be. हाँ रिफंडेबल का क्या है यस see keep the logic that just have a question if this was not done if this expense was not borne will the machinery be right now here if I did not pay the architect fee will the building be standing no that was necessary all the necessary cost needs to be capitalized and other all expensed. Okay, directly attributable, any cost necessary to bring the asset to the location and condition necessary for it to be capable of operating, like the direct installation cost. In the manner intended by the management. This is also important. Management intention. Now, let's say the manager wanted the machinery to be working at a particular voltage. So, until unless that voltage is not achieved, you cannot say that the machine is in working condition. That's the management intention. Now, coming to what is decommissioning. Okay. So, let's say there is an oil rig. Definitely, property, plant, and equipment. It would incur a lot of cost to build one self constructed asset. Let's say it costed around $50 million. The complete installation cost. But due to regulatory requirements, I am required to dismantle this machinery after 20 years. Now it's such a huge asset. I mean, it's such a huge building, such a huge structure that it is going to cost me a lot. Definitely. It's in the sea. It's going to cost me a lot. After 20 years, I expect that I have to pay around $10 million after 20 years. Okay. Now, if you might know, there's a principle of time value of money. All right. So 100 rupees today is not equals to rupees 100 after year one. Why so? Because of inflation. You have to account for that part. Hmm? The value of money changes with time. That's basically the principle. So let's say if I have to pay 10 million, that's the probable outflow. Probable, that's provision that covered in the IS 37. We'll go on with that. Probable outflow of $10 million. So that does not have the exact 10 million value today. So let's say the company uses a discount of 10%. Okay. And I have to pay 10 million after 20 years. So if the company uses the discount of 10%, I have to reverse back this 10 million and make it to present condition from at year zero when I'm capitalizing the asset. Okay. So I would be using the discount factor of 10% for 20 years. So that is how I'm going to get the present value. And that will be added to the assets cost. Recognize asset plus present value of PV. Let's say future cleanup. So definitely what's the entry going to be for that present value? Debit property, plant and equipment, and credit provision. Okay. And I'm getting the present value. Now just bear with me the logic. Let's say based on 10%, for example, I am incurring $50,000 of finance cost. Now you would say, what's the finance cost? If eventually I have to pay 10 million, but let's say the present value is dollar, I haven't calculated. Present value, for example, is $6 million. So eventually, on the horizon of 20 years, when I'm standing at year 20, I have to pay 10 million. So whenever I will de-recognize that liability, I'll be debiting that by 10 million. So I have to unwind the cost, right? So I'll be every year unwinding that cost by 10%. If there is a legal or constructive obligation to restore the site, that cost is unavoidable. Therefore, it is part of the cost of the asset liability. That is like dealt under IS 37. Provision. Got it? A provision is recognized immediately, the asset value is increased, and the interest on the provision is expensed over time. That is basically my finance cost, or you can say unwinding of discount. So that by year 20, I can reach to that 10 million figure. Got it? Now comes the special case, self-constructed asset and exchanges. Now, what are self-constructed assets? The building you are building, I mean, the structure that you are building. The principle, same rules as purchased asset. Like, but there are certain prohibitions. Internal profits cannot make a profit selling to yourself. Let's say you incurred a cost of $5 million and you are saying that I usually make a margin, so I'll be capitalizing $6 million. No, you cannot make a profit by selling it to yourself. So that's not allowed in the IS 16. Abnormal waste, wasted material, or labor inefficiency as an expense. Timing, depreciation begins when available for use, not when usage actually starts. This needs to be kept in mind. Asset acquired via exchange, general rule measured at fair value of the asset received. Like cost, fair value of asset given up, plus minus cash transfer. Now I'll give you an example. Let's say the manager, the company purchased new motor vehicle, okay, by giving $80,000 cash and management's old petrol car worth $12,500. Let's say this is the scenario. So I purchased it for 80,000. But I also given up the manager's car, which had a carrying amount, or let's say the fair value of 12,500. So what's the journal entry going to look like? Motor vehicles. How much? 80 plus 12,500. So that is dollar 92,500. Credit cash by 80,000 and credit disposals because I dispose of that asset worth 12,500. Got it? Now there's an exception. If the transaction lacks commercial substance, example swapping a similar assets with no change in cash flow, use the carrying amount of the asset given up. That's it. In this case, the car. Only the car, if the car was given up against that asset, then I would be using 12,500 as the capitalization cost. Got it? Now comes subsequent measurement. Now you did all the things, you calculated all the directly attributable costs, so on and so forth, and then comes subsequent measurement. How do you recognize that? So, based on that, there are two methods, cost and revaluation. Cost method is basically simple. We depreciate, less depreciation. Revaluation, any fair value changes. Let's say there's an upliftment going down the line. After 3 years, the asset value has risen. So that's it will be dealt under revaluation surplus. Okay. See, expenditure on any asset, routine maintenance repair, expense in P&L. As discussed, major part replacement, capitalized cost of new part. Major defect inspection, capitalized cost of inspection, major overhauling. Got it? That I have to capitalize, de-recognize carrying amount of previous inspection. Let's say there's a major inspection of 5 million happening every 5 years. So I'll depreciate that part for 5 years. And then once again, let's say for the other year, it's going to cost me 7 million. So then I will be dealing with that 7 million amount. Okay. Now there are models. Simple, as discussed. The cost model, conservative, simple, widely used. Carrying amount, how do I get to carrying amount? If you are confused, what is carrying amount? Basically, the balance showing in the balance sheet at year end. All right. So carrying amount is basically in case of cost model, cost minus accumulated depreciation minus impairment. Impairment is dealt under IAS 36. All right. So simple. Let's say you apply straight line method. You apply it equally. So if the asset is costing me 10 million at the start of the year and I'm going to use it for the useful life is 10 years. So dollar 1 million depreciation every year. That's basically the cost model. It's pretty simple. And the revaluation model. See, let's say I had a carrying amount of the asset as the asset costed dollar 1 million. Okay. The accumulated depreciation was 0.25 million, which means the carrying amount is $750,000. All right. Now, based on the market trends, the asset is now worth 900,000. Okay. So there's a fair value upliftment of how much? $150,000. Okay. So this $150,000 I'll be treating as revaluation. And should I immediately recognize this as a gain in P&L? No. Why so? Because let's say I made a profit on this machinery. Hmm? Me and my friends were discussing that. Okay, good. My building, it had a fair value upliftment of around $2 million. Now will ask me, okay, then show me in the balance sheet. I mean, show me in the profit and loss account. Can you withdraw it? I'll say no, it has been tied up. So to faithfully represent, we transfer this balance in other comprehensive income. All right. So in other comprehensive income, we have a balance of revaluation surplus. So this 150,000 fair value upliftment will be recorded in OCI, other comprehensive income, as revaluation surplus. Now, either you can directly transfer the revaluation surplus to the statement of changes in equity, or you have an option. Then let's say first you were incurring a depreciation of $10,000, and after revaluation, because your asset base has increased, so definitely you are gonna have increased depreciation 15,000. Now the difference of this 5,000 of increased depreciation, that you can transfer from the revaluation surplus to retained earnings every year if you choose that model. That's up to you. Yes. Which part? See, let's say on the previous revaluation amount, you were incurring a depreciation of $10,000. After revaluation, because definitely your asset base has increased, it has now become $15,000. All right. Now this excess depreciation, it is lowering my profit. So in that case, you have an option to transfer the additional depreciation to retained earnings. Got it? So this $15,000, $5,000, I'll be just debiting it, the revaluation surplus, because I'm reducing that amount by 5,000 and crediting retained earnings by 5,000. Got it? Now comes depreciation. अभी तक हमने till now we have discussed a lot. What exactly is depreciation? We are using straight line method. We are using the reducing balance method. Depreciation is nothing but systematically allocating the expense. I mean, systematically allocating the depreciable amount. How can you tell what is the depreciable amount? Let's say I purchased a machinery for $1 million. After 10 years, I can sell it for $50,000. Okay, so what is going to be the depreciable amount in this case? $950,000. Okay, this $950,000 is my depreciable amount. All right, now there are also ways. Either I can use straight line method, SLM, reducing balance method, and production based. This is not widely used, but we'll be sticking to SLM and reducing balance method. What is SLM? Simple. What is my depreciable amount? 950,000. And the useful life is of 10 years. So systematically allocating it over the useful. Now, what is reducing balance? Let's say I have a policy of depreciating my asset at reducing balance method at 10%. Okay. So 950,000 into 10%, All right, 25,000. This would be my first year depreciation. Now, after deducting 95, so this is going to look like 950,000 minus 10%, whatever is the balance over that minus 10%. So depreciation on the initial phases would be more because you have a larger asset base at the beginning and then eventually it will be depreciated and written off. Got it? Useful life, the period over which hmm, useful life is the period over which the asset is expected to be available for use by the entity. And residual value, the estimated amount that entity would obtain from disposal today if the asset were already at the end of its useful life. It is already at present value. Okay, that's why we do not, discount it back. Depreciation is a systematic allocation of the cost of an asset to the periods in which generates revenue. It reflects the consumption of economic benefits, not the decline in market value. Okay, we are using the asset, we are just systematically depreciating it and booking it at expense. That's why in the cash flow statement, depreciation is a non-cash expense. You're not paying anybody, right? But because of the machinery, you are generating revenue, you are getting the depreciation back. Residual value and useful life must be reviewed at least each financial year and changes are accounted for change in estimate. And if you guys remember, change in estimates are dealt prospectively. Got it? Now comes revaluation and impairment. As discussed, what was revaluation? There was a revaluation surplus. All right. And when does revaluation surplus happen? When there is an upliftment. There is an upliftment in the fair value. Okay. So I'll just give you a simple example. Hmm. Let's say there are two scenarios. Okay. The asset cost is dollar 1 million. All right. I have an accumulated depreciation of 250,000. All right. And when I checked after 2 years, the fair value is 900,000. So what's going to be the journal entry? If I look at from the cost perspective. So first of all, I'll be debiting what? Accumulated depreciation because that needs to be, managed off 250,000. And if I look at from the cost perspective, cost, okay, without considering the uh, depreciation part. So on the cost, $100,000 is less. So I'll be crediting cost by 100,000. All right. And also credit what's the remaining balance? Revaluation surplus. Okay. So how much is it? 150,000. Now, this was the journal entry part. Good for conceptual clarity. Now just simply I can also do this thing, and that should have been done. If I deduct 1 million minus 250,000, that is the accumulated depreciation. How much am I getting as the carrying amount? 750,000. Yes, this is the carrying amount. And what's the fair value now? 900,000. So directly I am getting a gain of 150,000. The revaluation surplus of 150,000. Now, if I'm having a balance, okay, of revaluation surplus. So let's say in future this value drops to 800,000 in the future. So first I have to deduct revaluation surplus. If I'm not having revaluation surplus, then I'm going to expense it into P&L. So how it's going to look like? Debit revaluation surplus. Let's say if the impairment, okay, fall in the value is basically impairment, okay, is of 100,000, and credit property, plant and equipment. Got it? Yes, tell me guys. Now comes, if there's a value increase, gain, credit other comprehensive income accumulates in equity as revaluation surplus. Exception unless it reverses a previous loss recognized in profit and loss account. Let's say regarding that, okay, first there was a loss. In this case, if there was a loss of 100,000 to that machinery. Now, in future, I have recognized this loss and losses are to be recognized in P&L. But in future, there was an upliftment of say 100,000 only. So I won't be crediting OCI in that case. I'll be crediting P&L to reverse that loss. That is what is written. It unless it reverses a previously recognized in profit and loss account. Now, if the value decreases, if there's a loss, debit P&L by default, exception unless there is an existing revaluation surplus, then debit OCI to clear the surplus first. What's the accounting mechanic? When revaluating any accumulated depreciation is eliminated against the gross carrying amount of the asset. The net amount is restated to the revalued amount. See, in this case, the asset would be restated to 900,000. And then future depreciation would be levied on this. Okay, that's why I vanished off this accumulated depreciation by debiting it. That's why the journal entry looks like this. Got it? Now comes impairment duty care. Carrying amount is more than recoverable amount. The asset is said to be impaired. That is read under IS 36 impairment. The loss immediately goes to P&L. Now comes derecognition of asset. Finally, we have did the revaluation. We have reliably measured the cost, initial recognition, subsequent measurement on what cost needs to be expensed and what needs to be capitalized. And then we got two different depreciation method, why depreciation is important, why do we do depreciation exactly, and now derecognition, the end of the final. Simple net disposal. Let's say I had a machinery with a carrying amount of $5 million. I sold it for carrying amount is basically less accumulated depreciation, less impairment. Okay, 5 million, and I sold it for $6.5 million. So the simple entry would be debit bank with 6 point because I'm receiving this much of money. Debit bank account with $6.5 million. Credit property, plant and equipment always at carrying amount with $5 million, and credit the balances P&L with 1.5 million. Got it? Carrying amount is cost minus accumulated gain or loss on disposal recognized in P&L, not revenue. Okay. When to derecognize on disposal, sale, donation, when no future economic benefits are expected from use or disposal. equity note. If the asset had a revaluation surplus, that surplus can now be transferred directly to retained earnings. It does not go through P&L again. Let's say you did not opt it for that route and you have a revaluation surplus related to that asset of, let's say, $20,000. Now, when the asset is disposed, what you're gonna do? You are just simply gonna debit the revaluation surplus and credit retained earnings. That is how you are going to transfer this particular thing. Got it? Simply, we'll just summarize everything that we have discussed till now. When do we recognize probable economic estimate plus reliable measurement, spare parts, inventory, and less major items? Scope, tangible, more than 12 period and held for use. Measurement, purchase price plus direct cost plus dismantling present value. Exclude training, admin, startup cost. Exchange, fair value. Depreciation, systematic allocation over useful life, component accounting, mandatory for parts with different lives. Just discussed in the airplane example. Review life and residual value manually. And de-recognize the end of the cycle. Remove and disposal or end of benefits. Gain loss equals to proceed minus carrying amount recorded in P&L. IAS 16 ensures the balance sheet reflects the economic reality of the assets powering the business. So this was the conceptual part. We'll now look into some questions. Okay. Initial, this is a question for initial recognition, capitalization, and cost allocation. So, can January 1, 20X1, Orion Co purchased a land and constructed a manufacturing facility on it. The following costs were incurred. We'll test our concept ki purchase price of land. Okay. If you can see, it purchased land and constructed a manufacturing cost. We are required to calculate the initial cost of land and manufacture. Okay, so there are two different prices. Legal fees relating to purchase. Okay. Site clearance and demolition of old buildings. Okay. Construction materials 6.5. Direct labor cost 2 million. Okay. Production overheads including abnormal wastage. Now let's just see. Purchase price of land definitely going to be included. This is the base price. Legal fees relating to purchase of land. Purchase of land, not the manufacturing. So these through costs will capitalize the land. Got it? Site clearance and demolition of old buildings. 400,000. Yeah, it is necessary to capitalize. Construction materials. Yeah. Direct labor costs. Yeah, capitalize. Production overheads. Now see, here's the important part. Production overheads are related to production. That means we need to include that. But we should not include the abnormal wastage. That is of 300,000. So we'll be deducting the abnormal waste and capitalize 1.2 million. Got it? General administrative, not capitalized. Staff training cost, not capitalized. Testing cost before the facility was ready to use, capitalized. Proceeds from sale of item produced during cost, not capitalized. This is part of revenue. Interest on specific construction loan. This, okay? IS 23 borrowing cost. Now, if you can see, now let's say there was a brief mention of IAS 23. That is borrowing cost. So the question arises, if I borrow funds Yeah, it's a genuine question. Because if you look, what does IS 16 says? Capitalize those costs which are necessary to bring the asset. Okay. So this does fulfill its condition. So that interest part, how do you capitalize and when do you capitalize? When do you stop capitalizing? That is dealt under borrowing cost. So let's say, so let's take an example. Meet Buildwell Limited. The company is constructing a factory. Okay. If it's constructing a factory, it will take a long time. And obviously, a lot of capital would also be needed. It's not like you can build a factory with $10,000. Okay. And that kind of money is usually financed. And if it's financed, so you have to bear an interest element. Construction will take 18 months. So to finance it, the company borrows money. Now comes the question. Is interest just cost of money or is it part of building a factory? Okay. IS 23 says if the asset takes time to get ready, then interest it is part of the asset's cost. So what could be the asset? The asset that takes significant amount of time. That becomes your qualifying asset. That's been mentioned here. IS 23 only applies to qualifying asset, an asset that necessarily takes substantial period of time to get ready for user say, like factory, power plants, large machinery. Not qualifying, inventory produced quickly, and assets ready for use immediately. When do we start capitalizing? Capitalization only begins when all the three are true. Expenditure on the asset is happening, borrowing costs are being incurred, and activity to prepare the asset are in progress. So, what could be the journal entry? Assume loan is of $10 million. Interest is at 10%. And annual interest would be 1 million. Okay, $1 million. Hmm? So if it's a qualifying asset, so I'll be capitalizing the interest element. What does that mean? I'll be debiting property, plant and equipment account by 1 million and crediting interest payable or if I've paid the interest to directly to bank. Got it? And here is a chart. And when you should, let's say I have taken the loan. Okay. So from the period to asset acquired or expenses incurred for the following. Till that period, I'll not be capitalizing it. Instead, I'll be expensing it. What does expensing mean? Basically, I'll be writing off, routing it through profit and loss account. Okay. Now, from that period, I undertook activities that are necessary for preparation of asset. Now, here comes the turning point. So, from asset acquired to this activity when they incept, till this time also, I am going to expense the interest element. And after that, I undertook the activities that are necessary for asset preparation. I'll start capitalizing. Now, what's the next stop? Construction stopped due to normal reasons. Now, just tell me, there could be bad weather. Okay? Normal routine stoppage. So it does not make sense. Let's say there's a 5 days stoppage, a normal one, which normally happens. So in that case, it does not logically make sense to stop capitalizing. Okay, and IS 23 says the same. So for that particular period, I'll not stop capitalizing. Now, normal stoppage restored. Okay. Then so we are obviously capitalizing. Now, construction stopped due to abnormal reason. What could be the abnormal reasons? Labor strike or some legal issue happened. Now, a legal issue, you can imagine, could go up to for 6 months. Yeah. So basically, in that period, you stop capitalizing. And then during that period, what's going to happen? You'll hit the P&L. Now, after this, construction restarted. So, but obvious, you will capitalize and then asset completed. When is the asset said to be completed? When it's ready to use as intended by the management. And after the asset has been completed, but still you have loan outstanding. So, does that mean after that also I'll be start capitalizing and adding it to the cost of asset? No. When the asset is completed, after that you will hit those interest costs in P&L. as usual. And after that, loan is prepaid. And then there's no interest anymore. We'll look into this properly by proper definitions in this. See? Hmm. So the core problem, a question of timing. See, companies borrow money to build assets. The fundamental accounting question is not if we pay for that money, but when we recognize the cost. That's basically what's happening. Okay. See what is happening here. I incurred the interest cost on the loan. So if I expense it now, profit falls immediately. Asset value will be lower. But although I put that money, put that interest part, put that financing into building that asset. Okay. So if I expense it right now, profit will fall immediately because I've expensed it. And if I capitalize, profit will be higher and asset value increases. So is that faithful representation? Yes, it is faithful representation because you are not doing anything wrong. And IS 23, just imagine all of those IFRS committee, interpretation committee that thought of something. So after that, IS 23 was issued. So that is how IS 23 has the core logic. Okay. And it increases the asset value and then will, depreciate on the increased value. IS 23 exists solely to act as the arbitrator, deciding when deferral capitalization is justified. Okay. The great debate, expense versus capitalize. Prudence. Interest is the cost of using money. Benefit is cash, not the asset. Simplicity and consistency. Okay. This is what the prudence concept is. That let's say you, although you have, uh, you know, bought the loan, you are incurring the interest cost. So prudent concept says that always assume the worst. That's what prudence concept is. So that is why there are different elements when we learn about provisions. So there's different criteria when it comes to recognizing asset. Okay, but we are stricter when it comes to recognizing a liability. That is why, because of the prudence concept. So what does prudence concept say? That okay, if you are having a buyer, always expense. But IS 23 is there to sometimes capital. Asset takes time to build, no revenue during construction, necessary cost to bring to asset to condition. Okay, IS 23 is the compromise. It mandates capitalization, but only under strict conditions. That's why there are conditions when capitalization must be stopped, so that we are not, getting and drifting away from our prudence concept. Let's say the legal issue is for 2 years. So then there's no need. The asset value to would be too higher because of the interest cost capitalized. Got it? Now comes the golden rule. Borrowing costs that are directly attributable, linked to specific projects, take substantial time and not optional. Mandatory capitalization is required. To the acquisition, construction, or production of a qualifying asset must be capitalized. What's a qualifying asset? Takes substantial time. Okay. Now, what is exactly the qualifying asset? An asset that necessarily takes substantial period of time to get ready for its intended use or sale. What are the qualifying asset? Manufacturing plants, power generation facilities. You can come up with many names. And what are not qualifying? Asset ready for use or purchase, inventory produced quickly, routinely, an asset measured at fair value. Got it? The key differentiator is the passage of time required for preparation. Okay, if there's no time, how are you going to capitalize? Okay, in asset ready for use upon purchase. So, what's the meaning of capitalizing it? Because it's ready to use. The whole point of capitalizing it, it takes substantial time. Now comes defining borrowing cost. IST 25 are broader than simple bank interest. It's not like only the bank interest, the interest when the bank loan needs to be capitalized. It covers effective interest under IFRS 9. We have discussed extensively what exactly IFRS 9 is. Lease liability interest under IFRS 16. Amortization, discount premiums, foreign exchange differences, interest adjustment, preference dividend classified as debt. That is also dealt in financial instrument. If it behaves like interest, IS 23 says capture it and capitalize it. The recognition logical flow. Is there a qualifying asset? Are the costs directly attributable? Yes. Capitalize, add to asset base. Interest become part of the asset cost and is depreciated later because benefits would be consumed later. You know IS 16. Why do we depreciate? Because that asset helps us to generate revenue. So we are systematically allocating it through depreciation. So there's matching also. And if it's not a qualifying asset, simple. Based on the prudence concept, expense all borrowing costs. And are the costs not directly attributable, then to expense P&L. That's why there's a stoppage. When there is, a labor strike or the deviation of the interruption is long. Measurement. Specific borrowing. I borrowed the money intentionally for that particular project only. Let's say I borrowed $10 million to construct the building. Okay, so it would be pretty straightforward that whatever interest I pay on that, let's say it's 8%, so 800,000, I'll be capitalizing. Actual interest incurred minus temporary investment. So definitely I won't be needing if I'm constructing a building. Just be logical. I won't be needing that funds outrightly, right? I'll be investing the rest of the funds somewhere else because obviously I've hired accountants for that. I've hired finance guys for that. So I won't be letting my money stay idle. So I'll be investing rest of the portion. Let's say I require $2 million right now. So I'll be investing the rest of the 8 million. So whatever the income is from that $8 million, I'll be investing that. Got it? So the net amount is capitalizable amount. Logic, you cannot capitalize interest you didn't essentially lose. Okay? If you park the loan cash in a savings account before spending it, that income must net off the cost. Okay? That also, accurately I'm capitalizing all the assets. I'm not unnecessarily adding up the cost and making the asset base higher, although I have earned this as an income because of the investment. Now comes general borrowings. Okay, so let's say I have different borrowings. One loan I have at 8% of 10 million principals, 10 million of principal. One loan I have at 6% with 5 million of principal. So these are called general borrowings. I have a pool of finance there. So how am I going to deal with that when I incur interest? And I'm specifically attributing it to an asset also. So I will be using weighted average calculation. Loan A, loan B, and let's say there's an overdraft. Total interest 2600. Let's take a scenario. Total debt I am having 2400. So on that 2400 of total debt, I'm paying a total interest of 2600. So by calculating, I'll get an average rate of 10.8%. Got it? Never capitalize more than actual interest incurred. So let's say I have calculated my weighted average interest rate at 10.8%. And if I use funds of, let's say, out of this total 24,000 debt, if I use 20,000, so this is what I'll be using for capitalizing. And comes timeline, also discussed. Expenditure incurred, cash paid. Capitalization commences only when all the three gears are turning. First is expenditure incurred and cash is paid. Borrowing cost incurred, interest is accruing, and activity starts. See, activities include technical and administrative work, planning permits, not just physical construction. So that is after when I can commence capitalization. Okay. Now comes when do I stop? Okay, when do I pause? Suspend capitalization during extended interruptions like industrial action, strikes, and programmed delays. Okay, why so? Because it could take 6 months, 1 year to resolve that conflict. So in that period, if I do not pause the capitalization, my asset base would become higher, and that is not faithful representation. And when do I continue capitalization? During necessary delays. Okay, like concrete curing, whiskey aging, technical admin work, seasonal weather delay. Let's say there's a rain, it's a bad weather, and because of that, 5 days you stopped. So it does not make even logical sense that I'll calculate, what's the amount for 5 days of interest and then that I'll not include that. No, it does not work like that. You can continue capitalization if It's necessary. It comes under necessary delays. If the delay is necessary part of the process, the clock keeps ticking. And when do we stop capitalization? That is basically cessation of capitalization ceases when the asset is substantially ready for its intended use or sale. Physical completion is the main trigger. Minor finishing work, painting, decoration, landscaping does not keep the window open. So it's not like you have completed the physical construction. After that, some minor tweaking is needed, to finish the off. So during that time, that minor period, do not start again, once again, capitalizing. You have to stop. Okay. When substantially all the work is done and substantially the asset is ready to use. For multi-stage projects, stop capitalization on each part as it is completed. Got it? Let's take an example of Brixham Company. Construction begin, okay, from November, December. Okay, so if the construction has begun, I'll start capitalizing for November and December. Now industrial action happened, so for January, February, March, I'll be stopping the capitalization. What does that mean? I'll be hitting P&L account for the interest component. Got it? Now, after March, from April, May, June, July, construction continues. And in August, the construction was completed and the asset was ready to use. So which means even if I incur interest cost on September and October, that will hit P&L. And when the construction was continued, this will be capitalized. Got it? So let's say total interest incurred was 225 less suspended period. For this period, it is $90. So capitalized total as 135. That goes to the asset. Rest 90 goes to P&L. Got it? So what is going to be the financial impact of this? Finance cost 90 because I've hit the P&L. Lower expense. Now higher profit. Now in the balance sheet, I'll be capitalizing that 135 higher asset value. Future impact, the 135 capitalized amount will flow to P&L over coming years via depreciation. Got it? It's all about classifying. Okay. Qualifying asset must take substantial period, just to keep in mind. Specific borrowings, actual interest minus temporary investment income. General borrowings apply weighted average rate. Suspension only during abnormal delays, during necessary aging or curing. And cessation stops when substantially complete. Minor finish work doesn't count. Got it? So are you guys well versed with this topic once again? Tell me yes or no. Hmm. Rest of you guys? Okay. Hmm. Let's do one question for this. See, Wilson Company obtained a loan of $18 million on January 1st, 20x8 at an interest rate of 5% per annum. Okay, to finance the construction of a new factory which meets the definition of a qualifying asset under IS 23. Okay, so the interest rate is 5% and the loan amount is $18 million. Okay, and the loan was taken on 1st of January. As the full amount of the loan was not immediately required, $6 million out of that 18 million was temporarily reinvested in 2% bond until 31st May 20x8. Okay. So they have invested it for 5 months, right? Construction of the factory commenced on 1st March 20x8 and it was completed on 31st December 20x8. Calculate the amount of borrowings to be capitalized in respect of for the year ended 31st December 20x8. Now, if you can see, the construction commenced on 1st March 20x8, right? And they have taken the loan on 1st of January. So, can I say the 2 months of interest, that is January and February, would hit the P&L? Hmm. And after from March to December, Okay. So that is 10 months. So I'll be capitalizing this. Got it? So how that is going to look? I have $18 million into 10 by 12. And what is the interest rate? 5%. All right. So how much this is going to be? Tell me quickly. 750,000. All right. Now comes the important part. Out of this is what I have incurred. Okay. This is that. Now, what does IS 23 is? All the temporary investment needs to be deducted. So if you can see, uh, 6 million was temporarily invested in 2% bond until 31st May 20 exit. And when did I commence it? So for March, April, and May. Don't you think the interest income for these 3 months needs to be deducted? Tell me yes or no. Yes. So how that is going to look? 6 million was invested, okay, for 3 months, okay, and at 2%. How much this is going to be? Tell me quickly. 30,000? Hmm. So this is 30,000. Okay. So can I say net interest capitalized is 720,000? Got it? Now comes the important part. See, for the month of Jan, Feb, okay, I have incurred interest on 18 million that I'll be expensing it. At the same time, the interest income earned in the month of Jan and Feb would be credited to P&L. Okay, all as per the provisions of borrowing cost. So, are we on the same page with this point? Great. So, we are done with IS 23. Now, we'll go on government grants. Okay, just okay. Okay. So before we begin, we'll, as usual, go with an example. Let's say, so IS 20 deals with government grants. Let's say for any activity, government grants you something. And that something could be like in the form of money, in the form of a cheaper finance. Okay. Any benefit that the government provides. Now, the core logic behind this is, let's say you are reasonably assured that you are going to fulfill that obligation now, but obviously government is not going to be like, okay, take this free money. Okay, they have some obligation that, let's say you employ 50 people per year for 3 years, then the performance obligation is satisfied. And if you are reasonably assured, then only you can reap the benefits of uh, government grant, right? So that is what accounting deals with. That is what IS 20 deals with. That how do you account for those government grants under certain situations? Okay. So let's say there might be a condition where I won't be reasonably assured that I would be able to fulfill the situation. Okay. So in that case, that becomes my liability. So that is why how accounting deals with it. So that is what is covered in IS 20 government grants. So let's say, and these are broadly divided into revenue grants and capital grants. First, we'll talk what exactly is capital grants. So let's say there's a company called Green Limited, and Green Limited wants to buy a machinery, and the machinery costs $10 million. Now, if Green Limited, why now you might ask, why would a government be so charity friendly and give 2 million to Green Limited? Because Green Limited is a sustainable energy. That's a different thing. We'll now focus on how to account for this. There might be certain reason, let's say Green Limited would, increase its production. It's a sustainable company, so government wants to promote that. That might be the reason. So government granted Green Limited with $2 million. Government steps in if only the conditions are met to provide a grant for. Now, how should I record this 2 million? So first is method 1. Okay, netting off, reducing the grant amount from the asset cost. What is the asset cost? The machinery costs $10 million. Government stepped in and provided me $2 million. Okay, so what is going to be the journal entry with this? Debit machinery account by $8 million. Why 8 million? Because I am netting it off. And debit bank account, because the grant is received in cash, I'll be debiting the bank account, and credit bank cash 10 million. Okay, eventually I'm going to pay 10 million. Okay, but out of that 10 million, 2 million is been provided by the government. So that is how my cost of the asset becomes 8 million. Now further, depreciation would be on this 8 million. So let's say this is for the machinery's useful life is of 5 years. So in that case, I'll be having 1.6 million per year of depreciation. Got it? Are we clear with the netting off method? Tell me, guys. Hmm. Now comes the other method, that is deferred income. Now in this case, when the grant is received, I'll be creating a deferred income. That is basically my liability. Okay. So what does that mean? My asset stays at $10 million only. So I'll be charging a high depreciation. Let's see how this works. Now the depreciation on the whole amount is $2 million on the cost. Why 2 million? Because $10 million divided by 5. That gives me $2 million per year. Okay. Now we will release the portion of government grant from the deferred income over the span of 5 years. So how is that going to look like? 2 million I have recorded as deferred income. I'll be dividing over the useful life. That will give me 40,000. And every year for 5 years, I'll be releasing 40,000. Now this 40,000 will be on the credit side of, right? Because I'm reducing my liability, I'm releasing it in my P&L. So if you can see, under method 1, I was charging a depreciation of 1,60,000. All right, but in this case I am also charging depreciation of 200,000. I'm sorry, this was 1.6 million. Okay, and in this case, although I'm charging a depreciation of 2 million, at the same time I'm also recording 400,000 of deferred income. So net effect is, say, I'm charging 1.6 million. I'm deducting 1.6 million from the P&A. Okay. Now comes revenue grants. Now same company, Green Limited, the government says we will give you $3 million if you keep 50 employees for 3 years. So recognize over the period of obligation. Okay, there's 3 years. So when received, how will I record this? I've received 3 million. 3 million would credit to my bank account. So debit bank, and credit once again deferred income. Okay, this method too. Yeah. Okay. Now the same company, Green Limited, the government says we will give you $3 million if you keep 50 employees for 3 years. Okay. So same, I will recognize the obligation over 3 years. So when I'll receive money, I'll debiting my bank account and crediting deferred income. Now, end of year one, I'll be releasing that 1 million. So if I'm releasing that 1 million, so debit deferred income by 1 million, I'm reducing my liability and credit other income that will hit my P&L. Okay. So in deferred income, I'm having deferred income closing balance. Got it? And then the same cycle goes on for the next 2 years. Got it? So are we on the same page with these two methods broadly? Then we'll properly move on to the presentation. Hmm. Okay. So what is the real objective? When is the benefit actually earned? The problem is I got the cash received. The benefit is spread over multi-year. So there are revocable conditions. The government might say you are not fulfilling the performance obligation. The accounting mismatch. Cash flow rarely matches economic performance. So I have cash received in this year. So IS-20 bridge this gap. How come? By, releasing the economic benefits spread over. That's why we create deferred income. So year one, year two. The core question is, when has the entity actually earned the government benefit? When has it earned? When it fulfills the performance obligation, whatever the grant condition is. Government transaction, IS-20 criteria. Okay. Government grants and government in assistance, let's say cheap loan, are included in IS-20, but IS-12 income taxes, tax holidays and benefits, they are excluded. IS-41 agriculture, biological, etc., they are definitely excluded. And equity transaction, government ownership and that is also excluded. We separate the source from the nature of transaction. Okay, the language of control. Government includes local, national, and international agency. It does not matter. Who gives it? Only what they gives is what matters. Government grant, a transfer of resources in return for past or future compliance with condition. Conditions create deferral. No conditions equal to immediate income. Okay, that's what prudence concept also say. First, in the IFRS 15, we first have to deliver on performance obligation, then we can recognize revenue. Okay, it's all around that conceptual framework. If you think it deeply and logically. Government assistance, action by government to provide an economic benefits. Example, free advice guarantees cannot be reliably measured. So no recognition, disclosure only. Okay, we have to reliably measure also. We cannot give it a number. That's why we are not recognizing it in financial statements and we are providing a disclosure. Forgivable loans, loans which the lender undertakes to waive under certain conditions. Treat as liabilities under forgiveness is reasonably assured. Okay. So there are some forgivable loans. So until and unless you do not meet the certain criteria that your loan would be revoked, till that time you recognize it as liability and then you de-recognize the liability. Okay. The recognition criteria. Cash received early, door says that record deferred liability as discussed. Okay. Approval without cash. Okay. You have been approved the grant without cash. Now, what is going to happen? You haven't received the cash. Let's say it is like over the 3 years, you have to, employ 50 people for 3 years. So for first year you have done, and you are reasonably assured that you are going to continue the same for the next 2 years. So then you will immediately recognize because you haven't received the cash. And then what is going to happen? You will credit other income, okay, and build an asset over that, receivable. And when the cash is government gives you the grant, you will debit cash and write off that asset. Both conditions must be met simultaneously to recognize the grant. The golden rule, the matching principle. Income follows cost, not cash. If costs are incurred over 5 years, grant is recognized over 5 years. If costs were incurred in the past, grant is recognized immediately. IS-20 rejects receipt based accounting. The grant is not earned by receiving cash, but by incurring the cost to grant is meant to compensate. That's why under that method, when Green Limited purchased the machinery, under netting of method, That's why you are deducting. Okay, matching principle is still there. You have an option, but the net effect was same. Okay, grant related to asset. The logic of long-term benefit. The asset provides benefits over its useful life, that is its asset carrying amount. The grant supports the asset, so it is recognized over the same useful life. That's why we recognize the grant for 5 years and the asset useful life was 5 years. Conditional check. Even if the grant has a location condition, example, operate in rural zone for 10 years. If the asset only lasts 5 years, the grant is usually matched to asset's life. Asset grants, presentation methods. Once again, the same thing. Method 1, deferred income, and method 2 is deduct from cost. In this, what is going to happen? I am going to record the asset as the cost and I am going to apply depreciation in the same. So depreciation expense would be 4,000, but grant income would be 4,000 because I have created a deferred liability. And deduct from cost, asset directly I'll be inputting at net cost. So 100,000 minus 20,000 of the grant. Simple. Depreciation expense 16,000, grant income release. So if you can see, net P&L impact stays the same. Method 1 shows you true asset scale. Method 2 shows net investment. The net expense is mathematically identical. Got it? Now grants related to income, subsidizing expenses. The scenario, wage subsidy. Expenses incurred 100,000, grant received 20,000. How am I going to account for this? Separation is preferred. Like expense I did for 100,000 and other operating income 20,000. That is better for presentation. That ensures transparency and comparability. And there is the direct method as well that you can, show the net cost. Recognize only when the expense is incurred. If an employee leaves mid-year, the subsidy for them stops immediately. Now comes specific scenarios. Timing mismatches. Past cost compensation, reimbursement for cost already incurred. Example, flood relief, recognize immediately in P&L. No future performance is required. Okay, as discussed, because you have incurred. Now comes grant received before recognition. Cash received 12 million, but condition spans 3 years. Credit deferred income liability. Income must be stored and released over 3 years. That is $4 million. Never credit equity, always deferred income. Got it? Now there are certain other grants as well, like non-monetary grants and forgivable loans. Like let's say the government gives you land. So how are you going to record that? At fair value, record land at fair value, grant at fair value. Or else nominal value. Record lent at rupees 1, granted review only if valuation is unreliable. But this is not going to be the case because obviously government is going to what? Give you land and land has its fair value. For forgivable loan, like let's say government says that if certain conditions are met, then you know your particular loan will be forgiven. So if there's phase 1 of uncertainty, still treat it as liability. But then if you are reasonably assured that you are going to meet that condition, then you can treat it as grant and de-recognize the liability. Got it? Now comes the low interest loans. Government also provides subsidized loans. So in that case, we have to just unbundle the transaction. Let's say cash received is 5 million and loan liability fair value is 4 million. And because it is subsidized, I got a benefit of 1 million. Income relates to match interest expense, IS 20. Interest expense unwinds the discounts, IFRS 9. This would be treated in under IFRS 9 and this would be treated as a grant. Okay, got it? A cheap loan is simply a market rate loan plus a hidden cash grant. We must account for both components separately. Now comes repayment when things go wrong. This is where this come accounting for breached condition. Let's say you do not meet the condition. This is an IS 8 estimate change, which means prospective adjustment. So income grant repayment, reduce deferred income balance, expense any excess immediately to P&L. And asset grant repayment, increase asset carrying amount, restore the cost and recognize cumulative extra depreciation immediately in P&L. The P&L hit represents the catch up. Okay, let's say you've previously recognized the loss. So you have to catch it up by hitting the P&L and recognizing a provision for depreciation that should have been charged if the grant never existed. Got it?
Now, government assistance, that is disclosure. I discussed government assistance cannot be measured reliably, so that's why we cannot put it in financial statements. So, forms of assistance could include free technical advice, loan guarantees, preferential procurement. So, no recognition cannot measure, only disclosure is required. Nature, extent, and duration of assistance. This excludes normal training transaction with the government, like supplying electricity. The mental map is asset grant, deferred income or net cost spread over useful life, income grant, other income or net expense, match related cost, early cash, liability, performance not yet met, low interest loan, split, IFRS for loan and IAS 24 grant, separate financing from benefit, repayment, change in estimate, catch up P&L immediately. Got it? So are we on the same page with government grants? Tell me. Hold on. Everyone understood? In a refreshed way? Hmm? Okay, so we will begin with the revision of IAS 40, that is investment properties. Now, up until now, what was happening? That we had property, plant, and equipment. So, can I say that it was used for production or it was owner occupied? Yeah, so that comes under IAS 16. But what if I purchase that particular property to for capital appreciation or for renting it out? Basically, to earn an income. So that is what IAS 40 investment property deals with. So let's say the core behind. Meet Urban Space Limited. Urban Space owns a building. Now, one simple question. Why do we own this property? Okay, simple. Do we do business, conduct operation in this building, or have I purchased this investment property to earn rentals or for capital appreciation or for both? Okay. So if these three conditions are met, then that is dealt under IS 40. Not investment property as owner occupied buildings or property held for sale in ordinary business. Okay. So that could be IS2 inventories for a builder. Okay. So you might think that flats are investment properties, but think it from the perspective of a real estate builder. Okay. So for him, the flat units would be dealt under IS2 inventories. Why so? Because he sells, the company sells flats in the ordinary course of business. Okay. So whatever transaction they do in flats, that would be held under IS2. Now, owner occupied properties, that is IS 60, property, plant, and equipment. But apart from all this, if it's held for rental or for capital appreciation or for both, then it comes under IS 40, that is investment properties. Okay. Now there is also one concept of mixed use building. Ground floor, company office. If it's occupied by the company, then the particular ground floor comes under IS 16 and upper floors are rented out, that it comes under IS 40 investment properties. So accounting portion would be dealt under IS 16, which means it would be depreciated over useful life, so on and so forth. And IS. How do we account in IS 40? Let's just look into that. IS 40 broadly uses cost model and fair value model. Now it makes sense. Cost model is basically carrying it at carrying amount, okay, at cost less impairment. And fair value is basically reflecting the true market value. Okay, so let's say right now the carrying amount. It was I purchased the investment property, let's say a flat for $10 million. After 2 years, it became 12 million. Now this 2 million impact that would be credited to P&L account. So that is what investment accounting, I mean, the accounting for investment property is done. That any gain or loss, okay, if in case there's a loss, that would be hit directly in P&L. Now, what was happening under IS 16, property, plant, and equipment? Any gain was credited to other comprehensive income, right? Under revaluation surplus. But that is not the case with investment property. It is credited directly in P&L or debited in P&L if there's a loss. Now we'll properly look into some examples and the core concept on how this works. Okay.
Okay. Now, why IAS 40 exists? The productive asset IAS 16. Property used in operations, value is consumed via use. That's why we use depreciation. That's why we have IAS 16. Now that let's say we made an investment. Okay. They have used a picture of shares, but no, shares will be dealt under IFRS 9. Okay. Property held to earn rentals or capital appreciation behaves like shares or bond. Behaves. Okay. I'm not labeling them as shares. Measurement tool, fair value. Investments earn income independently and are held to realize gains. Therefore, depreciation is the wrong tool. Fair value is the truth. Defining the asset identity. Investment property is a property held to earn rentals, capital appreciation, or both, rather than to use or sell in the ordinary course of business. Now, what's the litmus test? Purpose of holding. Land held for long-term price increase, vacant building waiting for tenants, property under construction for rental. That comes under investment property. Not investment property, factory of head office. That comes under IS 16. Why so? Because it is owner occupied. Property built for resale, IS 2. I discussed it. For real estate, that is an inventory. Trading stock, basically that's simply IS 2 only. Even if there is no rent yet, intention combined with evidence determines the classification. It's not like you have to earn the rent, but what's your intent with that property? Okay, one building, three possible standards. IS 40 investment property, the landlord. Identify investor, generates independent returns, logic not consumed in operations. So there's one building, so there are three possible classifications that it could be done based on what the building is used for and what's the intent behind. And if it's owner occupied, the headquarters of the factory, operator role is used to run the business and supports employees. Inventory. Now comes the builder. Identify trader property held for sale in ordinary course. The main objective of the business is to produce flat units and then sell it. So for them it becomes inventory. So logic is gain realized through trading, not holding. So that is dealt under IS2. IS2 will be do under IS2. Now comes the gray areas. Group entity perspective. Remember in business competition we discussed that a parent could lend a property to subsidiary. So in individual financial statements, that particular subsidiary would consider this as owner occupied. All right. And for parent, it would be investment property because they have rented it out. But from good group's perspective, that would be dealt under IS 16 because we account the group as a single economic entity, which means we have to assume that the property is owner occupied because it's basically occupied by the subsidiary. And if we are considering the group as single economic entity, so it logically also makes sense to record it under IAS 16. So let's say there's parent company and subsidiary company in the standalone financial statements because the parent has rented out the property. So yeah, fine, we will be classifying it as investment property. Why? The parent is essentially a landlord earning rent from subsidiary. But in the consolidated financial statements, classification would be owner occupied. Why so? From the group's perspective, the asset is used internally to generate group revenue. Okay, that's why how we'll get group retained earnings, so on and so forth. So it makes sense to classify that as IAS 60. One entity's investment is the group's office. Now comes the life cycle. Recognition and initial cost. Day one, future economic benefits are probable, cost can be reliably measured. So how do you initially estimate the cost? Initially record the cost. Purchase price, legal fees, taxes directly attributable cost, just like property plant and capitalized replacement of major component, example new road, new lift. Okay. I remember Priyanka asked one very genuine now, right? Remember Priyanka? Priyanka is there? Yeah. Is she there?
Yes, sir. Present here.
Yeah, yeah. So I remember she asked that what if there's something that is enhancing? So definitely we are going to capitalize it. Now you remember Priyanka, you asked me that.
Huh.
Uh, it has been a long time. Yeah. And what we should expense immediately? Cleaning, security, minor repairs, property management fees. Lease note. Investment property held by a lease is measured initially as ROU asset under IFRS 16. IFRS 16 we recognize ROU asset. Yeah, and a lease liability. So that's dealt under IFRS 16 leases. Okay. Now comes subsequent measurement. So there are two cost. Okay. One is cost model. That's an exception. And the fair value method reflects economic reality, gains and losses to P&L. The golden rule, consistency is mandatory. Whichever model is chosen, it must be applied to all investment property. No cherry picking. Okay. The fair value model reflecting economic reality. Core logic business because the asset is an investment, market value changes represent real economic performance. Measure at fair value, every reporting date. The building was of 10 million. Now it is of 12 million. Okay. Now the 2 million would hit the P&L. So it is reflecting the fair value changes. Okay. Volatility, all loss go immediately to profit and loss. Let's say, for example, carrying amount was of $10 million. Fair value is right now is 11.5. So the gain of 1.5 is recognized immediately in profit and loss account. Okay. Now, exception when fair value cannot be measured. Okay. It's a very rare exception. IS 40 assumes fair value can always be measured reliably. This presumption is rebutted only if in rare scenario, the market is inactive, the no comparable data actually valuation is unreliable on continuous basis. In that case, revert to cost model. For that specific property only, all other investment properties remain at fair value. Okay. Now, under modern context, IFRS 18 is the revised version. There's operating category and investing category. Rental income is not operating revenue for investment property. It sits in investing because the asset generates cash flow independently. So whatever rent you earn, okay, from the rented out property, that is most obviously going to investing category as rental income. Okay. Now comes changing the asset's identity. Here's the important part. Let's say investment property has now become owner occupied property. So how are you going to deal with that? So first of all, I'll calculate the fair value. Fair value at last before the conversion, I'll have a fair value, right? Let's say it is 11.5 million. Now at 11.5 million, right there and there only, this will become the balance for IAS 16. Now, whatever useful life is remaining, let's say 5 years. So I'll be depreciating this, taking as a cost of asset and depreciating this over 5 years as per IAS 16. Now, that's a different thing whether you choose to use the revaluation model. That's a different thing. Now, owner occupied becomes investment. Now, in this case, owner occupied is dealt under IAS 16. So let's say, for example, how do I calculate carrying amount? Carrying amount is basically cost minus accumulated depreciation minus impairment. Okay. So let's say that figure comes out to be 10 million. So if at that time, 10 million, if there was any revaluation surplus, so I'll first see if there's a revaluation. Let's say after revaluing it, the value became 11 million. So at that point, I have to transfer that to revaluation surplus, and at 11 million, I'll be converting that to investment property. Now, investment into inventory, that's a similar thing, and that is specific to real estate investors. Okay. So let's say a real estate, a builder, okay, a construction company. It was using an entire floor for office owner. Okay. Sorry, not for office, but as investment. But then they want to sell it out in their ordinary course of business. Then it comes from investment to inventory. So let's say the carrying amount at fair value was 11.5 million. That would be converted as the cost of inventory. Okay. And then IS2 applies. So basically after that, I'll be remeasuring either at cost or net realizable value. Okay. So let's say the net realizable value is less. So I have to put the loss also. Now inventory to investment, that's a different thing. Let's say first they wanted to sell, but then they converted into investment properties. Now they'll earn a rent. Okay. So the same thing applies. That is basically IS2 to IS 40. So whatever may be the carrying amount of that inventory, that translate to the IS 40's cost. Okay. See, from investment property to IAS 16 or IAS 2. Revalue to fair value immediately before transfer. Gain and loss hits P&L. Fair value becomes deemed cost. If investment property from cost model to IAS 16 IAS 2, transfer at carrying amount, no remeasurement. Why so? Because I am already depreciating it, okay, as per the cost model. Inventory to investment property, remeasurement to fair value, difference goes to operating P&L. Okay, because I have made the remeasurement as per IS2. IS2 ordinary business. That's why operating P&L. And owner occupied to investment property. Apply 16 up to the date. Treat differences as revaluation. Gain goes to OCI, not P&L. Got it? So let's say case study. Candy Company investment property to owner occupied. Okay, the carrying amount was 5.81 million and the fair value was 6 million. So what I'll be doing is recognize the 0.15 million gain immediately and transfer the asset as 6 million and start depreciating it as per IAS 16. Okay, and case study for sugar company, owner occupied to investment property. The carrying amount was 3.15 million and the fair value was 4.5. Now see, this goes to revaluation surplus. Treat increase as IAS 16 revaluation, gain goes to OCI, not P&L. Transfers from owner occupied protect P&L from unrealized gains. Transfers from municipal property recognize gains immediately. That's the only difference. Just to keep in mind when you encounter any questions that the owner occupied property went on to investment property. So just keep in mind that you have to transfer the revaluation surplus first and then take that fair value as investment. And then over that, if there's a change, that will hit the P&L immediately. Got it? Now comes disposal, see easy part. Derecognize when sold or permanently withdrawn. That's basic calculation disposal proceeds minus carrying amount. So let's say I dispose this for 12 million and previous carrying amount was 11.5 million. So 0.5 million gain. Okay. Gain loss presented in investing category. Portfolio effect under IAS 40, there's no netting of gains and losses in a reserved all movements hit P&L. Okay. So what are the transparency disclosures that are needed? Independent valuer involvement, rental income details, operating expenses, movement reconciliation. Executive summary. IS 40 treats property held for returns like an investment, measured for value, not consumption, with gains and losses reflecting real economic performance. Got it? So are we on the same page when it comes to IS 40? That's a simple IS, I'll say. Just keep in mind about the movements. Got it? We've discussed about IAS 16, tangible, non-current assets, right? They are non-monetary and have physical substance. So before we begin, we have extensively discussed that in live classes as well. What exactly is monetary and non-monetary? If I talk what is monetary, let's say, for example, receivable. Hmm? So you have contractual right to receive cash. Yes or no? Tell me. Hmm. Now, let's say there's a machinery. You purchase the machinery for, let's say, rupees 10 million. Oh, sorry, dollar 10 million. After using it for 2 years, let's say you account for the wear and tear and everything, you have a carrying amount of 8 million. The useful life is 10 years straight line depreciation. So after that, the carrying amount is 8 million. So can you say that I have a contractual right to receive 8 million? Tell me yes or no. Hmm? I can't be sure, right? Okay, I can sell it. I can sell the machinery. I'll receive a consideration in cash or let's say in machinery, so on and so forth. But I cannot say for certain that this machinery is going to give me $8 million. So I do not have a contractual right. That's why non-monetary. So IS 16, tangible, non-monetary, have physical substance. Now, what exactly is intangible asset? Hmm? See, let's say getting back to the basics, to the conceptual framework. What is the definition? An asset is something that came from past event, is controlled by the entity, will give future economic benefit. Okay, so it comes under the broad definition of asset. We have discussed assets are different kinds. We have inventory governed by IS2. All right, we have monetary assets, financial assets governed by IFRS 9. Now, what about non-monetary asset without physical substance? See, even if one of these fails, it's not an asset. So first we have the criteria for asset. So what is an intangible asset? An intangible asset is simply an asset that has no physical form. Have you ever seen a tangible software? No. So that has no physical form. Still gives economic benefit. You can use that software for your corporation. Let's say it's an ERPM, Enterprise Resource Management Software. It's helping you to build revenue. So yeah, future economic benefit can still be controlled and measured reliably. Control. Then you might argue that okay, if I train my staff, hmm, oh, it's creating an asset, future economic benefits. But can you say that you are controlling your employees? No, not at all. Okay. So if these three conditions are met, that's called an intangible asset. It should be non-monetary. Okay. So it's simple real life example, software, patent, like for example, Apple. Apple has a lot of patents in pipeline. Licenses, you have a license. Let's say license to extract a particular exclusive license to do something that is non-monetary. Okay, because you cannot say that if I sell this license, I'm going to get $10 million. That's non-monetary without physical substance. You cannot see a license building. Okay, no physical substance, and yeah, it's identifiable. So that is exactly what an intangible asset is. You can't touch them, but clearly it helps you earn money. Now it comes internally generated goodwill. Now I might argue that I'm spending $2 million on building my brand. Now IAS 38, intangible assets, explicitly forbids that you cannot recognize this. That's basically internally generated goodwill. If you have incurred proper expenses, that you have, incurred advertisement expenses, that in the long run, that you might think is going to have a brand reputation. But IAS 38 says that you cannot capitalize it as intangible asset. What you can do? Expense it as what? Business development expenditure. All right. Got it? Let's say there's a company named InnovateX. It becomes famous, customer trust is, brand value explodes. Accounting temptation. Let's capitalize brand value. We'll have an asset in the balance sheet. IS 30 said that does not allow that at all. No identifiable transaction, no reliable measurement. So, if you remember, we discussed that in consolidation, that we do have goodwill in our balance sheet. Why do we record that? That's not internally generated goodwill. That's the purchased goodwill that we are recording. Got it? Now comes when to capitalize and when to expense. So there are going to be two phases when it comes to if I am developing an intangible asset within my house. So research expenses could be like research for drug. Okay. So there are going to be surveys, so on and so forth, a lot of activities. And then there's a split. After that, if six conditions, we'll talk about that. Pilot conditions. If these six conditions are met, after that date, I'm going to start to capitalize that asset. And before that, it's going to be expensed. Probable future economic benefits, if I'm certain. Intention of management to complete. Resources like finances available. Ability to use. Technical feasibility. feasibility, ability to measure the expenditure reliably attributable to intangible asset. So if these 6 conditions are met, then I can capitalize. Okay. What about recognition? What about what cost should be included? Let's say I purchase an intangible asset. So in that case, similar to IAS 16, I have to include directly attributable cost, direct installation cost, direct expenses, anything that is directly attributable to make that intangible asset work needs to be capitalized. Okay. And what about subsequent measurement? In IAS 16, we had depreciation. In IAS 38, we have amortization. What exactly is amortization? Simply, over the useful life of the asset, we are going to allocate expenses. Okay. And what about goodwill? Goodwill is reviewed for annual result after this. Okay. So we'll just formally proceed with this chapter on what exactly ACCA wants you to know when it comes to intangible assets for IS 38. Hmm. For example, company A buys a patent for rupees 10 crore. Okay. Result, capitalized asset. So asset increased by 10 crore. If simple transaction. Okay. Debit intangible asset and credit cash. Okay. Simple. Now let's say at the same time, as I discussed about business development expenditure, company B spends 10 crore on brand building result expense. Why? If both capitalize this cost, profits increased artificially and the balance sheet becomes fiction. IS 38 exists to shield financial statements from this manipulation. Okay. Now you get it why we do not capitalize the business development expenditures. This is the reason why. Now comes scope and exclusion. What exactly is included in IS 38? Not allowed IS 2. Why? Because IS 2 has its own rules and regulations when it comes to inventory. Inventory work. Assets sold in the ordinary course of business. Okay. So how do we measure inventory? At lower of NRV or cost to sale. For example, films for sale. Those are inventories for the producers, right? Financial assets, IFRS 9. These are monetary assets. Receivables, bonds, rights to money, not operating resources. Not allowed mineral rights, exploration and extraction, industry specific. That's why it's not included. Before testing the asset, we must ensure no other standard governs it. That's very important. Okay. Now comes the control test. Controlled by the entity. Remember the definition? Non-monetary, without physical substance, controlled by the entity. So, for example, human capital or training cost. I cannot consider that as intangible assets. I cannot consider my talent. Let's say I tell my HR departments just capitalize all the salaries for the year of all the employees. Let's say that comes out to be around 2 crore rupees in a year. And I'll show that in the balance sheet. But that's not possible because I cannot control my employees. So control test. No controls, employees can resign. So that's why salaries are expensed. Okay, any training costs, those are expensed. What exactly is control? Power to obtain benefits, ability to restrict others from accessing them. Definitely, my employee is not restricted unless I sign the bond or something else. But yeah, I cannot control him, right? Let's say I sign the bond, but can I control the employee? No, definitely not. Legal rights, patents. control power to restrict others. If I purchase license, I have the legal right, okay, to use that license. So basically, I'm controlling it. Got it? Even if future benefits are expensive, expected, you cannot control the employee. Therefore, training is always an expense. Identifiable non-monetary asset without physical substance. Separating the asset from goodwill. If there's an intangible item, is it separable? Yes. Then it's an identifiable asset, can be sold, rented, licensed. No. Does it arise from legal rights? Yes. Still, it's an identifiable asset. And if all of those conditions are not fulfilled, that comes under goodwill. Got it? Now, for example, business combination is governed in IFRS 3. So if you remember, when we calculate goodwill, what's the formula? Purchase consideration, right? Plus NCI minus net identifiable assets. Okay. Now let's say, for example, I have customer. They have customer list. The subsidiary acquired company. So there are either two ways. I can allocate them as intangible assets if I can reliably measure them. How can I reliably measure them? If I have the customer list who are subscription based, for example, so I can know what are the revenues. Hmm? And apart from that, there's one also customer list that is basically, you can say, for because of the brand loyalty. I cannot simply measure that. So what's going to happen? Why am I paying the premium? First of all, the premium, the goodwill is basically what? The premium for control and something that I'm giving over net identifiable assets. So that forms a part of goodwill. Got it? The OR test, it must be at least one condition. The trap, internally generated goodwill is strictly prohibited. ICCA does not allow that. Let's say you say, my company's goodwill is $5 million. It's not at all possible because you cannot reliably measure what are the terms that you're going to use. Got it? That's why purchase goodwill is always included in statement of financial position. Physicality and substance. Here comes the important part. Let's say there's a laptop that comes under IS 16. That's tangible. And intangible is standalone app or software. And operating system is integral to hardware. That's the thing to notice. The hybrid problem. When an intangible sits inside the tangible assets, which element is more significant? In this case, can you say the laptop is more significant? Yes. So that will be governed under IS 16. Got it? Now comes recognition criteria. What are the conditions to recognize an intangible asset? Probable future benefits, revenue increases or cost savings, and reliable measurement. Cost is known, not guessed. Okay. For example, there's a speculative idea. If I am interpreting, so should I capitalize it? Should I expense it? But I am having a speculative idea. Basically, I'm guessing the cost. So I am going to expense it. But it's a proven tech, then I can reliably measure the cost. Then I have to recognize. Meeting the definition is not enough. Without recognition criteria, the item is ejected to expenses. Expenses, prudence concept, do not overestimate everything. Everything comes down to faithful representation. Got it? Reliable and faithful representation. That's what the conceptual framework wants, and the ISB, International Accounting Standard Board, wants by issuing IFRS. Origin matters. Acquisition versus combination. If I directly acquire, for example, price is proof of value. If I acquire an intangible asset, let's say a software, so I'll be paying the invoice price, the base price. So includes the purchase price, or let's say I have incurred the direct attributable cost. For example, the leader fees. And what do I exclude? Admin, training, advertising. Just like IS 16. Don't, if they are not directly attributable, we exclude them. For example, I purchased the software for 10 lakh. Base price That's what I've been invoiced for. And I trained my employees worth of 2 lakh. So I'm not going to capitalize the entire 12 lakh. I'm going to include that 2 lakh and expenses of. An example business combination, recognize at fair value. Hidden assets appear here, includes customer list, market share. So the residual is goodwill, as discussed in the previous example of IFRS 3 business combination. Now comes internally generated asset. Why so? Like brands, mastheads, publishing title, customer leads. Can you reliably measure them? No. Why so? These items are indistinguishable from the cost of developing the business as a whole. Internal goodwill. IAS 36 explicitly forbids capitalizing them to prevent profit manipulation. And as though I would say that I'm building my brand, I'm incurring a lot of expenses. So what's going to happen? I'm not going to book the required expenses and just going to capitalize it. What's going to look like in actuality, it's not happening. Okay. That's why we have cash flows. We'll discuss why do we have cash flows. But my balance sheet is going to look healthier because I'm having more assets and I'm not booking the expenses. So yeah, that is what profit manipulation is. A lot of frauds happen in the past. We'll have some discussions over that. Okay, now comes the important part, research and development. What is research? Searching for knowledge. Treatment, expense, always. Why expense? Prudence. Hmm? And as discussed, when do we start capitalizing? When the pirate criteria is met? When the commercial viability is established. That at the development cycle begins. So application of knowledge, treatment, capitalize. Maybe if criteria met. The capitalization gauntlet is pirate. Probable future benefits. Okay. Intention to complete and sell. Okay. Resources available, technical financial. Ability to use or sell. Technical feasibility and expenditure measured reliably. Capitalization starts only from the date all six are met, no retroactive. Let's say you argue that okay, the pirate criteria is met. Now I'll enter into the development phase. So I'm gonna retrospectively, whatever the expenses I've booked in the research phase, I'm gonna capitalize them, reverse them. No, that's not gonna happen. Once research expenses are booked, they're gonna stay there. Okay. Similar to IS 16, we have two models, cost model and revaluation model. So cost model has cost minus amortization as discussed and impairment. Impairment is IS 36. It's nothing but fall in the value of assets. And we'll measure the asset either at higher of value in use or fair value less cost to sell. Revaluation model, fair value. Rare exceptions. Why rare exception? Because there's an active market constraint. Revaluation is only allowed if identical assets are traded frequently with observable prices. Remember IFRS 13? Fair value measurements. There are three levels, input level 1, 2, and 3, observable inputs and observable inputs, so on. So like taxi licenses, they are traded. So it's fine to, measure them at fair value. Unique brands cannot use this model. Useful life, finite versus indefinite. Finite useful life, patent is for 10 years. Okay, I'm going to amortize that over 10 years systematically. Indefinite life, example brand. Do not amortize, test for impairment annually. Annual impairment. If there are indicators of impairment, irrespective if there are indicators of impairment, I'm gonna still look for annual impairments and the book the impairment. Indefinite does not mean infinite. Okay, it just means there is no foreseeable limit on how much we can use that asset. Maintenance and transparency, impairment IS 36, mandatory annual testing for goodwill and indefinite life assets. Derecognition, remove upon disposals or when no future benefits remain. Gain on losses goes to P&L. Simple. Whatever the proceed amount is, debit that by bank and credit P&L account. I mean the balance sheet figure. And disclosure, users must see useful lives, amortization methods, research and development expense amount. Transparency is the antidote to judgment. The golden rule, identifiable, controlled, probable benefits, and measurement cost is what an intangible asset is. Only capitalize intangible expenditure when the asset is identifiable, controlled, capable of generating probable future benefits, and its cost can be reliably measured. Otherwise, expense it. Got it? Are we guys on the same page with intangible assets? Great. Now we'll discuss about IFRS 5. Okay. So what was happening till now? We had IS 16. Tangible non-current assets. We were using the asset to generate revenue. So asset was used in the business consumption. Yeah, that's why we depreciated it. But let's say management intends to sell that asset. Okay. So now, how is the value recovered? Through sales, right? So if this is the case, that is where IFRS 5 steps in. That is assets held for sale and discontinued operation. Normally, accounting assumes asset will be used, benefits will be consumed, and depreciations make sense. But IFRS 5 says the moment management decides to sell, the story changes. On sale, once sale becomes a strategy, depreciation logic collapses, recoverability logic changes, and presentation must change. So IFRS exists to change the narrative in the financial statement. IFRS 5 applies when recovery of an asset value will be through sale rather than through continued use. That's the most important criteria. When does IFRS 5 apply? Most important. Just like we had pirate criteria for recognizing the development phase, it's just the same. IFRS 5 applies when all six conditions are miss even when IFRS 5 does not apply. Asset is available for immediate sale without any modification. Buyer can take it as it is. Sale is highly probable. Board approval is obtained. Active buyer search started. Sale expected within 12 months. Asset is actively marketed at a reasonable price. Reasonable price is very important. That shows that management really wants to sell that. Overpricing is no genuine intention. Management committed to the plan, not just discussion, formal decision. Unlikely to be withdrawn, plan must be firm, not tentative. Completion within 12 months. Except rare situation beyond complete control. Now, what's step two? What asset can be classified as held for sale? Simply non-current asset, property, machinery, investment property, intangible asset. Disposal groups. Now comes what are disposal groups? A group of assets plus liability to be sold together. Example, entire factories, retail divisions, and business segments. Those comes under disposal group. Now, how do we measure it? Once classified as held for sale, measure at lower of carrying amount, fair value less, cost to sale. Step 4, depreciation and amortization stop. Example, a machinery has a carrying amount of $50,000. Fair value is 45,000. Cost to sale is 3,000. So fair value less cost to sale would be 42,000. So measured at 42,000. What was my carrying amount? 50,000. So what's the difference? It's basically impairment. Impairment loss of 8,000 and credit machinery account with 8,000. Now let's say, for example, there's a disposal group. Okay, entire unit. It has property, plant, and equipment for $70,000, inventory for $30,000, receivables for $20,000, and liabilities of 40. So net carrying amount would be $80,000 after deducting the liability. And when I got to the market and I recognize what is fair value less cost to sale, it is 65,000. The impairment loss is 15,000. But if you can see, how do I allocate this 15,000? First to goodwill, if there's a goodwill, then to asset on pro rata basis. That will be discussed further in IAS 36 impairment. Got it? Now, what is discontinued operation? A component of an entity that has been disposed of or classified as held for sale. Represents separate major line of business. Okay, for example, a telephonic business. It has a separate major line. It's situated in a separate major geographical area. Why special presentation? Because users want to know what profits will continue and what will disappear. Discontinued operations are shown separately, net of tax at the bottom of statement. Like profit from continuing operations will have the bottom line reporting and profit from discontinued operation. And then the total. What if assets is not sold eventually? Reclassify the asset back, measure at the lower of carrying amount before IFRS 5, adjusted for depreciation, and recoverable amount at the date of decision change. So this was exactly what IFRS 5 is. Okay. Now we'll move on to what exactly ACCA wants to know regarding IS 5 in their language. See, when the problem is when future intent conflicts with past reporting. For example, management decides to sell a major factory today. Historically, it was used for operations, which means historically it was dealt under IS 60. So accounting reality, if we keep depreciating and mixing income with operations, so user would be confused. User cannot predict future performance because it is no longer used for production. Management tries to sell it. So IFRS 5 exists to separate past earnings that will disappear from future earnings capacity. The core shift changing the valuation mindset. Okay. In IS 16, used in business, valued via usage, action, depreciate. Under IFRS 5, the asset is to be sold. So value recovered via sales do not depreciate. Depreciation ceases when it is classified under IFRS 5. Okay. Classification criteria available for immediate sale, must be sold in present condition, no renovations pending, and no backlog completion required. Sale is highly probable, active research, reasonable price, and commitment plan. Management intention alone is not enough. The simplified test point include management commitment. Management is actively committed to plan to sale. Active research, an active program to locate a buyer and has been initiated. Reasonable price, asset is marketed at reasonable to its current fair value. Timing, sale is expected to qualify for recognition within 1 year. Unlikely to change. Significant changes to the plan or withdrawal are unlikely. If these 5 conditions are met, then asset is recognized as held for sale. Abandoned asset. For example, let's say the asset is abandoned. So you might think it should come under IFRS 5. Asset will be closed down rather than sold. Rule not held for sale. Reason, value is recovered through use. The asset has been abandoned. The management does not intend to sell it. Value is recovered through use until the end of its life, not through a sale transaction. Timing. Criteria met after reporting date but before statement issue. That is dealt under. Was the condition existing? No backdating. Treat as non-existing event, disclosure only as per IAS 10. Got it? How do I initially recognize? First of all, apply IAS 16 or 38 to bring book value up to the date immediately before classification. For example, the carrying amount was 100 before classification, but after that, I have to measure at lower of what? Either carrying amount, my carrying amount is 100 and fair value less cost to sell is 85. So I'll be measuring it at 85 moving forward. And depreciation ceases from that. Depreciation or amortization ceases from that point. Okay. So recognize impairment law of 50. Got it? Subsequent accounting. First of all, stop depreciation. Once classified, no further depreciation is charged. Value is recovered via proceeds, not consumption. Reporting date remeasurement, check value again, lower of carrying amount versus new fair value less cost to sell. At each and every reporting date, you have to see. Let's say it has been held for sale, it will be having the carrying amount. At reporting date, you'll check and compare with the carrying amount and fair value less cost to sell. Okay. So whatever the lower amount is, and the difference you'll be booking it as impairment loss. Can impair further if value drops, can reverse impairment if value rises, capped at original carrying amount. Let's say in future, there's a reversal of impairment. But the asset is going to be sold, okay, in 12 months only. But if, let's say, it stretches a bit for 5 months, but rest of the criteria are met, in that case, let's say there's a reversal of impairment. So even if you want to reverse it, you can just cap it up to the original carrying amount only. What was the original carrying amount? Let's say it was 100, then it became 85, but after that it became 110. But you will not record it at 110. You will record it at 100 only. Got it? Because the original carrying amount was 100. Disposal groups selling the package. A group of assets and directly associated liability to be disposed together in a single transaction, like a factory division. See, it has inventory, it has machinery, it has liability, it has payables. So can you say that it's a disposal group? Yes. Say the lower of carrying amount and fair value less cost to sale. Allocating impairment in disposal group. If the group loses value, who takes the hit? So I am having total impairment 1. So first of all, I'll be allocating it to goodwill. Losses wipe off goodwill. First, it is the most uncertain value, and then to non-current asset. Remaining loss calculated on pro rata basis on non-current. It will be more clear when we'll touch upon the topic of impairment. Now comes discontinued operations. Moving from asset accounting to performance reporting. So these are continuing operations. We'll be having a bottom line reporting of profit from continuing operations and discontinued operation. When do we say that this is the discontinued operations? Must be component with separate cash flows. Let's say a telephonic division. They're going to have its own revenue, own cost of sale, and meet one of this separate major line of business, separate geographical area of operations. Subsidiary acquired exclusively for resale. If there is, one of the condition is met, then you can say it is a discontinued operation. Okay. And how are you going to report this? Single line item, cleaning the income statement. Previously, what was happening? We were merging this, but once it is classified as discontinued operation, I am going to have a single line in my profit and loss from discontinued operations. Includes post-tax operating result of the discontinued operation, post-tax gain loss on disposal or remeasurement. Okay. Presentation statement in financial position, that was for profit and loss. So under that, non-current asset held for sale. Why so? Because within 12 months and under reserve, accumulated OCI related to held for sale. Balance sheet comparatives are not restated. The past year stays as it was. Okay, no retrospective change. Asset held for sale and discontinued operation. When it comes to scope, single asset or disposal group, but this is for major line of business or geopolitical area. Measurement, lower of carrying amount or FAT area, same, applied to the group. Depreciation, stops immediately. There's no point in depreciation because this is a separate line of business. I'll be having a, profit as calculated. It's just about presentation. Current assets in balance sheet, single line item in P&L. Got it? IFRS 5 prevents the noise of existing business from distorting the signal of continuing operation. Separation, it strictly separates what will stay from what is going. And protection, the highly probable criteria act as shield against manipulation. So that management is not like book this as held for sale so that we can remove this and that. There are a lot of creative ways of accounting, right? Yeah. Now comes impairment of asset. Yeah. So we've been discussing under IS 16. Under IS 16 as how do we calculate the carrying amount? Cost minus accumulated depreciation minus impairment. All right. Same goes for IS 38. What have we discussed? The carrying amount is calculated through cost minus amortization minus impairment. All right. And then IFRS 5, when we remeasure the asset held for sale, we booked impairment loss. So this particular word was very evident throughout the lectures that we went. Okay. So first imagine this situation. You bought a machine, brand, or a business. At the time of purchase, everything looked great. Projections were optimistic. But business is not static. Markets change, technology changes, demand fails, competitors arrive. Now comes the question. Is the asset still capable of generating the benefits that were expected? What does that mean? IS 36 ensures that assets are not carried in the financial statements at more than their recoverable amount. So don't you think if this does not happen, there would be overestimation and overstatement of assets? Yes or no? Tell me. Don't you think? Okay. So the goal of IS 36 is everything stays at their. What's the goal of financial statement? Faithful, relevant, and faithful representation. Okay. Users don't get manipulative information. Okay. So IS 36 ensures that assets are carried at the lower at their appropriate carrying amount. So I'll be having a carrying amount. Okay. Cost minus depreciation minus impairment. I'll be having a carrying amount. And I have to measure it at the recoverable amount. Should be the higher of IS 36 days if there's an indicator of impairment. Okay. So you compare cost and the normal carrying amount and you compare the recoverable amount. So recoverable amount should be the higher of value in use or fair value less cost of disposal. So what exactly is value in use? The present value of future cash flows generated by asset. So let's say there's a machinery. Okay. It's a bit hard to calculate fair value less cost to sale. So if there's a machinery, I can predict at year 0, 1, 2, 3, 4, 5. I can predict that at year 1, it is going to get me 100,000. In year 2, 90,000, 80,000, 40,000, and 30,000. These are the predicted cash flows. Okay. So if I discount them using an appropriate discount rate as cost of capital, let's say 10%, and bring them to present value. So that is going to be value in use, my value in use. And fair value less cost of sale, market selling price minus selling cost, like legal brokerage or dismantling. So what IS 36 is saying, let's say if carrying amount is more than recoverable amount, so which means it should have been at the recoverable amount. Okay, says it. That is what faithful representation would be. But the carrying amount is higher. There's an overestimation. There's overstatement. So to match that, I'm gonna book an impairment loss. Got it? Assets tested only when indicators exist. Example, PP and finite life intangibles like I said. Indicators include market decline, physical damage, obsolescence, poor performance, and legal restriction. Okay. If any of this indicator exit, then it is expected that the asset is impaired. Now, there are special cases. Intangible with indefinite useful life. We have discussed that in intangible. There are special cases like goodwill, intangible assets with indefinite useful life, intangible not yet available for you. For them, what will be doing? Tested for impairment annually. Okay. Now comes cash generating unit. A simple cash generating unit example. Let's say you have a coffee shop. In the coffee shop, you're going to have a coffee machine, furniture, brand, staff individually. There's no cash flow because you can't say that this coffee machine is sitting there, it's generating cash flow. Now, combine them, the coffee machine, the table, the staff, everything, it becomes your cash generating unit because it's independently able to generate cash. Okay? The coffee shop, not the coffee machine. So, individually, no cash flow, together, cash inflow. So, let's say after calculating everything, after calculating the value in use and all, I found that there's an impairment in my cash generating unit. So the cash generating unit, for example, contains the PP, intangible asset, goodwill. So I am having a total carrying amount of 150,000. And I found the recoverable amount to be 110,000. So impairment loss, I'm going to calculate it as carrying amount minus recoverable amount. 150,000 minus 110,000, that gives me 40,000. Now the important things to note here is, how am I going to allocate this 40,000? I am already having goodwill. Now, IS 36 impairment says that if you have goodwill, first of all, vanish that goodwill. Okay. So I'll be deducting the 30,000 of impairment from the goodwill. How much am I left with? 10,000. Now, this 10,000 would be prorated among the intangible asset and the property, plant, and equipment. Got it? That is 10,000 into 80,000. And what's the total balance of these two? 110,000. 120,000. 80 and 40. Got it? Tell me, guys, are we on the same page? Yeah, so we'll formally discuss that what exactly ACCA wants to you do. It's all covered, but still, let's just have a quick look at yeah, the conflict between history and economics. The book says a history, book value is of 100 crore, assumption, constant benefit generation. The reality, generative capacity is only 60 crore. Basically, they're referring to the recoverable amount. Why? Because technology changes, market decline, and there's obsolescence. The gap without impairment, assets are overstated and investors are misled. So we first determine the scope where IS 36 applies. Property, plant, and equipment, intangible assets, goodwill, subsidiaries, and associates. Inventory, they are not there. Financial assets are dealt under IFRS 9, excluded because these standards already require continuous fair value updates, deferred tax, and held for sale. Got it? The core equation measuring recoverable amount. So how am I going to calculate the recoverable amount? Same. Higher of value in use, fair value less, cost of disposal. What is value in use? Keep and use future cash flows. And strategy sell today, market price minus selling price. Recoverable amount is the higher of two. A business will always choose the part that yields the highest economic value. That's why we choose the higher of two. Okay. The valuation methods, fair value less cost of disposal and value in use. Simple, market based. I'm going to have a market value, price received to sell today, and includes legal fees, stamp duties, dismantling cost. Now, for example, the price is 100,000 if I'm going to sell in the market, dismantling cost is 5,000 and legal is 1.5k. So 93,500 is going to be fair value less cost of disposal. Okay. Now let's talk about what is value in use. Entity specific present value of future cash flows. Inputs forecasted inflows for our final disposal projects excludes financing cost, tax handled by discount rate. Discount rate must be pre-tax. Let's say after applying all this, I found that the value in use is 95,000 at a pre-tax discount rate of 10%. Okay. So which recoverable amount am I going to use? Tell me. Yeah, tell me. Yeah, the 95,000 one. Or let's say my carrying amount was 110,000. My recoverable amount is 95,000. So I'm going to book an impairment of $15,000. What it? The shortcut logic, if either value in use or fair value less is greater than the carrying amount, there is no impairment. It's simple logic. Where what did I say? If carrying amount is more than value in use, then there is impairment. Okay. But if the reverse is true, if carrying amount is less than value in use, so then it's fine. There's no impairment. Okay. Why do we do not say that, okay, we should increase the value? Prudence concept. So why do you want to unnecessarily book profits? Right? There is no need to calculate the second value. Example, carrying amount is 100, fair value less cost of disposal is 120. Stop. Even if in exams you have been given that carrying amount is this, fair value less is cost. No need to calculate impairment because there is no impairment. If the recoverable amount is higher than the carrying amount. Example, carrying amount is 100, fair value less cost to till is 120, same. Stop impairment. Forecast period next 5 years based on management budgets capped at long-term industry growth, no double counting. If cash flows are risk adjusted, the discount risk must not include the same risk. This is for cash flow. Okay, when you are calculating the value in use, you just have to keep in mind. Okay, but you won't be asked in that detail when it comes to financial reporting. The timing of the test, mandatory versus conditional. Mandatory annual testing, regardless of indicators, test every year for goodwill, intangible with indefinite useful life, and intangible not yet ready for use. Reason, high uncertainty and judgment risk. Conditional test is test only if indicators exist, just like the normal assets. All other assets, PPE, finite intangibles. Reason, standard assets are assumed stable unless signals suggest otherwise. Identifying the warning signs. Now comes exact points to be remembered when it comes to indicators of impairment. Technological obsolescence, asset idle disused, asset operating losses, physical damage, market value crash, interest rate rising, crushing the value in use, market cap is less than the net assets, worse purchase performance, and modern context. Don't worry, you won't be asked in that detail. But there is a sustainability and climate risk that is also a indicator of impairment, like emissions regulations rendering engines obsolete. Okay, let's say there are new regulations. Now, company had property, plant, and equipment. Now the government says that you cannot use it. So that's basically an indicator of impairment. So you have to, see how much impairment needs to be booked. It might also happen that you have to dismantle the entire machinery. You have to bear the losses. There's no option. Okay. The CGU, individual assets when combined into one, The smallest identifiable group, assets generated independent cash flow, just like discussed with coffee shop. Coffee shop would be having a coffee machine, furniture, okay, and its own liabilities. So it'd be having a net carrying amount after deducting the liabilities. The smallest identifiable group, and why? Because it generates independent cash flows. Combined together, coffee machine alone cannot generate independent cash flows. Example: a retail store, a production plant, and airport. A single machine often cannot generate independent cash flows. You cannot test the screw, you must test the car. Okay. Allocating shared resources, goodwill, and corporate assets. Let's say in that you had goodwill. And there is head office and corporate assets. There is cash generating unit A, cash generating unit B, and cash generating unit C. So corporate assets and goodwill would be allocated on pro rata basis. Okay, corporate assets, let's say you are having a head office. Head office is at the center, but you have to allocate that. So between the CGUs, you will be allocating the head office or corporate assets and the goodwill. Goodwill never generates cash alone, must be allocated to cash generating usage. IT, headquarters, research, must be allocated reasonably to the CGUs they support. Reason prevents offsetting losses in a bad division with gains in a good one. Say, logic, relevant and faithful representation. Now comes allocating impairment loss. As discussed, let's say I'm having a total let's say for example, there is a CGU, cash generating unit. It has property, plant, and equipment of let's say $2 million. It has goodwill of let's say $500,000. And it has liabilities worth $1.5 million. So what's the net carrying amount? It would be 2.5 million minus 1.5 million, right? So I'm having a net carrying amount of 1 million. And I found that the recoverable amount is how much? It was very low. It is only 400,000. How much is the impairment loss? 600,000, right? I need to record this. But if you can notice, I'm having goodwill worth of 500,000. So first I'll vanish off this 500,000 impairment loss, which means I'm left with 100,000 of impairment loss. How am I going to allocate this among property, plant, and equipment? I'm having only property, plant, and equipment. There's no other intangible asset. So simply I'll be deducting 100,000 from this 2 million. Okay. And let's say you have inventory in the given question and receivables. So as discussed, inventory is dealt under IS2 and receivables under IFRS 9. So do not include that for pro rata allotment. Got it? So impairment loss total allocated to goodwill and then allocated to other assets on pro rata basis. So for write-off goodwill often to zero, allocate remainder pro rata to other assets in the cash generating unit, and no asset can be written down below the highest of fair value less cost to sale, value in use, or zero. Okay? Just keep in mind what's the fair value. Se niche, you cannot go below that. Recognizing the loss in financial statements. If the cost model is used, impairment loss, P&L, accumulated depreciation. Okay. And if the revaluation model is used, similarly, revaluation surplus first, you're going to debit that, and then for impairment loss to P&L access. This is how the asset value is measured under revaluation model. Come back and the ceiling. Let's say there's a reversal of impairment. Okay. After we've checked, there's a reversal of impairment. So let's say the asset we here had here, and then we, book the impairment, the asset value fell. But after that, we recognized that there's a reversal of impairment. Hmm? So we have to book it. Goodwill impairment never, there's an exception, goodwill is never. So, how are you going to treat that? We are never going to book the entire profit. Well, look, what was the net carrying amount when for historical cost less depreciation? What would have been? Ignoring all this. So whatever that number is, let's say there's $1 million and the reversal, okay, wants me to book it at 1.5 million, but I'll stop at $1 million. Okay. The ceiling is historical carrying amount minus net of depreciation. Okay. Why are we doing this? Simple. Prudence concept. Do not unnecessarily book gains. Got it? IS 36 and IFRS time. IS 36 is impairment status asset in use, strategy recover through use or sale. Depreciation continues. Valuation higher of value in use and fair value less cost of disposal. Now is IFRS 5. Status asset retired from use. Strategy is to recover through sale only. Depreciation stop. That's why valuation is at lower of carrying amount less, fair value less, cost to sale. Okay? When asset must be written down immediately when its carrying amount exceeds the amount that can be recovered from using or selling it. Okay? Assess, are there indicators or is it mandatory like goodwill? Measure, recoverable amount is higher of value in use and fair value less cost of disposal. Conclude, if carrying amount is more than recoverable amount, impair. Got it? Wording of the question. Nodi has a property included in its statement of financial position at a carrying amount of 2.75. Did he mention historical cost or anything like that? This is the carrying amount, right? The property had been revalued during the year by 1.75. So 1.65 million is the revaluation surplus? Yes or no? Tell me. After that, he arrived at the carrying amount, right? Yes or no? Hmm. And out of this surplus, he made an annual transfer of 150,000. Yes or no? So how much revaluation surplus is remaining in this OCI? 1.5 million. And what's the question? Recoverable amount is 1 billion, 1 million. And what is the carrying amount? 2.75 million. Right? And what's the recoverable amount? Carrying amount is more. So how much is the impairment? 1.75 million. And what does impairment says? IS 36. If there's a revaluation surplus, first we have to hit the revaluation surplus. And how much we had in the balance? 1.5 million. So B is the right answer. We are just going to manage that revaluation surplus. Got it? PQ has ceased operations. See, what was the carrying amount? 2.75 million, right? And look at the wording. Carrying amount at a carrying amount of 2.75 million. The property had been revalued during the year at 1.65 million. All right. If the property had not been revalued, its carrying amount would have been 1.25 million. Okay, we'll see. Do we have anything to do with this figure or not? Nobody has made transfers of 150,000 excess depreciation. You see, IAS 16 allows an annual transfer if you opt for that, so that retained earnings is increased, and you don't get hit by the excess depreciation. Okay. Following a fire, an impairment review estimates the recoverable amount of the property to be 1 million. All right. So what was the carrying amount? 2.75 million. This includes a revaluation surplus of 1.65 million. See, by 1.65 million. Okay. And my carrying amount is more than my recoverable amount. So I'm having an impairment loss of 1.75 million. Okay. If you look at this carefully, 1.65 million was there in my revaluation surplus. I made an annual transfer of 150,000. All right. So that gets me a balance of 1.5 million. What does IS 36 say? If there's a revaluation surplus balance, impairment loss would be hit by that. I mean, first, debit the revaluation surplus by whatever balance is remaining. And if there is excess impairment, that would be in profit and loss account. So here, the total impairment loss is 1.75 million. I'm already having 1.5 million in my valuation surplus. And what's the question? How much impairment loss should be recognized in OCI? So 1.5 million. Got it? Yes. Once PQ has ceased operations overseas in the current accounting period, resulting in the closure of number of small retail outlets. Okay, which of the following cost would be excluded from loss? Cost that should be excluded from loss on discontinued operations: loss on disposal of the retail outlets, redundancy cost of overseas staff, cost of restructuring head office as a result of closing overseas operation, restructuring the head office, trading losses of the overseas retail outlets up to the date of closure. Hmm? Which cost would be excluded? See, loss on disposal of the retail outlet, it would be included because it is related to the outlet. Redundancy cost, that would also be included. Cost of restructuring the head office as a result of closing. Now, if I'm restructuring the head office, it's going to be used somewhere else. So that won't be included. Okay. Basically excluded. So C is the right answer. Trading losses of the overseas retail, that basically would be included, right? Not excluded. So C is the right answer. On 1st January 20x0, Beach purchased an asset of 500,000. All right. Now the asset had a useful life of 8 years and no residual value. On July 1st, 20x3. So it was purchased on 20x0. The 20x0, and now we are talking about July 1st. Take a look at the timeline, okay? It helps a lot in gaining marks. The asset was classified as held for sale in accordance with IFRS 5. So if it is recognized, it passed the criteria for IFRS 5. How it is going to be recognized? At fair value less cost of disposal. Okay. At that time, fair value less cost of disposal was, as I said, 254,000. So from now on, it would be assessed at 254,000. Okay. What is the total expense to be recognized in profit and loss for the year ended 31st December 20x3? All right. Now, if you look at this very carefully, there are a lot of components involved. First, January, and then 500,000. And in the mid of 20x3, it was classified as held for sale. So don't you think that from Jan to June, I was recording it under IS 16, so I have to record the depreciation, right? And then I will be having some carrying amount, and based on that, I'll be recording an impairment loss if the fair value less cost of disposal is less. Got it? So first of all, what would be my carrying amount at July 20x3? Historical cost is 500,000. right? And the useful life is 8 years. So that gives me a depreciation of 62,500 per year. Okay. So how many years have passed? If you can see, January 20x0 till January 20x1, 20x2, and 20x3. January 20x3. 3 years have passed and 6 months of that. So 3.5 years. So that basically gives me an accumulated depreciation of 21750. Now, if I deduct that from the carrying amount, okay, of 500,000. So what's the carrying amount as per IAS 16? 281,250. And what's the 6 months depreciation? How much is going to be the 6 months depreciation? That is basically 500,000 divided by 8 gives me 62,500 for 1 year. So if I do that, so I'm getting 6 month depreciation as 31,250. All right. This is the 6 months depreciation. And this is the carrying amount. This is accumulated depreciation for 3.5 years. Hmm? Right. So this is how I reached at the carrying amount as per IAS 16. Now, what I'm going to do is compare this with the fair value less cost of disposal. How much is it? 254,000. Hmm? So what's the impairment loss because of the recognition? 281,250 less 254,000. So that's gonna give me 27,250. Okay. So 31,250 plus 27,250 gives me 58,500. So this is the total expense. Got it? C is the right answer. Did you guys get it? It's important to know the transition, know the 6 months of depreciation, and then add all the expenses. Okay. So let's see. Now we'll begin with IS2, that is inventory. Hmm? All right. Um, hmm. So till now, what was happening? We had asset, hmm, IAS 16, property, plant and equipment. Tangible, non-current asset. Okay? Okay. Now, first of all, remember that for any inclusion, what's our main goal? What is IAS and IFRS's main goal? To have faithful and relevant information, right? So what's gonna happen? They have a set definition. Okay, a present economic resource controlled by the entity. Now, diving deep into that, we have IAS 16 that deals with property, plant, and equipment, tangible non-current asset. We also have IAS, sorry, we'll discuss this further, IFRS 9. Hmm? Receivable is also an asset. Okay, we have a contractual right to receive cash or cash and cash equivalent. We'll dive this deeper when we'll talk about IFRS 9. Okay, so that has financial asset, right? And now, if I talk about what we sell in the ordinary course of business, so don't get confused. Let's say I'm selling cars. Cars has a lot of value. So don't confuse materiality with something like, okay, the car has a lot of value. It's usually, denominated in huge numbers. So that means I should be recording that as IAS 16 property, plant and equipment. It is not like that. You are selling that asset. Let's say a car in your ordinary course of business. So that becomes your inventory. Dealt as IAS 2, dealt under IAS 2 inventory. Anything. Let's say you are a real estate developer. So for you, the flats, for someone, that is going to be IAS 16 if it's owner occupied. If he intends it to rent it out or for capital appreciation, it would be dealt under IAS 40 investment property. But for you, what that flat is going to be? Inventory. And what's the whole sole purpose of inventory? IAS 2? Simple. Inventory should be measured at the lower of net realizable value or cost. What does cost have? Directly attributable cost. All right. So what are the directly attributable? They will have a cost. There is going to be work in progress. All this makes up cost. So let's say I'm having $10 per unit cost, but something happened because of the external number or whatever. There was a defect. So I have to incur $2 of extra cost so that I can sell the inventory for $8. So $8 becomes my net realizable value. All right. So I have to state inventory at the lower of cost. How much was the cost? $10. And how much is my net realizable value? $8. What is lower? $8. So I'll be recording in the closing. In the statement of financial position, you always have inventory. Okay. So let's say in the preparation of single entity statement, you get an adjustment regarding the inventory. So you'll make an adjustment accordingly. So let's say if the NRV is lower, so you have to list the inventory at $8 and there's an adjustment required for $2. Got it? And how does this impact? Simple. If you know the formula for a simple formula for cost of goods sold, opening inventory, plus purchases minus closing inventory, right? So let's say if your closing inventory is overstated, what's going to happen with your profits? Because it is reducing my cost of goods sold, my profits are going to be inflated. Yes or no? Yes. So I have to make sure that inventory is recorded at its net realizable value. Okay, that translates to what? Relevant and faithful information. Got it? So this was the wholesale base of what exactly IS2 is. Okay. We have closing inventory. If the closing inventory is more, what's going to happen? What's going to happen? Closing inventory is increased. So cost of sale is going to reduce and profits are gonna increase. Okay. Every business has capital locked in goods. The accounting challenge is determining the split. How much stays on the balance sheet, that is asset, versus how much it's the P&L, that is expense. Without strict standards, profit is easily manipulated. I would say I've incurred this much cost, but that is not the net realizable value. If I go in the market, I cannot sell that inventory for that. So there's no use in measuring that inventory at that higher figure. Okay, that's gonna artificially boost my profit. Inventory is a waiting room for cost. It represents future economic benefits not yet sold. That's why we list it at current asset. Okay, in the statement of financial position, you have seen we have inventory. Okay, the standard determines conservatism, never overestimate assets. That's why lower of cost and NRV. So recognize expected losses immediately, but recognize gains only upon sale. What's the golden rule? Measure at lower of cost or net realizable value. Now we've been discussing about cost. What exactly is cost? Just like IS 16, you have purchase price, there directly attributable cost, okay, direct labor cost. Similarly, for any inventory, I'm gonna have purchase price, import duties, transport, direct labor. I'm gonna input them as direct cost, but I will not include admin cost, selling cost, seller's commission, okay? Abnormal wastage, storage unnecessary, and after including all the directly attributable cost, I'll have capitalized inventory cost. For example, purchase price is rupees 1 lakh, less trade discount is 10,000, and I'm having duty or transport as 5,000. So final inventory cost would be 1 lakh minus 10,000, add 5,000 as 95,000. So this will get into 95,000 as my closing inventory. Okay. And let's say in future, the net realizable value changes to 92,000. So I have to list the inventory at 92,000 and book and loss of 3,000. Okay. Include only cost necessary to bring the item to its present location and condition. All right. Now comes the important part. See, there are going to be normal production level. Okay. So I'm gonna have fixed overheads. What does that mean? Irrespective of how much I produce, the total fixed overheads are gonna stay the same, right? Like rent. Yes or no? So what's gonna happen? Let's say I'm having a total rent of rupees $1 million. And the normal production capacity is 500 units. All right. And let's say there's a wastage. So first of all, I'll be dividing the total cost with normal production capacity. All right. There's 2,000 per unit. That comes out to be 2,000 per unit. And let's say I produce 400 units. All right. So I'll be allocating 800,000 to the cost of production. Got it? And rest 200,000, I'll be expensing it. See, inefficiency cannot be an asset. Production overheads must be allocated based on normal capacity, not actual low production. Okay. Inventory values reflects the cost of making the product, not the cost of failing to run the factory efficiently. That's what here it is. Let's say I would have capitalized the entire $1 million, but 200,000 loss is because of my inefficiency. So if I capitalize that, so that's not the true value that I'm showing. That's not faithful and relevant. Okay. That's not faithful representation. So that is where IS2 stops. you from recording it like that. Okay. Now comes allowable cost formula. First in, first out. You have oldest sold first, so ending inventory would reflect current prices. Make sense? Weighted average. I'm having different products. I'll just weigh it out according to the number of units and then have a per unit average product. LIFO is not allowed. Okay? Under IS2. Last in, first out. Hmm? So let's say any inventory which is last in, and if it's getting sold, okay, immediately last in and first out. So that wouldn't represent the true economic value. Why so? Because the inventory that we purchased earlier has not yet been sold. See, distorts profit and understates balance sheet assets. That's why last in, first out, it is not allowed. What is allowed by IS2? First in, first out, and weighted average. Comes what exactly is net realizable value? The logic. If you can't sell it for what it cost, write it down now. Don't carry hope that it is going to be sold for, let's say the cost of the inventory is rupees 120 and it's going to be sold for 120 only. Okay. So for example, estimated selling price is 125, 120 less completion and selling cost equates to 25. Okay. So that gives me a net realizable value of 95 because this is what I am going to actually receive. Right? So that's why I'll be recording it. And I had incurred a total cost of 100. Okay. So write down required is of rupees 5, recognize loss immediately. And there's an exception also. Raw materials are not written down if the finished products will still be profitable. Makes sense. Now comes when do we classify that as inventory? See, I can say that is extensively discussed under IFRS 15, but I can say my inventory is sold if the control is transferred. So let's say I'm a car manufacturer, and there is a car dealer. So I have an arrangement that I will send, okay, my cars to your dealership, but you have to pay me only when sale occurred, and when the sale is going to occur. Hmm? When the control has been transferred to the new owner, right? Only then the dealer can say na, that I have sold the car. And after that, only if the control has transferred for that car, then only the manufacturer can say that I have sold the inventory. Otherwise, it stays in the closing inventory. Got it? Inventory remains on manufacturer's balance sheet. Why so? Because control has not transferred. The expense cost of sale lives only when the revenue is born. Possession is not equal to control. We'll discuss that in IFRS 15. So this was it. We'll do a question for this. But before that, we'll cover up IS 41, that is agriculture. Yeah. So till now, we've seen property, plant, and equipment, right? We've also seen investment property. We've seen intangible assets without physical substance. And right now, we discussed about inventory. Now, what about the biological asset? The cows, cattles. Hmm? Let's say you are into sugarcane business. Sugar canes, they are made out of carbon. So basically, there's biology. Now, if you look at the fundamental definitions of asset, present economic resource controlled by the entity. So let's say if, can I say cow? If I purchase a cow, So that is controlled by me. Yeah, present economic resource and will, because definitely I've purchased the cow for some reason. I'm gonna have milk production out of it. So will it give me future economic benefit? Yes. So yeah, it falls under the definition. Now the question comes about, okay, we'll recognize this as an asset. But if you might have seen, even in IS 16, there's a concept of reliable measurement. That's how we derive cost. Same goes for IS2 inventory. Same goes for intangible asset. Now, how am I going to say that, okay, I can reliably measure my cow's cost? How can? Because I cannot put values on how much it is eating, right? It won't be practical. Like I cannot say that the cow has grown this much because I'm feeding it this much. Okay, so there's no proper way of reliable measurement. That's where IAS 41 steps in. Okay, what does IAS 41 says? For any biological asset. Okay, let's say it's cow, cattle, sugarcane, you are using it for your agricultural produce or dairy produce. Okay, biological asset. So at initial measurement, you recognize it at fair value less cost to sell. And once again, at remeasurement also, you recognize it as fair value less cost to sell. Now you might say, why fair value? Because obviously, if I'm in the market for a cow, so there is a stipulated amount for the cow in the market. IFRS 13. Remember, fair value measurement. So definitely I'm going to get a fair value and I have to, at any time, at any given point, let's say there's a fair value. IS 41 says measure at fair value less cost of sale. Let's say I have to give the mediator some commission or something like that. I have to deduct that amount. So at initial measurement and the subsequent measurement, I have to record it at fair value less cost of sale. Okay. So there are some exceptions as well, like the bearer plant. Hmm? The main plant in which you are growing the trees. That will be dealt in IS 16. Okay. Now just don't ask me the how you depreciate it. Just depreciate it over the useful life. Okay. It's not like you have machinery only. Bearer plants are also considered under IAS 16. Okay? Property, plant, and equipment. Got it? Biological asset is a living animal or plant. Transformation, growth, procreation. The economic driver. Okay. I cannot measure that. Important thing to note here is when it's sheep. The sheep particularly is considered under IS 41. Now there is going to be a point in harvest and then I'm going to get wool out of it. So if I'm selling that wool after the point in harvest, that is going to come under IAS2, lower of cost and NRV. So that's a distinct difference. Measurement is mark to market, simple. Fair value less cost to sell. Like the rule is measure at fair value less cost to sell, unlike a factory. Gains are recognized before the sale, reflecting the value nature created. Okay, it's not like you have to realize that, but when you are remeasuring it, gain will immediately hit profit and loss. For example, price change is 40% market fluctuation external. Physical change is 60% growth, age, health management. IS 41 encourages splitting the gain so users know if the profit comes from good farming or just expensive commodities. You won't be asked this much in detail, but when it comes to disclosure, hmm, when it comes to disclosure because of the efficiency, just have a split that mark in the market, the commodities are expensive, that because of the luck, the fair value is higher, so on and so forth. Got it? The great exception is bearer plant. as discussed, this particular barrel plant, see, this plant is holding my grapes. Okay, so this will be dealt under IAS 16. Now, grapes. Grapes is biological asset until the point of harvest. Do remember that. After I harvest the grapes, that would become inventory for me, right? Because that's my bread and butter if I'm a farmer. So that I'll be selling. So plants that are used only to produce output. This plant is used to produce the output of grapes are not sold themselves, are treated like machines. Measure at cost less depreciation. Now the comparison between IS2 and IS41. Basis IS2 is historical cost. Measurement lower of cost and NRV. Fair value less cost to sale. Recognition upon sale immediate upon growth or birth. Philosophy prudence don't count chickens. Reality count the chickens. Got it? Prudence concept is that's why we have the concept of NRV, net realizable value. We do not recognize unnecessary gain. But under IS 41, the recognition criteria is fair value less cost of disposal. Okay, if the value is created, just hit the PNL. Got it? Summarizing it, inefficiency is an expense. Never capitalize abnormal waste or idle capacity. All right, watch the floor. If net realizable value drops below cost, write it down immediately. Nature creates value. Recognize biological growth as profit now. Disclose assumptions. Separate physical changes from price changes to build trust. Valuation. Got it? Yeah. So this will. Hmm. So yeah. So from wherever you start, you might have come upon this word provision. Provision for tax. Yeah. Since 12th standard, we had provision for tax. All right. And what about creditors? What about them? I know that I have to pay Mr. A sum of $50,000. Can I say the amount is fixed? Yeah. And after 6 months. Yes, the amount is fixed. The time of repayment is also fixed. Right? So what does this mean? This constitutes a liability. A present obligation arising out of past event. Now, what if the amount and timing is uncertain? That's where IAS 37 steps in. Provision, contingent liabilities, and contingent assets. What exactly is? Now, if you look at the example of provision for tax, I do not know the exact amount. All right. There might be some deductions from the tax department, but I have calculated from RAI and I have created a provision. Why so? Because I have to pay the tax. So it makes sense. So what does IS 37 say? What is IS 37? Provision. And what exactly is provision as per the definition? A liability of uncertain timing and amount. Okay. Liability, present obligation arising due to 5 event. Okay. Uncertain timing. I don't know when I have to pay it, but depends. I have to pay it because let's say there's certainty that I have to pay for a court case. Okay. Now I know that although I have to pay, but I'm not sure when do I have to pay. Okay. So that becomes uncertain timing and amount. Let's say for provision of tax, I don't know how much exactly would be debited. Okay. How much exactly the tax would be charged. So that basically constitutes for a provision. Okay. That is where IS 37 steps in. Now, previously, what was happening is a lot of scandals happen. That's called creative accounting. But before this was introduced, the lack of strict rule allow company to manipulate financial statements through big bath accounting and profit smoothing. What management used to do, management created large unnecessary provisions in good years to artificially reduce profit. Okay. In bad years, these provisions were reversed to artificially boost profit. So first what they did, artificially provision created. How do I recognize provision? Debit P&L and credit provision. Okay. So what's going to happen? It's not going to be a small amount. It's not a utility expense. Okay. So it's definitely going to hit my profit and loss account. Okay. And then after that, to smooth it out, when let's say performance was necessary, in actuality, the company was not performing, they were reversing the provision. So if I want to reverse the provision, what's going to happen? I'll debit provision and credit P&L. Okay, profits increased, right? So investors saw a smooth earnings line that masked volatile economic reality. But was this the economic reality? No. Does the intended user, let's say a potential investor, is he getting proper information out of this? No. That's why this accounting was necessary. When does uncertainty become a liability? A liability is present obligation, past event plus expected outflow. For example, a creditor, a bank loan. For example, trade payable, or let's say I have a accrual. So uncertain or amount of timing. If I do not know what exactly when I do, how much do I have to pay and when do I have to pay, that comes under provision. Mark my words, provision is also a liability. Okay, but the situation make it a provision and not an exact liability. Okay, uncertainty is in the how much or when, never in if the obligation exists. I have obligation, that's why provision is a liability. I have a present obligation because of past event. Got it? Now comes the recognition. When do I have to recognize? To recognize a provision, you must pass all the three gates. If any answer is no, no provision is recorded. Okay, so that no manipulation happens. Does an obligation exist today from a past event? If the answer is no, no provision. Let's say, okay, obligation exists. Is there a probable outflow? In the future, is there probable outflow? What is probable? More likely than not, more than 50%. If the payment more likely than more than 50%. Okay, then two, can a reliable estimate be made? Can it be measured reliably? If all the three conditions are met, then you can recognize a provision. Got it? IS 37 assumes a reliable estimate is almost always possible. Inability to estimate is extremely rare. Yeah, even that does make sense. If you remember in IS 16, we had a provision for dismantling cost and then we unwinded it through finance cost. The obligation. The obligation could be legal or constructive. For example, contract, legislation, operation of law. Example, a warranty clause in a sales contract. That is your legal obligation. And there is constructive obligation. arises from past practices, published policies, or specific current statement. Let's say, although out it's not in my contract, but let's say a customer, I sell a pant. I'm having a clothing store, and in my past practice, I've allowed my customers to return the product, although not written in the contract. When I'm selling in the billing, I have not mentioned it that you cannot return. But in my past practice, I always allow the customers to return. So is that becomes my constructive obligation. So I have to account for that how much is the possibility. There are different estimates on how you will record the provision. How much is the possibility when it comes to recording that provision? Why so? Because of past practice. Published policies or specific current statement. The entity has created a valid expectation. The customer also expects from me, right? That I'm going to fulfill that obligation. Expectation in other parties that it will discharge the responsibility. Example, an oil company voluntarily cleaning up spills to maintain reputation. Okay, so that is their constructive obligation, although not legally mentioned anywhere, despite no legal requirement. Exclusion, future intentions, like we plan to go green. Do not create obligations because the company can change its mind. And if you can see, there is also no past event occur. Got it? Now, the condition 2, the probable threshold, defining probabilities in population. Like, if it's possible, less than 50%, it's possible. And there is less than 5%, it's called remote. Remote, we do not disclose it. If it is less than 50%, it's possible, it's contingent liability. Okay. So if it's a contingent liability, we have to disclose it as a note. And if it's more than 50%, that is probable. So I have to recognize a provision. For example, probability of specific unit failure is 2%. That is remote. So no provision for this specific unit. But if I look at from a larger perspective, probability that some units in the group will fail is nearly 100%. So I'll have to recognize provision for the aggregate cost. All right. Once again, we'll recognize when do I recognize that a contingent liability as a provision or disclose or do nothing. First is start. Is there a present obligation from past event? Yes. Okay. Is an outflow of resources probable? Is more than 50%? Yes. Can it be estimated reliably? Yes. And if you remember, IAS 37 assumes that it could be reliably estimated. But if not, then it forms contingent liability. But if it can be reliably estimated, then it is a provision. Recognize a provision. But what if the possibility is less than 50%? It's not probable, rather it is possible. So I have to disclose contingent liability. And if the possibility is almost remote at 2 to 5% in that range, I have to do nothing. Got it? Finding the best estimate. So there are methods on how can you recognize a provision. The amount recognized in the best estimate to settle the obligation at the reporting date. First, I have expected valuation. For example, the probability that I have to incur a cost of $10, okay, for as repair cost, okay, that is 20%. The probability that I have to incur $20 is 20%, and the probability of $5 is 5%. So what I'm gonna do, $10, 20% into minor repair plus 5% into major repair. So that is how I'm going to get an average. And what is the most likely outcome for single obligation? For example, the most likely outcome that how much I have to pay is pound 1000. Okay. So used for lawsuits or one-off disputes formula, the single most probable figure. Okay, let's say there's a figure of 80%, 90%. So that is going to be your provision amount. Example, if euro 1 million settlement is the most likely outcome, provision would be created for euro 1 million. Got it? And the impact of time. Remember, unwinding of discount. In the case of oil rig, we've included the present value of dismantling cost, right? So at the inception, when I'm recognizing the property, plant and equipment, what is going to be the journal entry? So let's say the present value is $50 million. So debit PP, I'm just talking about the present value. And credit what? Present obligation arisen due to past event. Now me purchasing, constructing this oil rig has already a past event. And do I have the present obligation? Yeah, I have to incur the dismantling cost. So yeah, provision is there. So I'll be crediting provision with how much? $50. Now this is the present value. So let's say after 50 years, there is XYZ amount based on the, it's not going to be 50 million. 50 million is the present value. That is, after 20 years, if I discount it back as per the appropriate discount rate, let's 10%, I get a figure of 50 million. So I have to unwind it so that when I reach there after 20 years, I have that full provision amount. And when I pay that, I can reverse it. Got it? So charge as finance cost, and this difference is charged at finance cost, and at the reporting date it will increase the balance sheet amount of provision. Okay, that's the logic. A liability of $100 payable in 10 years is less of a burden today than $100 payable tomorrow. That's the basic logic, because I have to get to that. I say that is $80 million, for example. Okay, and the present value of is $50 million. So I am unwinding it, adding it to the finance cost, so that the provision by the time I reach there becomes 80 million. Got it? Liabilities versus assets. Okay, when it comes to asset, we are always prudent, because when it comes to liability, you can see if it's remote, do nothing for liability and assets as well. But if it's possible, in the range of 5 to 50%, I have to disclose in notes as contingent liability. But for assets, if it's possible, still do nothing. And if it's probable, more than 50%, recognize provision. But if it's probable for an asset, I have to disclose in notes as contingent asset. If it's virtually certain, still recognize provision. Okay? And in this case, recognize an asset. Got it? IAS 10, that is events after reporting period. Okay. So what usually happens is there is, let's say, we have a reporting date. For simplicity, we'll keep it at 31st December. Okay. What does this mean? All the balances in the statement of financial positions are as at this date. Okay. So that becomes our reporting date. Okay. It's very important. Carrying amount at the reporting date. Okay. So on and so forth. So is it like at 31st December, it is my reporting date. So I'm going to produce all my financial statements at that date only at exactly 12 a.m. No, it's not like that. There's a time frame in between the reporting date and when the financial statements are authorized and approved. So IAS 10 is concerned with whatever activity is happening in between this period. Okay? That's what IAS 10 is concerned with. So there are going to be adjusting events. Should I go back and adjust at that time? And non-adjusting event. What does non-adjusting event mean? That is something happened at 1st of March, 31st December 20x1. Something happened at 1st March 20x2. Okay. So if it's adjusting, it would have been reflected and adjusted accordingly. But if it's non-adjusting event, what does that mean? Which means it belongs to 1st March 20x2 and it will be recorded there. Nothing much. But what if it's material? What exactly is materiality? Same example. Let's say I start a business and earn a revenue of $10,000. Okay. So let's say there's an anomaly of $1,000. So what do you say? Would I mind if I do not find the accountability for that $1,000? Definitely. Why? Because that forms 10% of my revenue. Okay. So that is material for me. Any exclusion of this amount is going to change my decision. Okay, so that is what materiality. It differs from organization to organization, and you will learn this extensively in your audit and assurance. What exactly is materiality? Auditor sets some benchmark. Okay, it could be 1 to 2% of total assets, so on and so forth. Okay, so this is how materiality is determined. So if there's a non-adjusting event, we'll discuss what exactly is adjusting, non-adjusting. When do we classify this as adjusting and non-adjusting? We'll disclose it. Why so? Because it is hampering the decision-making ability. We have to faithfully represent the financial state. That's why this IAS exists. Got it? See, my reporting date is 31st December and I authorize the financial statements in March. So there are going to be adjusting events and not just non-adjusting events. If I talk about the brief definition, it's nothing but evidence. If the evidence existed at the time of reporting, it becomes adjusting event. And if evidence does not exist, indicative of conditions arising after the reporting date, nothing existed at the reporting date. So that becomes non-adjusting event. See, for example, financial statements are prepared in January and authorized in March. During this window, factories burn, customers go bankrupt, and law changes. Okay? Financial statements must represent the position at the reporting date. However, ignoring subsequent events can make those statements misleading. The question, do we rewrite history based on future events? IS draws the line between correcting the past and reporting the future. Reporting date of authorization, let's say 15th March. IS 10 governs only the events occurring in this specific window. After this, everything is ignored. Once the financial statements are authorized for issue, the window closes. It's only about this particular window. Okay, favorable or unfavorable wind, we'll look into that. The logic, one question to rule them all. Did the condition exist at reporting date? Let's say my reporting date is 31st December. And at 31st December, I am having a receivable. And that receivable, I know the financial condition of that particular debtor was not good. And on 15th of Feb, okay. And on 14th of Feb, he went bankrupt. Got it? So on 14th of Feb, this is after the reporting date. So on 14th of Feb, he went bankrupt. So isn't going to be like he was financially sound at the reporting date and directly he went bankrupt on 14th of Feb. Definitely condition existed at the time of reporting period. Okay, the simple logic is, does the condition exist at the reporting date? Yes, that's an adjusting event. Evidence of past confirmation and I'll have to correct it. And if the condition did not exist, let's say there was a fire at building at the same date of 15th Feb. Now, are there going to be any indicator? Is there any condition that exists at the reporting date? No. So that becomes non-existing event. New condition, future event, distinct. The entire standard hinges on this single decision node. If the logic clicks here, the application becomes intuitive. First, we'll look into adjusting event. These events provide evidence of conditions that already existed at year end. The problem was there. We just received confirmation letter. Look at this. We just received confirmation letter. Like, what is going to be the action? Adjust the financial statements. Why? The financial statements were incomplete or incorrect. Without this new information, we are looking back to fix the past. So that is adjusting event. Non-adjusting event. These relate to new conditions arising after the reporting date. Nothing was wrong at year end. A new economic phenomenon has occurred. The action, no adjust, disclose if material. Just now we discussed what is material. If there's a significant event occurring, so we have to disclose, although if it is non-adjusting. Why? User needs to know for future decision making. Intended users of financial statements. What do they want? They want informed decision making. So that is why we have to disclose if there is non-existing event. Got it? Hmm. Case file evidence of the past. For example, bankruptcy. A customer goes bankrupt in January. All right. They were likely in financial trouble in December. The receivable was overstated. So I will recognize the impairment loss if the customer went bankrupt. That comes under adjusting event. So there's another case of a verdict. Court rules in February that entity must pay 50 lakh for the past dispute. Okay, verdict. The obligation existed in December. The verdict was passed in February. Okay, what was the prime filter that we used? Did the condition existed at reporting date? Yes. Okay, so action recognize the provision, reverse the amount. Bankruptcy and verdicts are usually evidence, not new events. New circumstances like a fire. A factory is destroyed by fire in January. Verdict, the factory was standing. Had the reporting date, was there any evidence of fire? No, it was fine. And 31st, the exit existed. Do not adjust assets, disclose the loss because it is material, definitely. There's a fire in the factory. Merger scenario, buying a competitor in February. Verdict, the company did not own the competitor on 31st December. So action, do not adjust, disclose the acquisition. If it creates a new circumstance, do not touch the year-end numbers. Now, corrections versus new event. Inventory, the NRV test. Inventory costing 10 lakh is sold in January for 7 lakh. The sale prices proves the net realizable value was low at year end. So action, inventory value. No, this is an adjusting event. Fraud discovery. Fraud relating to the prior year is discovered in February. It was related to prior year. A condition existed at that time. The financial statements contain an error. Action adjusts the financial statement. These look like new events, but they are actually corrections of the past. Just keep in mind. Now comes the dividend trap. Dividend is declared after 31st December. Example in January or February. The logic at 31st December, was the company obligated to pay? No. Shareholders could have rejected it. There was no present obligation. So, no liability recognized at year end. Disclosure in notes only. Dividends are only liabilities if declared before reporting date. If it was declared before reporting date, then fine. It is considered as liability. But if it was declared before the reporting date, it already would have entered, would have been included in the statement of financial position as current liability, or reduced from statement of changes in equity. That's how dividend is dealt. Okay. The ultimate overhead, going concern. So if you know the fundamentals of accounting, we assume
to run for the foreseeable future. All right. What does that mean? We believe that business is going till the moon. Okay. But is it going to be the case? No, not always. There are going to be certain conditions which is going to prompt me to change my accounting method. What exactly is that? For example, management decides after year end to liquidate or cease trading. Okay. So does that mean I'm going to continue the business for the foreseeable future? No. I have to now account. My accounting changes from historical accounting to breakup basis. Now I would account as if I want to realize everything. The impact, the fundamental assumptions that the business will continue is broken. Rule. This overrides the non-adjusting logic. Even if the decision happened in March, the December accounts must change. Action. Total adjustment. Assets are no longer measured for continued. That's why we use breakup basis accounting. Accounting as if I have to sell it. I have to sell it. That's a breakup basis. Look at the word. Now comes a rapid fire strike by workforce. Condition existed? No. It happened directly. New event occurring post reporting. Discovery of fraud. Adjusting. Why? Error existed at year end. F. Foreign exchange rate for fluctuation. Non-adjusting. Why? New economic condition. I cannot say that the dollar price value was this much, so I will be adjusting that. No. Settlement of a legal claim. Adjusting. Why? Case existed, right? Condition existed at the reporting date. So, obligation existed previously. Rights issue. It's a new economic thing. So, that is non-adjusting because it's a new financing event. Inventory sold below cost. Adjusting. Why? Evidence of low net realizable value at the reporting date. Got it? Hmm. What are the transparency and disclosure requirement when it comes to IS 10? Date the financial statements were authorized so that you know what is the time frame exactly, who authorized them, the cutoff point. For material non-existing event, user need to understand the future impact on the business. The nature of the event and an estimate of financial effect needs to be disclosed. If the event is non-existing, but if it's material. Got it? So now we'll move on to different IAS 8. Yeah. So what's happening till now? If you remember, IAS 16, property, plant, and equipment. It has two models for subsequent measurement of non-current asset. One is at cost and one is revaluation model. Okay. Now it based on industry practices, company policy on how they are recording it as. Are they using the cost model or revaluation model? Okay, this is the prime question. So this is the accounting policy, right? Now, remember depreciation, useful life of assets. Don't you think it won't be possible for the management to accurately predict that it is going to last for only 10 years? No, it is not going to be like that. So that comes under estimation, right? Hmm. And what if there was an error in the past?
How do we account for all this? If there's a change in accounting policy from cost to revaluation model, if there's a change in estimate, before it was 8-year useful life, now we have reassessed it and made a judgment that the useful life is 4 years. And what if we have discovered that this was an error made in the past? Interest was wrongly recorded. Okay? So, how do we account for this? Do we get back to the history and adjust it retrospectively? Or should we just continue and adjust it prospectively? What does that mean? Coming forward. Okay? If the estimated useful life of asset has now been revised from 8 years to 4 years. So, I'll be adjusting it with the new depreciation charge. I won't be going back. Okay, so that is what IAS 8 changes in accounting policies and estimate deals with. Okay, the problem without rules, profit is just an opinion. For example, FIFO method or weighted average cost method. So if the company switches to weighted average cost to boost low profit and then changes the depreciation method and then claims prior years were wrong, so what's going to be the impact? In this scenario, users cannot tell if a business performance actually improved or it is just accounting myth. So that way, don't you think it makes sense to show the accounts as if always, let's say we've shifted from cost model to revaluation model to show the account as if revaluation model was always used. That will be more relevant to the users of financial statement. IS 18 ensures we compare apples with apples. Got it? The ground before the hours. We want fair representation, substance over legal form, going concern. Okay, survival is more than 12 months. And accrual basis. Event, we recognize IS does its accounting based on accrual basis. It's not like when we receive cash, we are going to record the revenue and so on and so forth. If we have receivable, we are still going to record the revenue. That's what accrual basis is. And out of this, we are going to make policies and estimates. So example A, for substance over firm, a sale with a buyback agreement is recorded as financing, not revenue. Right? Remember IFRS 15? If the business is closing, assets drop to scrap value immediately. And record revenue when earned, not when cash is received. Debit receivable, credit revenue. Doesn't matter. It should not always be debit cash and credit receivable. Credit revenue. When compliance breaks the truth, the true and fair view override. Normally, fair representation is achieved by strictly by following IFRS. Okay. However, in extremely rare cases, example a crisis where fair value become meaningless, strict compliance might mislead users. So, management may depart from standard if following it misleaded users. Management may depart from the standard if following it may mislead users. And the disclosure checklist is what? Which standard was ignored? Why was it misleading? What alternative was used? And what is the financial impact? So, what exactly is true and fair? We have discussed it extensively for every IS Act we discussed. Presenting financial statement that honestly reflect the economic reality and performance, even if it requires departing from a specific IFRS standard to avoid misleading users. Okay, that is where this IS steps in. Accounting policies, the rules we choose, we as company choose. Principle, basis, conventions, and practices used to prepare statements like first in, first out for inventory valuation. IS2 allows either you choose FIFO method or weighted average cost method. So must follow standard. Example, IS2 requires lower of cost or NRV. That is what required by IS2. And consult conceptual framework or similar standards. So first, if the IS exists, you have to follow the IS. But if not, in very rare circumstances, consult conceptual framework. It has all the laid down definitions for what is asset, liability, equity, income, and expense. Okay. And what's the objective of? To have true and fair view. And any information included should be faithful and relevant. Okay. So you cannot use FIFO for warehouse A and weighted average for warehouse B just to manipulate the bottom line. You have to consistently apply that particular policy only. Okay. Changing a policy. As a, with appropriate reasons, you chose to get to revaluation model from the cost model. That's a change in accounting policy. So why is change allowed? Required by IFRS. If there's a new IFRS in issue, results in more relevant, reliable info like switching to revaluation model. Never allowed just to smooth profit. Retrospective adjustment. Adjusted as if revaluation model was always used. Got it? Apply the new policy as if it has always existed. Restate comparative figures for prior years. Adjust opening retained earnings often requires presenting 3 statements of financial position. Now comes policy change in actions. For example, this might be confusing. How do we reinstate past year profit? Let's say there are 2 years, 20x6, 20x7. So original reported profit was 100 lakhs. After changing the accounting policy, the new profit has been 115 lakhs. So the opening in retained earnings would be adjusted with this increase, and last year would be we rewrite the past 20x6 profit changes from 100 to 115 using the new method. Now the trend from 115 to 140 is meaningful. We are comparing apples with apples. Got it? Exception IS 16 revaluation is applied prospectively when it comes to revaluation. Now comes accounting estimates, the measurements. What exactly is that? Useful life of machinery. From 4 to 8 years. What's going to be the impact? Definitely my depreciation is going to be lower. Warranty provisions, I predicted it. Now I think that before I predicted that I have to create a provision for 5% based on past trends. Now the new estimate suggests that only 2.5% is needed. Expected credit losses, net realizable value, all these are estimate changes. Why they change? New information, more experience, or changing conditions, not because we are wrong before. So an estimate is not a policy is a rule. Example, straight line depreciation. An estimate is a measurement based on uncertainty. Example, the machine will last 10 years. So how are we going to account for this? Prospective adjustment. So till now, let's say I was recording the depreciation as 40,000. From now on, because the useful life has increased, the depreciation is 20,000. So I'm just going to book it 20,000. I'm not going to make past adjustment retrospectively. The past was reasonable based on what we knew, then do not touch it. A machine was depreciated over 10 years. In year 4, we realized it will last 15 years. Do not change years 1 to 3. Simply spread the remaining carrying amount over the new remaining life. Basically, depreciation is going to be reduced. Now comes prior period errors when we were wrong. Okay, omissions or misstatements resulting from failure to use information that was available. Keep in mind, it should have been available at the time. This isn't a change in view, it is a mistake. Example, mathematical mistake, misapplication of policy, fraud, overlooking facts. Example, inventory count was wrong, and personal expenses booked as business expenses. Everything comes under error. Okay, now it makes sense that we have to reinstate that. If we want to reinstate, that means prospective, retrospective, as if we have already corrected it. So that's why retrospective. Got it? Now, correct the financial statements as if the error never happened. If I want to book if some expense was missed. So I have to adjust it backwards, retrospectively. Restate comparatives and adjust opening retained earnings. What's the logic? Error correction does not create new profit. Okay, keep in mind that if we miss some interest income or something like it does not create new profit. If we overstated expenses last year, we understated profit. Correcting it moves that profit from nowhere back into the last year. It creates no new economic value. It just places the value in the correct time period. That's what we want. If it is placed in the correct time period, true and fair view. Users get relevant and faithful information. And that is what we want. Got it? Accounting policy is a rule change. We have to adjust it retrospectively. Comparability must compare with like accounting estimate is new information. Prospective. Past was reasonable at that time. Prior period edit, mistake, fraud, retrospective. The past was incorrect. So these all are the adjustment that we need to make. Got it? So now we'll do some questions. This is yeah. Which two of the following statements about contingent assets and contingent liabilities are true according to IS 37 provision, contingent liabilities and contingent assets? Let's see. A contingent asset should be disclosed in a note if an inflow of economic benefits is probable. If it's probable, what do you say? Should we disclose it? I will see. A contingent liability should be disclosed in a note, regardless of the probability of transferring economic benefits. If it's remote, we ignore it. So yeah, this is not true. No disclosure is required for a contingent liability if it is less than probable, in between 5 and 50%, that a transfer of economic benefits will be required. No, we require a disclosure for contingent liability. So this is also not true. This is also not. If circumstances relating to a contingent asset change and an inflow of economic benefits becomes virtually certain, an asset should be recognized. Yeah. D. A contingent asset should be disclosed in a note if an inflow of economic benefits is probable. For asset, the 5 to 50% stands for disclosure. Okay? So we have to disclose it. So A and D are right. Now comes question 2. For which two of the following should time recognize a liability as at 30 September 20x4? Signing a non-cancelable contract in September 20x4 to supply goods next year at a loss due to a pricing error. Remember on-risk contract? We have to create a provision for that. Yes. So we'll have to recognize the liability, that is a provision. Cost of reorganization approved by the board but not yet implemented or announced. What are we going to do in this case? It has not yet been announced. If it's not announced, then there is no obligation. We are not going to recognize a liability in this. Deferred tax relating to a gain on revaluation of property during life. If we remember, when we create deferred tax liability, okay, if carrying amount is more than tax base, we create a deferred tax liability. Remember IS 12? Yeah. So it's a liability of uncertain timing and amount, and we recognize it. So yeah, C is right. This is also right. Warranty provision relating to products where warranties have expired by year end. It has expired by year end. So what's the point in recognizing the rent? So A and C are correct. Now comes on 1st October 20x3, Explorer commenced drilling for oil.
extraction damages, the seabed, and registration costs are 10,000 per million barrel extracted. Let's say if you extract 1 million barrel, it will cost you $10,000. Okay. So during the year ended 31st September 20x4, after 1 year, 250 million barrels were extracted. So this is a present obligation arisen out of past event. Right? So that will be included in the provision. Explorer must also dismantle equipment at the end of a 5-year license at an estimated cost of $30 million. It's after 5 years. On 30 September 2028, the present value factor 5 years is 0.68. They have given us the present value factor. We'll look into it how to calculate it. Okay. So what total provision should be recognized at 30 September 20x4? We are already extracted 250 million barrels. All right. And for 1 million barrel, it is going to cost me 10,000. So $10,000 into 250. That is 2.5 million. All right. First of all, I have to recognize this and an estimated cost of 30 million. Present obligation, past event recognizes it, satisfy the criteria. Okay. So how am I going to account for this? Present value is at 30. So 30 million into 0.68. So that gives me 20.4 million. Right? That gives me 20.4 million. Now, what does this mean? So I have 20.4 million plus 2.5 million. So that is 22.9 million. C is the right answer. Got it? Total provision to be recognized. See. Now I have question 4. At 30 September 20x1, closing inventory was incorrectly stated at 386,400. Okay. Included were 1,000 items costing $18 each. These were sold after year end for $50 and the selling cost were $800. Okay. So can I say $800 was the net realizable value for those 1,000 items? So how am I going to record this? $50 per unit was the net realizable value and the selling cost were $800. So how am I going to record this? If you look at this, how many items? $50 into 1,000. And it costed $18 into 1,000, right? That is 18,000 and 15,000. And out of this 15,000, 800 was the selling cost. Okay, so 14,200. So how much write down is required? $3,800. And what is my inventory valued at? 386,400. Let's look at the other scenario. 5 items purchased 8 years ago for $100 each and sold after year end for $1,000 each, net of selling expenses. So do you think there's any need? No, because it costed 1,000 and the NRV is much higher. Okay, so no adjustment needed here. So how am I going to calculate what is the correct carrying amount? 3,800, 386,400. See, 3,800 of write down is required and incorrectly stated at 38. So if I deduct less 3800, I'm gonna get 382 600. Got it? Which two of the following statements regarding inventory measurement are correct? See,
हेलो सर हेलो
yes,
नहीं आया सर फोर्थ वाला
हाँ. See, one on 30th September 20x1, closing inventory was incorrectly stated at 386 400. They are clearly stating it. It was incorrectly stated. For included in this were 1000 item costing $18 each. 1000 costing $18. So that is 18,000. Okay. These were sold after year end for $15 each. So this 1000 item was sold for $15. Okay. So 15,000. And the selling cost was 800. So that is 14,200. Now, if you look at this carefully, this is the NRV, net realizable value, and this was the cost. So I require a write down of how much? 3,800, right? So if I look at this carefully, it was incorrectly stated as 386 400. I require a write down of 3,800. What does that mean? 386 400 less 3,800. That is 382 600. Got it? See, 5 item purchased 8 years ago for $100 each and sold after year end for 1,000 each. So is there any need? NRV is much higher at $1 1,000. What does IS2 says? If they measure at lower of cost, in this case cost is lower, so it will stay at cost. Got it? So my inventory would be valued at 380 to 600. Now comes, which two of the following regarding inventory measurement are correct? The carrying amount should be as close as possible to net realizable value. They should be lower, as close as not, lower of net realizable. All classes of inventory must use the same cost formula. Production overheads included in inventory cost should be based on normal production levels. Yes, net realizable value should be assessed item by item or for similar items, not in total. So if you can see, all classes of inventory, they have the options to use FIFO or a weighted average. Production overhead, yeah, this is correct. It should be based on normal production level. We have discussed the inefficiency portion is expensed in P&L, and net realizable value should be assessed item by item per unit. Okay, and not in total. That's why in this question you can see $18 each. There was an adjustment required out of this. That is item by item. Question 6. XYZ farm purchased 100 turkeys for $10,000. Okay. So at 31st December, estimated selling price was 10,500. Expected cost was transportation 700, interest expense 700, and income tax 1,000. So I think these are not to cost of sale. And what does IS 41 say? It should be measured at fair value less cost of disposal or sale. So in this case, I can include transportation in that because that would be required. So my estimated selling price is how much? 10,500. So there's no point in
excluding this, and getting a total and reducing it for 10,000. I just have to reduce 700. So what does that give me? 10,500 minus 700, 9,800. Got it? Now comes, which two of the following are biological assets within IAS 41? Biological assets. Fruit trees, bearer plant. Sheep, yeah. Harvested as apple, inventory. Wine also inventory. Sugar cane, yeah, could be. And milk is also inventory. So I can say sugar cane and sheep comes under IS 41 biological assets. Today we are going to deal with IFRS 15, revenue from contracts. Now any statement of profit and loss. The first line is always revenue XX. Then you have cost of goods sold. We deduct that, and then we derived gross profit. So if you can see, this is the first line that I have in my financial statements. This is going to form the basis. Okay. Higher the revenue, definitely higher the profit, because this is the base number that I use, okay, to get to profit. Now, definitely, it is very important that how should we account for this? Should I book the revenue when I receive cash for the goods provided or services rendered? Genuine doubt. Yeah. So IFRS 15 answers all this. It has a step-by-step process through which you can recognize revenue. And why is it very important? Because if you see, whenever there's valuation you paid, this is the first line that enters the statement of profit and loss. So this is going to determine your forecasted sales, your everything. Okay, if it's gonna determine okay, what is going to be the future sales, it's used in valuation. So yeah, accounting for revenue is as important as that. Okay. The core philosophy is performance, not cash. What is performance? Transfer of goods and service. Time and time, whenever I am teaching any IAS or IFRS, it's all about control. Risk and rewards are transferred or not. Right? So this is all dealt under IFRS 15. And consideration is what I expect from those goods and services after I complete my performance obligation. What's the objective of IFRS 15? To recognize revenue in a way that reflects the transfer of control in an amount that reflects the consideration the entity expects to receive. The when his timing is determined by transfer of control, and how much measurement is based on the entitlement expected. That is basically consideration. Okay, so I sell goods, well, let's say $100, and I sold 100 of them. All right, so this revenue of 10,000 would be consideration. But if I expect 99,500, then this expected value is my consideration. So I'm going to be booking the revenue by 9,500. So how do I
recognize revenue. So there are 5 processes. These are going to stay the same in SBR as well. First is identify the contract. Confirm validity. Is there a valid contract? Identify performance obligation. Understand promises. Determine the transaction price. Quantify the value. Okay? 9,500, 10,000, which one? Allocate the transaction price. And then recognize the revenue. It could be either at a point in time, okay, or over a period of time. We'll discuss each and every step in detail. See, the sequence is rigid. You cannot allocate price, that is at step 4, without identifying the obligations. Okay, the single model replaces all previous industry specific standards. Irrespective of which industry you are operating, you have to first identify the contract, then identify a performance obligation, then you have to determine the transaction price, allocate it, and then recognize the revenue. Got it? First gate says identify the contract. Okay. First, the gatekeeper. First question you ask whether a sale has occurred or not. Is the contract approved, written, oral, or implied? Are the rights identifiables? Goods and service in the contract, are they stipulated properly? Payment terms identifiable? What's the exact price? In revenue terms, we call this as contract price. Commercial substance, future cash flows will change. Collection is probable. The collectibility issue, revenue is only recognized if it is probable. See, probable in the range of more than 50%. The entity will collect the consideration. For example, a construction company signing a contract with a significantly distressed customer cannot recognize revenue until collection becomes probable. Because the customer is significantly distressed, it's not probable that he's going to make the payment. So I cannot recognize revenue in that instance. This prevents overstatements, and that is what we want. True and fair view. Right? Now, the second part, performance obligations. What am I supposed to deliver in exchange for that consideration? It's not gonna be like someone is going to pay me for nothing. We have commercial substance here. So, is the promise distinct? Can the customer benefit from the goods and services on its own? Let's say I sell a customer a pen. Okay. So, yeah, he can derive the benefits of the pen on its own. But let's say there's construction. First, I'll be building the blocks, and then there will be work in progress, and then finally, I'll be building a house. So, can the customer benefit at this stage? No. So, that's a bundled transaction. Or let's say there's a software. So, the customer can benefit separately from the software card, tech support, and updates because they can be purchased distinctively as well. Okay, each element provides independent value and it's separately identifiable. Okay, so can the customer benefits goods and service from its own? Yes. Is it separately identifiable from other promises in the contract? Yes. So that I have distinct performance obligation. If no, I have single performance obligation of construction. Got it? So when the revenue should be recognized in case of single performance obligation? When I have completely built the house. Okay. But what there will be a confusion. What about revenue over a period of time? That we'll discuss. But when it comes to separately identifiable transactions, in this case, it's software card, tech support, updates. So in that case, they all will be having a standalone prices. Okay. In their respective areas. If a customer wants a software card, it cost is $50. But then there would be a bundle, including all the software card, tech support, and updates. So let's say the transaction price is 1000. So I have to allocate this transaction price in the proportion of each and every distinct identifiable performance obligations in standalone prices. Let's say the software cost, if sold separately, costs 250. Okay. So 250 here, 250 here, and 500. Sorry. It costs 300, 300, and this costs 500. Okay. So if you can see this total of standalone prices is 1100. So I will be allocating this 1000 among these three. Okay. We'll do a proper questions about that. What about transaction price? Let's say I have already received cash, but the work has been completed after 2 years. So substantially, substance over firm, customers is essentially lending me money because he hasn't received the work to be completed. I haven't completed my performance obligation. So what does that mean? Let's say the customer gives me 840,000. Okay. So after year two, in year two, he is supposed to pay 970K. But he right now paid 840,000. I have received the money in advance. All right. I have received this money in advance. So what am I going to do? The work is to be completed as this. What do we say? After year two, right? So what am I going to do is when I receive 840,000, that I'll be putting a journal entry like debit bank 840,000, right? And credit liability. Why not revenue? Because I haven't satisfied the performance obligation by 840,000. Okay. So then what's going to happen? In year one, I'm going to unwind the interest. Let's say the effective interest rate is implicit interest rate is 8%. So I'm going to be increasing the liability by 8%. Okay. And then once again in year two, 8%. So that will grow to 907,000 as liability. And then when I satisfy performance obligation, that would be converted into revenue. Okay. But what if I have completed the work done, but the cash received is afterward? So essentially, what is happening is I am lending the customer. The company is lending the customer because cash is being received afterwards. So year three, I'm going to receive cash. So what am I going to do? Let's say I'm going to receive $5,000. Okay. After 3 years. So I'll be recording the revenue at present value. All right. And then the customer is eventually going to pay me 5,000. So that difference between the present value and the money that I'm going to receive, that would be my interest income. Got it? Variable and non-cash consideration. Variable consideration like the constant include, let's say I am constructing a building. Constructing a building. All right. Now, what's going to happen? As per the contract terms, if
I complete within 1 year, I am eligible for a bonus, right? So this is as per the terms of the contract. So that forms my variable part, variable consideration. It could vary. I could get it depending on my performance, but I could not get a single penny if I do not satisfy the condition. So, like bonuses, rebates, penalties, discount we have to include this in the revenue recognition only if it's highly probable that significant reversal of revenue will not occur. Hmm? I should be almost certain that I'm going to receive that amount, because how can I be sure that it is highly probable? I'll know now. I'm constructing a building, so I'll be having an idea that it is going to be completed within the 1 year time framework, 1 year time frame. So then I'll be recording the revenue, the bonus element as well. What about non-cash consideration? When a customer pays in goods or shares instead of cash. Simple. Measure at fair value of the non-cash asset received. If fair value cannot be estimated, use the standalone selling price on the goods promised. Okay? In rare case. But if the customer exchanges commodities or shares, the it is easy to derive the fair value. Now comes allocating the transaction price. Remember, we discussed about distinct performance obligation. So let's say I have two promises. Obligation A is standalone selling price is rupees 100. And obligation B, the standalone selling price is rupees 200. So what's the total standalone selling price? 300. And I made the transaction bundling these two at 240. So how am I going to allocate this? Simple. 240. This is the transaction price. And for obligation A, the standalone selling price is 100 and total is 300. So that is going to give me 80. Got it? Simple. Same goes for B. The standalone is 200 and I've made the transaction as 240. So that is going to give me 160. Okay. Allocation is determined at contract inception and is not adjusted for subsequent changes in standalone prices. If it's locked at 300, we recognize at 300. So then we do not, go and look that the standalone prices has changed. We have to allocate it differently. No, at that price. Now comes the final steps. Okay. Over time or at a point in time. When? The big question. So there are two ways in which you can recognize revenue. At a point in time, you sold goods, you satisfied your performance obligation. Yeah, done. There and there you recognize revenue. When you transfer the goods, control has been transferred. But what about overtime? If any of this is met, simultaneous consumption. Example, cleaning services. Okay. Customer is receiving benefits, right? If I clean one room, then yeah, it's simultaneous consumption. Asset controlled by customer during creation, like building on customer land. Okay. So if the building is getting built, slowly its value is increasing. No alternative use. Plus right to payment. Example, custom manufacturing. In that case also, it is not going to be like I am going to be able to produce that machinery within 1 to 2 months. Okay, it is going to take time. It is custom, but I have the right to receive cash. So in that case also, let's say I completed a task on the machinery at 40%. So I'll recognize the revenue of 40% of the contract price. Got it? So that's over a period of time. So whenever I'm building, let's say I'm constructing a building, so that is going to be recognized over a period of time. So how are you going to recognize this? There are two methods, input method and output method. We'll discuss that also. Measuring progress over time. Input versus output. Output is basically based on the value transferred to customer, or you can say work certified. Hmm? Example, work certified, milestones achieved, units delivered. Pros, direct reflection of performance. Cons, outputs may not be observable early in the contract. Input method. Simple. Input. You are inputting something based on entity's effort to satisfy the promise. Example, cost incurred, labor hours, time elapsed. And as usual, we have to exclude inefficiencies, wasted materials, and abnormal costs. These do not represent progress. We just have to include those costs that reflects progress. That's why input method. All right. Now we'll do a small example on what exactly is input and output method. See, Tanner is building a multi-unit residential complex. In the prior year, Tanner entered into a contract with the customer for a specific unit that was under construction. Okay. Tanner has determined that the contract represents a single performance obligation satisfied over time. Yes. And single performance obligation, why so? Because I cannot sell the bricks alone. Okay. That was single performance obligation and satisfied over time. Tanner gathered the following information for the contract during the year ended 31st December. So these are the cost incurred to date 1500, future expected cost. So that will basically form my total cost. Work certified to date is 1800. All right. Expected sales value, contract price, right? And revenue recognized in earlier period is 1200. Okay. Now, what are we required? Calculate the revenue to be included in the statement of profit and loss for the year ended 31st December using work certified output method and cost incurred input method. See, it's easy to remember. Output, I've done the work, it has been certified by some external party. That's why output method. Input, simple. I have inputted something. That's how I derive cost. Okay. To determine the stage of completion. Let's see how are we going to deal with this. See what have we been given. First, we'll deal with output method. Okay. So what's the contract price? 3200. And work certified to date is 1800. This is the total work certified. So if I take the percentage, it comes out to be 56.25%. So I can recognize a total revenue. What's the contract price? 3200. So I can recognize the total revenue. This is a cumulative revenue, okay? Because this much work has been satisfied. That comes out to be 1800. But if you can see, revenue recognized in earlier period was 1200, right? So that gives me a revenue of 600 as per the output method. Now let's see what's about input method. Cost incurred today it is 1500 and future expected cost are 1000. So
cost are 1000. So I can say that for the entire contract, the total cost is going to be 2500. Okay. And out of that, I have already incurred 1500. Okay. So that gives me a 60% I have incurred. So if I look at the contract price, that is 3200. And divided by 60%, that gives me 1920. Okay. And how much revenue was recognized earlier? 1200. So for this year, I'm going to recognize 720. Okay. So 600 as per the output method and 720 for this year as per the input method. Got it? Now comes contract costs, asset versus expenses. See, if you incur any cost to obtain a contract, like incremental cost, sales commission, capitalize, you can capitalize as asset if they are recoverable. Okay. But usually they are not. But general costs like travel, bidding costs are expense because they were an avoidable cost. So you have to expense those costs. Okay. Now, cost to fulfill a contract is like check other standards like IS 16 for equipment. Okay. So if no other standard applies, capitalize if it relates directly to contract, generates resources for future use, and costs are recoverable. General admin is always expensed. Okay. So let's say you have a machinery. So for that depreciation component, you can input that expense as input cost. Okay. If it relates to that particular contract. Now comes presentation, contract asset versus contract liability. It's pretty simple. Let's say I work, completed the work of worth of dollar 100,000. I have satisfied a performance obligation that will equate to 100,000. But I have invoiced the customer only 90,000. Okay. So definitely I have satisfied the performance obligation. So 10,000 in this case would become my contract asset. Usually the current asset. Okay. Now let's say inverse. I satisfied the performance obligation worth of 90,000, but I invoiced my customer with 100,000. So that simply becomes my contract liability because I'm still not being able to fulfill that 10,000 of performance obligation. So that becomes my contract liability. Okay. So that's a simple concept. Contract asset, we have performed work but not yet have invoiced. Okay. Nuance, conditional right to consideration, distinct from a receivable, which is an unconditional right. Okay. That's why we do not show it as receivable. Rather, we show it as contract asset. What about contract liability? We have invoiced or received cash but have not yet performed the work, also known as deferred income. Got it? No offsetting allowed between these two contracts. Okay. So you cannot have a net position. Now comes special arrangements. What are those special arrangements? Principal and agent. There's a principal and there are agent. What's the role of principal? Controls the good and service before transfer. Accounting recognizes gross revenue. The principal is primarily responsible for the fulfillment, bears the inventory risk, and has discretion in establishing price. Okay. And who are the agents? Arranges for another party to provide the good. So they receive a commission
So for agents, the revenue is going to be commission. All right. Indicators they are paid in commission does not control the specified good. Okay. Now comes repurchase, bill and hold, and consignment. What is a repurchase agreement? When if the entity has right and obligation to repurchase at a price, usually the price is more or equal to the selling price. If I am selling a machine for let's say $10 million, then I have the option to buy it out within 2 years at 12 million. Okay, so this essentially is not a sale. This is repurchase agreement. Okay, so this is basically the other company lending me money. So it is a financing arrangement, not a sale. Cash received equals to financial liability, and I do not de-recognize the asset. Now, bill and hold arrangement. Customers buy what but leaves goods with entity. Let's say I purchased a machinery worth of $15 million, and I also purchased tools to operate that machinery worth of $1 million, but I do not have the storage. Okay, so what's gonna happen? I asked the vendor reply, okay, who provided me with the machinery. I asked him that can I store the machinery tools at your warehouse? So from vendor's perspective, who has sold me the machinery, he has satisfied the performance obligation. Yeah, he sold me the machinery for 15 million. He also sold me the tools. So yeah, from his end, he can recognize a revenue of 16 million. All right. But what in this situation is happening? I'm asking him to hold the machinery tools. Okay. So basically, he is also going to, along with the 60 million, also going to receive a storage fees. See, customers buys but leaves goods with entity. Revenue recognized only if substantive reason exists, goods identified separately, ready for delivery. Okay. And then I'm just putting it in the seller's warehouse. Okay. And then comes consignment. Dealer holds goods, but supplier retains control. Same car dealership. Let's say a car manufacturer, it sends cars to the dealer. Now, dealer, although it might look like a dealer has purchased the cars and okay, he's bearing the inventory risk if the cars do not get sold, but it's not like that. The car manufacturer will lend the dealer his car, and when the dealer is going to book a sale, the car manufacturer then can book revenue. And what is the dealer going to receive? Commission, right? So dealer holds good, but supplier retains control. Revenue recognized only when dealer sells to a third party. Okay. So when the supplier sells to dealer, there is no revenue. Why so? Because essentially control has not transferred. Risk and reward has not transferred. See, so before we wrap up this, we first just summarize all the things that we studied. Is there a valid contract? Yes or no? Are obligation distinct or bundle? That is step two. Is there variable consideration or financing? How is the price allocated? Standalone? Does the control transferred over time or point in time? How is revenue recognized? If over period time, input or output methods. Is the contract onerous? Loss making? So what happens when the contract is loss making? You create a provision. Provision on onerous contract. What's going to happen? Let's say I had a contract of $150,000, but the cost to fulfill that contract are 200,000. So what I'll do is I'll book a provision. The total loss is this much.
And then I'll spread it. So first there would be loss on contract. So debit P&L by 50,000 and credit provision by 50,000. All right. And now each and every year, let's say it was for 3 years, I'll spread it. Okay. So the first year that would be current liability, and for the rest of the years it would be non-current liability. Got it? So yeah, so this was it for IFRS 15. Now let's move on to IFRS 16, that is leases. So see, traditionally what was happening, that if you want to buy a big asset, you used to get a loan from bank, right? Let's say the machinery. You want to buy a machinery of $5 million. Hmm? And then you get to the vendor and purchase the machinery for $5 million. So you recognize an asset for $5 million and a liability, because you have to, repay the loan, a liability of $5 million. That's the traditional view. So that's where IFRS 16 stepped in. Okay, it's based on control. So what exactly is lease? There's a lessor and there's a lessee. So let's say I want for my company for 10 years. Okay. So it's an office space for my company for 10 years. So definitely I would want that it should be themed according to my company. Right? So on and so forth. So basically what I want is for the tenure of 10 years, I want control. Hmm? So that is not possible with simple renting out. Not possible. So that's why I want control. Hmm? I want to direct the use of asset. So if this is the case, so in the lease term, I would be told that you have to make an annual lease payment of $50,000 for the next 10 years. Okay. So I have to make a payment, but I also can control the entity. Remember definition of an present economic resource. Resource providing future economic benefits and controlled by the entity. Okay. So yeah, this particular office sits in the definition of asset. What about liability? A present obligation arisen due to past event.
and for which probable outflow, there's a probable outflow. So these lease payment also represent liability. So that is where IFRS 16 steps in. Leases. Okay. So there's a lessor who holds the asset. And then there's lessee who leases the asset. Okay. So when it comes to lessee, we are concerned with in the books of lessee. So logically, when I talked about that particular office, I'm going to have an asset and a liability. Yes. So that asset is transferred to right of use asset. And liability is basically the present value of lease payments or lease liability. Okay. So this is the wholesale transaction that we are going to revolve around when it comes to IFRS 16. See, let's say a company needs an asset. Historically, the choice was binary: buy it, asset plus loan, or lease it, expense. IFRS 16 remove this distinction. If you control the use, you must recognize the obligation. So similarly, with loan, a PPE and a bank loan, lease under IFRS 16, ROU asset and lease liability. See, understand that leasing and borrowing are now economically similar. Off balance sheet financing is gone. So how do I recognize is there a lease or not? Control is very important. For example, there's a scenario. AB company and road hauler. Okay, so the contract is transport goods from London to Edinburgh. Okay, so inputs. AB co uses substantially all trucks capacity. Dates are fixed pickup and delivery. Restriction. Road hauler operates the trucks, this company. Okay, and decides the route. So we'll apply the logic. Is there an identified asset? Yes. Specific truck. Does the customer obtain economic benefits? Yes, because the customer is using the full capacity of the truck. Yes. So does the customer direct the use? No, because supplier operates the trucks and decides the route. So this is a service contract, not a lease. See, obtaining economic benefits alone is insufficient. You must have the power to direct how and for what purpose the asset is used. So let's look at another scenario. Contract 20 refuse trucks for 6 years. Specification, registration numbers are listed in the contract. They are also listed. Supplier can substitute trucks but only for servicing and repair. If you can see the lessor or supplier, he can substitute the trucks but only for repair and maintenance. Can I say I have the control? Substitution for repair and maintenance, no economic benefit to supplier. Substitution is not substantive, so lease exists. The term is specified, there are specific 20 terms, so on and so forth. So in this scenario, there is a lease. Now, what about lease term? Economic expectation overrides legal verdict. Let's say the machine. Management is reasonably certain to extend the accounting term to 5 years. Okay. So the lease has a 3-year non-cancelable period. For example, okay. But at the discretion of lessee, they can extend the option. Okay, so now the management feels that they will exercise the option. So what's going to happen? My lease term would be 5 years. Okay, so I'll deal accordingly with the depreciation of ROU asset and the lease liability. Let's say there is another scenario. The factory management expects to cancel at break clause accounting term 15 years. Okay, from 20, there's an option to do it early. So in that case, I will not be using 20, I'll be using 15 years. See, the lease term is not just the contract length, it includes optional period if the lessee is reasonably certain to exercise them based on economic incentives. That is what is going to form my lease term. Okay. Now comes a proper example for short-term leases. IFRS 16 allows exemption when it comes to short-term lease or small value items. Okay. So for example, there is Kesco to lease office space. The term is 12 months. Okay. Exemption applied because it's less than 12 months and IFRS 16 allows for exemption. And the rent is $1,000 per month and first 2 months are rent free. Simple. Total cash flow 10 payments, 10,000 is the total cash outflow. Usage period is of 12 months. Okay. So do remember that you are not counting in the incentive. P&L expense would be 10,000 divided by 12. That gives me 833 per month. See, even if payments vary for there are rent-free periods, then you might think so, I should have been dividing the 10,000 divided by 10. No. The expense must be recognized on a straight line basis over the lease term to reflect the pattern of usage. That's how you get true and fair view. Okay. Now comes the present value of future obligations, lease liability. All right. So what is lease liability? As discussed, lessee has to bifurcate that in ROU asset and lease liability. What is lease liability? Present value of future lease payment. For example, there's a machine lease. The lease term is 6 years. The interest rate implicit is 10%. You have to make a lease payment of 2,000 annually in arrears at the end of the years. And you also have a purchase option of $500 and you are reasonably certain that you are going to exercise it. So we also have to include this. All right. And the deposit is 2,000 paid upfront. Okay. So annual payments from year 1 to year 5 or 2,000 into 5 include. Purchase option year 6 500 include. Deposit paid initially of 2,000 exclude because it has been already paid. Lease liability or present value of future payments. If you have already paid 2,000, there's no use in calculating that. Okay. So PV of payments plus present value of option. We've been given the annuity for 5 years at 10% is 3.791. So I'll just multiply this with the annuity factor. And for the 6 years, it is 0.564. So that gives me an initial lease liability of 7860. Okay. And what about ROU asset? Okay. First, we'll look how do we subsequently measure the lease liability. So I've got the initial lease liability to be 7860. Okay. So now what I'm going to do, this will be my opening balance for lease liability. Then I'm going to input a finance cost. Then I'm going to have a total. Okay. So that gives me 8646. Then in the year end, I'll make a payment of 2,000. Right? So I will be getting a closing balance of 6466. Now this, I'm standing at 6466. For the next 12 months, what I am going to get? Next payment is 10,000. Next interest is 665. So for the next year, I'm going to pay 1335. So that becomes my current liability. That is next year's principal. And the balance remaining 5311 is going to be my non-current liability. Got it?
So that's how subsequent measurement of lease liability is done. ROU asset. So remember, we have paid an initial deposit of 2000. Now, although it has already been paid, so that won't be included in the lease liability, because lease liability is what? Present value of all future payments. Okay. So, but when it comes to ROU asset, that is a directly attributable cost. You paid it on the lease agreement only, and then you got the asset. So you have to include that 2000 in ROU asset. Okay. So what is ROU asset? Initial lease liability, deposit paid, and any direct installation cost. In this case, there was 600 rupees of installation cost. So that gives me an ROU asset of 10460. Okay. Now 10460, it's an ROU asset, so I'll be depreciating it as per IAS 16 property, plant and equipment. The next scenario involves a purchase option of $500 that is reasonably certain to be exercised. Will ownership transfer here? Depreciate over useful life or lease term? Useful life. Why so? Because I'm reasonably certain that I'm going to buy that. Okay, so if I'm reasonably certain, so I'll be depreciating it over useful life and not the lease term. Okay, so 10460 divided by 8 years is 1380 depreciation per year. Got it? So now you hmm. So how is all those positions gonna look like? For example, there's a Delta company. If they have non-current assets, so ROU asset would be net of accumulated depreciation as usual as per IAS 16, and liabilities, lease liability closing balance 7581, operating expenses as 1618, and finance cost at 861. Okay, these are depreciation charge, and this is finance cost. It adds up and is included in the closing lease liability. Eventually, the lease liability is going to be zero by the end of the lease term. Got it? Notice how the asset and liability values drift apart. The asset reduces straight line because of physical logic, and while the liability follows the amortized cost method, financial logic. That's why first we have opening balance, then we add, then we deduct the lease payment, and then we have the closing balance. Okay? Hmm. Now, what if there are advance payment or mid-year starts? See, the lease started on 1st July. So how am I going to calculate the ROU? And I paid an advance of 30,000 and installation cost of 10,000. And the lease liability. Lease liability present value of future lease payment. Okay. First payment was paid immediately. And for the rest, I'm having a PV of 91,119. Installation cost for 12,000 and interest rate is 12%. So how am I going to deal with this? 30,000 was it advance, although I've paid it. So that will form a part of ROU asset. What about the lease liability? Initial lease liability is 91,999. Okay. And I paid it immediately on 1st of Jan, 1st of July. Now, outstanding liability would become 6199. So what does that mean? From July to December, I'm going to incur a finance cost of 6 months. And then 6 months from Jan to June. 6 months. It's a presentation difference. If you look at it closely, what was happening? I was having a lease liability of 119. And then I made a payment. Okay. At that time, 30,000. So then how much was outstanding? 61,119. All right. So over that, although my reporting date is 31st December. And where am I standing? 1st July. So for that, I'll be
incurring interest of 6 months over this. Got it? So annual interest is also 7334, but interest expense to be recognized in profit and loss would be halved. That is 3667. All right. Watch the dates. Advance payments reduce the principal immediately, lowering the interest base. Okay. Always time apportion interest if the lease starts mid-year. Now comes sale and lease back. Okay. So before I explain this, let me just see, let's say, remember IFRS 15. When does a sale occur? When control is transferred. Okay. So if it's a sale, what does that mean in terms of sale and lease back? Let's say company A sold a building to company B. Okay. And leased it back. First, I sold to company B, which means I might have received money, right? Sold it to company B and then leased it back. So definitely, if I'm leasing it back, what's going to happen? Debit ROU asset because I have leased it back and it's a sale. Hmm? Credit the carrying amount because I have to remove. It's a sale. Credit some gain might have happened, right? And I have leased it back. So credit lease liability. This is exactly what the wholesale purpose is. When there's a sale, important point to note here is if it's a sale. If it is not a sale, remember IFRS 15, it's a financing arrangement. We'll consider this. When it's a sale, what are we going to do in terms of sale and lease back? Okay. Yeah. So see, in this scenario, hmm, asset had a carrying amount 640,000. Okay. In my books, it was 640,000. In the company's books, it was 640,000. And it was sold for 750,000, which is its okay. Now 750,000, which is its fair value. And the same asset was leased back. All right. For and having a lease liability of with a lease liability of 546,000. All right. This is the lease liability and this is the sale. So what's going to happen? See, I sold it for 750,000. Yeah, which is its fair value. And I had a carrying amount of 4. So don't you think out of this lease liability, I'm going to have ROU asset. How am I going to calculate this? So ROU asset is going to be basically lease liability divided by the fair value in proportion of the carrying amount. That gives me 465,920. Now, if you look at this ROU asset, out of this carrying amount, ROU asset is basically what I retained. Okay. So I have to book a gain in proportion to what I sold. Right? True and fair view. Agree? So this 465,920 is my ROU asset. What's the total gain? Total gain. If I look, the fair value is 750,000 and the carrying amount is 640,000. So I'm having a total gain of 110,000. Okay. So am I going to book this entire gain? No. Look at this logically. I have retained 465,920 out of 640,000. How much have, so this forms how much percentage? Recognize gain of this portion. Okay. So how much is left? 27.2% I have sold. So I can recognize a gain in relation to this. To 27.2%. Okay. So that gives me 29,920. So this is the wholesale logic. This is not this hard. This is so that you understand what's the exact logic behind applying sale and leaseback. So if I put in a journal entry, it would be pretty simple. What would the journal entry look like? Debit bank by, because I would receive the money of fair value of 750,000. Debit ROU asset. How much was it? Mm. 465,920, right? And credit machinery at carrying amount by 640,000. I also have a lease liability credit by 546,000. So what's the balancing figure? It's 29,220. So this is the gain that you will recognize with respect to the sale and leaseback transaction. All right. See, the asset value was 750,000. Right transferred, profit recognized for 27.2%, and we let go the lease liability portion. We did not recognize the profit for that. How come? The total potential gain was 110,000. The recognized gain is total gain into transferred right. That is 110 into 27.2, 29,220. It could be done in either way through the journal entry working. That is pretty simple. But this is for you so that you understand the logic. In a sale and leaseback, you cannot book the profit on the part of the asset you leased back. You retain the control through ROU asset. You only sold the rights transfer. Got it? First of all, identify. Summarizing IFRS 16, identify. Control over the use plus identified asset is a lease. Term. Economic incentive more than legal option. Include extensions if reasonably certain. Liability. Present value of future payments only. Unwind discount annually. Split current and non-current. Asset. Cost plus liability plus direct cost. Depreciate over useful life if owned or item. Owned or term. Exemption. Short term, 12 months, low value, like computers, tablets. Okay, there's an exemption. Okay, so that you have to expense it. Got it? Now we'll begin with foreign exchange. Let's take a scenario. Company A exports to USA and company A is in India. All right. Now the question is, now obviously US's currency is dollar and Indian we have rupees. So the payment that company A is going to receive would be in dollars. Although after conversion, they'll get it in rupees, but the core payment, the conversion rate would be at spot rate. Let's say right now, for simplicity, we'll keep it $1 equals to rupees 90. Okay. So if company A exports to USA and invoice says company B in US worth $10,000. Let's say there's a transaction. They sold goods in USA worth $10,000. So this $10,000 would be receivable. A, right? And they are receivable, which means they are monetary. We have discussed what is monetary and non-monetary item because company A has contractual right to receive this in cash worth $10,000. Now, definitely, I'm not. Company A is not going to keep the dollar at as it is. It is going to be converted into rupees. Okay. So they have invoiced it and sold goods worth $10,000. Now there's a delay in payment. All right. So when Nibe is an exporter, so let's say the dollar value jumps from 90 to 95 at the date of payment. So now how much company A is going to receive when converted? $10,000 into 95. That is 95,000. Okay. And 95,000 is received. And at the time of delivery of goods, I've satisfied my performance obligations. I've recognized revenue. So I've recorded the receivable at how much? At the rate of 90. $1 when $1 was 90 rupees. At that time, I recorded it as 90,000. Now, IS 21 bridges this gap of 5,000. I received 95,000 and I've recorded it at 90,000 and it is a monetary item. So I have 5,000 rupees worth of foreign exchange gain.
Got it? So this is what IS 23 is all about. Let's say I was an importer, so vice versa would happen. When the dollar strengthens, I would have lost. Got it? This is when I'm an exporter. I'm going to receive money from USA. Okay, so if dollar strengthens, I'm going to get more rupees. All right. See, global business is dynamic, but financial reporting requires consistency. The business context. Companies engage in foreign currencies through direct foreign transactions like buying, selling goods, and borrowing. Foreign operations subsidiaries operating in different economies. The accounting problem is exchange rates fluctuate constantly. Yeah, 90 to 95, creating two critical questions. At what exchange rate should a transaction be recorded? Usually at spot rate. Where should the resulting exchange gains or losses be recognized? That is where what IS 21 deals with. Foreign exchange. Okay. So IS 21 provides a mandatory framework to answer these questions. So when it comes to the currency in which the company deals with, there are two types of currency. One is functional currency and one is presentation currency. All right. The economic reality, the currency of prime economic environment, the currency of the primary economic environment in which the entity operates. It derives selling prices, cost, and cash flows. If that is not available, we can see the currency in which financing is done. Okay. So after considering all the questions, we will have functional currency. And based on that only, I will, contextualizing what foreign exchange gain I'm getting and what and not. And representation currency is basically me converting my functional currency into representation currency because I'm in India. Let's say, although I'm in India, I'll be required by law to show my financial statements in rupees. Okay, but my functional currency is dollars. So, an Indian entity with US operations may have a USD functional currency, but an INR representation currency. So, what I'll be doing, I'll be just retranslating my balance sheet and profit and loss account to presentation currency for reporting purposes. But my functional currency is dollars. Functional currency is determined by economic reality, not choice. Primary factors are currency influencing the selling prices of goods, services, currency influencing labor, material, and other costs. Secondary factors include, if primary is unclear, currency of financing activity, from where the debt and equity, in which currency the debt and equity comes in, currency in which operating receipts are retained. Once determined, the functional currency changes only if underlying economic environment changes. Got it? Functional currency could change if the underlying economic environment, the primary and the secondary factors change. Now comes monetary items and non-monetary items. Units of currency held an assets liability to be received or paid in a fixed number of units. I have a contractual right. Receive cash, receivables, payable loans. Okay, I know that I have $10,000 in my bank. I know that customer is going to pay me $15,000. Okay, so those become my monetary items. What are non-monetary? Absence of a right to receive or obligation to deliver a fixed number of units of currency, like inventory. Okay, so right now I can say that my machinery costed me $15,000. I'm depreciating it over a straight line basis, but I cannot say that when I sell the machinery, I'm going to receive XYZ amount of money. It's not certain. The question here is fixed number of unit. Do I have the contractual right to receive XYZ number of unit? No. Do not retranslate. So what's the core purpose of IS 20? If it's a monetary item, that I have to retranslate as per the closing spot rate. Okay. Retranslate at year end using closing rate. And if it's a non-monetary item like property, plant and equipment and machinery, do not translate, stay at historical cost. How do we initially recognize this? At the transaction date, record using the spot exchange. For example, it could be $1 equal to rupees 90. That could be the spot exchange rate, and the subsequent changes would be the spot rate of that time. Why so? Reasons reflect the economic value at the exact moment of the transaction occurred. Scope applies to purchases, sales, loans, and asset. An average rate like weekly, monthly is permitted only if exchange rates do not fluctuate significantly. Otherwise, you have to use the spot rates. Now comes an example of purchasing inventory. Okay, Aston buys goods from Mexico for 286,000 pesos. Okay, and right now I've been given the rate. My functional currency is dollar, and the spot rate at 24th, 5th of October is $1 equals to 11.16 pesos. If you can see, I get more pesos in $1. So if let's say I'm dealing with this amount, so definitely my dollar amount would be less, which means I have to divide. Think of it logically. I get more pesos in $1. So simply at the transaction date, in terms of dollar, how much would I have? 286,000 pesos divided by 11.6. That gives me 25,627. All right. This is at the transaction date. Now comes settlement. See, at the transaction date, I will record debit purchases as 25,670 and credit trade payables as 25,6. Now comes settlement. Aston pays the supplier. Rate now is 10.87. So what has happened? If you can see, I paid the suppliers, I'm going to pay him 286,000. Okay. So initially I recorded trade payable at how much? This was the trade payable. Trade payable is monetary. Okay. But at the date of settlement on 16th of November, when I actually paid him, the rate was 10.87, which means pesos has strengthened. Okay. So I have to put in a little bit more dollars, right? First it was 11.6, so it was easier for me to get more pesos in dollars. Now it has shrunk. It has shrunk to 10.87, which means I have to pay more dollars to get more pesos. Okay. So I have booked the liability by 25,627. But I paid how much? If you can see, 286,000 divided by 10.87. That gives me 26,311. This is how much I paid. So I'm bearing an exchange loss of 684. What about the inventory? Inventory is a non-monetary item. So action none remains at historical cost of 25,600. But what if I did not settle at 16th November? The trade payable was still outstanding at reporting date. What would have happened? Retranslate to closing rate. What was my opening rate? 11.2 as 625. Original value was 25,627 as per the spot rate at that time. But what's the rate at 31st December? 11.02. So as per that rate, I'm having my closing liability as 25,853. All right. So difference is $326. Liability has increased. So exchange loss and credit trade payables. So this is how monetary items are dealt with when it comes to recognition. If it's a monetary item, you have to retranslate if it's not settled. In this case, it was settled. Okay. So I booked my exchange loss and then credited. So see, I credited cash with an increased number. Why so? Because I bore a loss of $684 on that transaction. Let's see about loans. Warrior received a loan of Australian dollars 1.52 million unpaid at year end. Okay. So at the start, $1 got me 1.52 Australian dollars. So definitely in terms of dollar, the figure is going to be small. And the value is 1 million worth of loan. See, if I divide 1.52 million Australian dollars by 1.52, because that's the rate, I'm going to get $1 million in terms of dollar. But at 31st December, $1 got me 1.66 Australian dollars. So I have to pay, right? It's a loan in Australian dollars. So I have to pay in Australian dollars. So if before it was 1.52, now it has become 1.66 Australian dollars in $1. So in a way, Australian dollar has weakened. I can get more Australian dollars for one. So which means right now, if I convert that 1.52 million by the rate of 1.66, I get $916,000. All right. So what does that mean? My liability has reduced. Now, if I want to repay the loan, I'll change it. I'll convert at the exchange rate. I have to pay 916,000. Okay. So debit loan liability 84,000 and credit exchange gain. This is a gain and it's a monetary item. And if I haven't paid, I have to retranslate it. Got it? Now comes financial assets at fair value. FVOCI. If you remember, financial instrument based on the intention of what I want to do with the asset. If I want to, hold it for capital appreciation, but sell it when there's a good opportunity. In that case, we classified it at FVOCI, fair value through other comprehensive income. Okay. In that case, how am I going to deal with this? So there are going to be fair value changes and there is going to be an exchange gain. For example, see, I purchased an asset, a financial asset that costed me 10 million euros. Okay. And at that time, $1 gets me 1.2 euros. Okay. So the asset cost is 10 million euros. And at year end, the fair value is 12 million. At the year end, $1 gets me 1.25. So dollar is the bigger currency here. So the figures would be less. I mean, would be in a smaller number when it comes to conversion in dollar. So what was my original value at 1.2? When $1 got me 1.2 euros. If the asset cost is 10 million euros at 1.2, my original value stood at 8.33 million. Now, if you look at year-end fair value has moved to 12 million euros. And if I convert that to 9.6 million, so exchange component is monetary aspect. Like calculation is 8 million versus original. Look at this carefully. At year end, if I convert my investment, I'm getting 9.6 million. All right. Now, if you remember, I have to convert my monetary asset and retranslate it. So this $9.6 million, it is by converting it. Okay. But if I follow through this 10 million worth of cost that I bear, if I convert that using now the spot rate that is at year end, that is 1.25, I get 8 million. And the original cost was 8.33. See, we calculated here. So in terms of asset, this this is a foreign exchange loss. All right. And the remaining component, 9.6 value, the 1.6 million gain.
that goes to OCI. I'll explain it once again. See, I purchased the asset at the rate when it was 1.2 million. So at that time, I would have booked 8.33 million in terms of dollars because the rate was 1.2 million. Now, what does IS 21 require? Retranslation of monetary items. So at the year end, the fair value was 1.25. So based on that, I get a dollar value of 9.6. Okay. Now I have to compare it with cost so that I can separate what is the foreign exchange part and what is this. So if I compare with the cost of euro 10 million now at 1.25, I'm gonna get a cost of 8 million. Okay. And originally I paid how much? 8.33. Okay. So in terms of cost, I'm having a loss. That's a foreign exchange. And then when I compare this cost of 8 million to now's rate of 9.6 million, this 1.6 million gain goes to OCI because it is FET OCI. Got it? So FET PL gain to foreign exchange goes to profit and loss. FET OCI foreign exchange profit and loss goes to profit and loss, and the fair value changes goes to OCI. Okay, and PPE revaluation, both foreign exchange and the increase goes to OCI. Now comes advance consideration rule for prepayment. Payment date is translated at spot rate, recognize prepayment asset. Year end prepayment is a non-monetary item. Prepayment, let's say I get a gym membership. Okay, so I prepaid for the gym membership. Let's say, for example, $5,000. Okay, to the gym owner. So for the gym owner, it's gonna be a prepayment. He's gonna record a deferred liability. But in that case, prepayment is a non-monetary item. So do not retranslate. Delivery date, derecognize prepayment, capitalize the asset as historical. Similarly, uh, revenue recognition stuff. Exchange rate is fixed at the date of cash flow. I gave him 5,000. He will record it at 5,000. Okay. Let's say I'm traveling. I had dollars. I was traveling to other country. I made a prepayment of gym membership. He's gonna record at that value. It is not going to be retranslated as monetary items. See, underlying transaction, trading items, payable, receivable, P&L classification, operating profit, borrowings, finance cost, investment, investing activity. If a non-monetary item is measured at fair value, like PP revaluation, the exchange component follows the fair value goes along, that is into OCI. So let's say I have a revaluation gain. Okay, so when I compare it with cost, I'll have a foreign exchange gain. Both will flow into OCI. Got it? What are we required to disclose? Net exchange differences, OCI impacts, functional currency, and changes. If the functional currency has changed, the entity must disclose the fact that and the reason for change. All right. So now this was it for IS 21. Okay. We have one left. Okay. This is just a summary. First, we have to determine functional currency, classify the item as monetary, cash debt, then retranslate at closing rate. And if it's a non-monetary, stop, keep at historical cost, spot rate at transaction. Okay. And at settlement, calculate the difference between booked liability and cash paid. Got it? And everything goes to P&L. Now we'll begin with IAS 33. That is earnings per share. what happens is we get a net profit. Okay, let's say $20,000, for example. Hmm. And let's say I deduct preference dividend of 5,000, 15,000. Okay, so what does this mean? Can I say this? Yeah. So let's say in the company, there's a $15,000 and there are 100,000 ordinary shares. So I'm gonna get $0.15 as earning per share. So what does this mean? Basically, this is 15 cents. What does this mean? For each and every share, you earn 0.15 cent based on the profit that is attributable to ordinary shareholders. Why is this important? Why the presentation of earning per share is important? Because of the lot of valuation matrices that it uses. Let's say higher EPS would result to higher PE ratio, price earning. Okay, so that is what follows the backbone of valuation. All those are interconnected. So basically, the shareholders want to know for one share how much am I earning. So that is where IS 33 earnings per share steps in. So there are a lot of conditions as well, like there are bonus issue, a right issue, dilutive. All right, all those combined to form earning per share. You have to make an account for everything, and also in some instances, you have to also retranslate prior year's earning per share to improve comparability. Okay, see the problem. Entity A earns $10 million worth of profit, and entity B earns $5 million worth of profit. Okay, so on the face of it, it might look like that entity A is performing really well. But if you look closely, entity A has 1,000 shares in issue. So this 10 million profit would be divided further into this 1,000 shares. But if you look closely, the entity B has only 100 shares. So entity B has higher efficiency per share. 50,000 EPS. And in this case, it is only 10,000. Okay. So an absolute profit figure of is misleading without knowing the capital employed to generate it. So in this case, entity B is pretty efficient because it has a very lower shareholders base. EPS answers the critical question how much profit is earned for each ordinary share. It acts as the great equalizer, allowing comparability between different years and companies of vastly different sizes. All right. So, what's the golden rule and scope of IS 33? It definitely applies to the companies who are listed because it's earning per share. Entities whose share debts are publicly traded or parents of groups presenting EPS. So what's the formula? Profit attributable to ordinary shareholders divided by weighted average number of ordinary shares. Weighted average is really important. That we'll discuss further. Numerated starts with reported profit. Deduct preference dividend. That is equity classified. Deduct profit attributable to non-controlling interest. That is for group. And we have to ignore dividends on liability classified shares. Already that's an interest. expense. Reporting requirement. EPS must be presented for both continuing operations and total profit to indicate sustainable earnings. Now comes the weighted average shares part. See, what happens is during a year, it's not like the same number of shares are going to stay. Let's say in between the year, mid of the year, the company issues 200,000 equity shares. So was that particular finance available? Finance in the sense, was that particular capital available during the first 6 years? No. So I have time apportioned for the capital availability. It was available after 6 years. So I have to time apportion everything and get a weighted average number of shares for proper EPS calculation. The logic shares are included in the calculation from the date they generate resources. Okay. And if shares are issued at market value, the company receives cash and profit potential increases. Therefore, we must time apportion this share. For example, a company has a reporting date of 31st March. On 1st April, they already had 400,000 shares. But on 1st of October, mid of the year, they issued 60,000 new shares. Okay. Now, if you can see, I was standing with 400,000 shares during the year. All right. But after that, I was having 460,000 shares in total. All right. So what does that mean? 400 shares would be time opposition for 6 months and 460,000 would be time opposition for 6 months. So that gives me a total of 430,000 shares. And this is what I would be using it as a base for my EPS calculation. Okay. So total time average weight would be 430,000. So basic EPS is, let's say company earns a profit of 475,57,000. So I'm having weighted average number. Now you might be asking that why not 460,000? It's all about when the resources were available. 60,000 shares were issued mid of the year. So resources were available for 6 months. So 400,000 of capital base, 400,000 shares for the first 6 months. That was the capital base. And after that, the company was having the resources of 460,000 shares. 6 months with 400,000 and 6 months with 460,000. So that is how it is calculated. So I'll be dividing it by 430,000 number of shares. So that gives me 13.3 cents. All right. Now comes bonus issue. Oh, let's say company issues a bonus share. So the question arises, has the company received any resources in return of this share issue? No. What's increasing? Only the number of shares are increasing. Let's say company offers one bonus share for every 2 shares held. All right. So what does this mean? So the people, the shareholders who are having 2 shares now will be having 3 shares in total. Okay. So has the company received any money in this issue? No. Only the number of shares have increased. So it does not matter. I have to account for this share throughout the year because it's a bonus issue. See, a bonus issue increases shares without increasing resources. I have not received any money. To prevent an artificial drop in earnings per share, we use a retrospective adjustment, the time machine. What is retrospective? Throughout the year, I'll calculate the EPS based on the total number of shares after the bonus issue. All right. Now, let's take, for example, a company. It has 20x on profit as 130,000. On 1st October, it issued a bonus share for 2 for 1. For anyone having 1 share will be getting 2 shares. Okay. So that basically means right now the opening shares were 200,000 and they'll get 2 shares for each and every share set. So how many new shares were issued? 400,000.
new shares, new bonus shares, but there was no capital injection. It is a bonus issue. So my closing shares would be 600,000. Now I will calculate EPS taking 600,000 shares as a base. So bonus fraction. What's my bonus fraction? For each what happens is that company issues bonus shares. Okay. So let's say in this case, a company issues 2 new bonus shares for 1 old. So total, they're going to have 3 shares for every 1 shares held. So 3/1 is going to be my bonus fraction. Okay. So based on that, if I divide the multiply 200,000 with the bonus factor, I'm going to get 600,000 total number of shares. Now I'll be calculating EPS for the year based on 600,000. And what was my profit? 130,000. Okay. So based on that, my current year profit would be 21.7 cents because 130,000 divided by 600. Okay. So that get me $0.21. That is basically 21.7 cents. Now I have to also reinstate prior year's EPS. So there's a simple way of doing that. I have calculated the bonus factor. I just have to reinverse. What was my bonus factor? 3/1. So when I inverse it, it becomes 1/3. And what was previous year's EPS? 40 cents. If I multiply it by that becomes 13.3 cents because um, there has been an issue of 400,000 shares. So that is basically retrospective adjustment. As if 600,000 shares were always there. Okay. Now comes the right issue. So for bonus issue, it was like that I issued an entire free shares. I was not getting, the company was not getting any resources in return for that. So there's another concept of right issue. What is right issue? You'll get some compensation, some consideration in issue of share, but that won't be at market value. So let's say the market value is $5 and there's a right issue of $4 for the existing shareholders. So don't you think this $1 is a bonus? Yes, this is a bonus. So in case of right issue, this is very important that you have bonus fraction. How is that calculated? Using TERP, theoretical X rights price. How are we going to deal with that? We'll just look. So there's a market element, cash received treated as market issue, time apportioned. And bonus element, discount provided treated as bonus issue, retrospective adjustment. So for example, to separate these elements, we calculate the theoretical X right price. For example, London company issued 1 for 5. I mean, those who hold 5 shares in the company will get 1 right issue to subscribe at 0.9 and the market value is $1. Okay, they will get the right to subscribe at 0.9 and the market value is 1. So first of all, I have to calculate theoretical X right price. It's very simple. 5 shares I will be holding at $1 because that's the market value, and 1 share I'll be subscribing that is of value 0.9. So that gets me a total of $5.9, and I eventually would have 6 shares. So TERP would become 0.9833. Okay. So the bonus fraction is basically the market value, that is the fair value, upon TERP. And how much is the TVRP? 1 upon 0.9833. So this is what I am going to use for bonus. And the company issued this at March. Okay. April 1. All right. And the company has a reporting period of 31st December. So from 1st January to the date of issue, that is April 1, I'm having 3 months, right?
So for that, the opening balance is, first I had, let's say, 1 million shares. This is the opening balance. Okay. So I have to retrospectively adjust for the bonus fraction. And I have calculated the bonus fraction as 1 upon 0.9833. Okay. Why? Because that's bonus part. I have to retrospectively adjust that. So I'll be having, and time apportion, why? Because it was for 3 months. And after the 3 months issue, I have issued the right shares. So how? It was how much? 5 for 1. So that basically means 1 million shares. People will get 1 share for every 5 shares held. So that gives me a 200,000 new shares to be issued. And that were issued after third month. So after 1st of April, after 31st March, after 3 months have passed, the total number of shares in the company would become 1.2 billion. Why am I adjusting with the bonus fraction? Because it needs to be adjusted retrospectively. This is the bonus portion. Okay. So when the shares are issued, then I'll not be using the bonus factor. So I'll be getting weighted average denominator as 1.154237. This I will be using as a base to calculate EPS. Got it? Now what happens if there are multiple issues? See, there are opening shares from Jan to Feb, and there is a bonus issue. So apply bonus factor and apply time weight. And then there is new issue from March to July. Same, apply bonus factor and apply time weight. Post bonus, August to December. This I am talking about market issue. Okay, from March to July, or rights issue. See, bonus factor up until the point till all the shares are not issued for bonus factor and post bonus. First of all, we have rights issue and normal market issue. So when the right issue has happened, after that we stop using the bonus factor. Okay, and use the total number of shares available. Diluted EPS. What is diluted EPS? By the word itself, you can see that something is getting diluted. All right. So what happens in a company? There are convertible debt. Okay. The debt that could be converted into equity options. All right. So what does that mean? Eventually, I'm going to lose some ownership. My ownership is going to get diluted. So this is where this scenario of diluted EPS comes in. Diluted earnings per share ask, what is the worst case scenario for shareholder value if all potential sales were released? Potential shares include convertible debt, interest becomes equity, and share options. Employees buy shares below market value. The prudence concept only include potential shares if they are dilutive, that reduce the EPS. If they increase EPS, ignore them. Just simple prudence concept. Now, just give one example. Let's say it is 1st of January. I already have shares in issue of dollar. Number of shares include shares in issues 1 million. Okay. And profit for the year is $200,000. All right. Now, At 31st March, company issues $200,000 6% convertible bonds. All right, these have been accounted. So the terms of conversion are 100 shares for dollar, it's a $100 per note if within 5 years, and 110 shares if after per $100 if after 5 years. So for the calculation of dilution, I have to, consider the worst case scenario. If I consider this 110 shares for how many shares I have to issue? 220,000 shares. Okay, this is the worst case scenario. Now, what is going to happen? Hmm. And I have issued this on 31st March. What does that mean? So basically 110 divided by 100 and the 200,000, and that is for 9 by 12. Why so? Because I have issued it on March. Okay, so 9 months are remaining till the reporting date. So I'll be time apportionating it. So based on that, I am going to issue 165,000 new shares. But if you look at this carefully, this is a convertible bond. Now, what's going to happen if these are converted? So I will no longer be having debt. Okay, which means my profit is going to increase slightly based on the interest that I'm not paying. So first I have to account for that as well. So what is the normal profit? 200,000, right? 200,000 is the normal profit. Now, if I consider this element of interest, how much interest do I have to pay? Here, interest element on debt is dollar 11,730. This is as per IFRS 9. Okay, so we are using the effective interest rate now. But now, if I consider this 11,370, I have to reduce it to post tax. All right, the tax rate is 30%. So that means 11,370 into 0.7, basically 1 minus 30%. That gives me 11,730. This is Okay, so that basically gives me 8211. This is what? This is the interest that I saved. Interest that I saved because I no longer have to pay. They have been converted into equity shares. So 8211 is what I saved, which means I can add that back to the profit. How much was the profit? 200,000. All right. So I am getting 8211 as an increase in earnings because of the interest savings. Okay. Yeah. This is 8211. This is interest savings. All right. Now, what my profit becomes? 208211. All right. But at the same time, I have also increased the number of shares. What are my number of shares now? 165. I already had 1 million shares and 165 additional. So 165,000 shares. So that gets me 17.87 cents as earning per share. Now I have to calculate what was the basic EPS. If not accounting for the dilutive earning, basic EPS would have been simple 200,000 divided by the same number of shares. How much it was? 1 million. So that basically means 20 cents, right? So if you can see, these are called dilutive. If these are converted, EPS is going to fall because of the additional number of shares issued. That's what is explained. This was the interest element. I multiplied it by the net of tax. I am savings 8211, but at the same time, so adjusted earnings would be 20811. Now, basic shares are 1 million plus potential shares on conversion. I've calculated that as 165. So, adjusted share would stand at 1165. So, diluted EPS would be 17.9 cents. Okay. Now comes share options. What if someone has an option to buy at a lower rate than the market? Definitely he's going to exercise it and we have to still issue the share. So, for example, there are 200,000 options at 6 and the market price, one company has an option to purchase other company shares at $6 and the market price right now is $8. So, what's going to happen in this case? Now, the company has to issue, will receive a consideration, but the company has to give out 200,000 shares. Okay. So, if you can see, how much proceeds am I getting? 200,000 shares. Okay. And I have the option to purchase at $6. So I'm going to give 1.2 million to the company. And company is going to give me 200,000 shares. Now, let's just say for the same amount of consideration, that is 1.2 million. If the company issued that at market price, how many shares would the company need to issue? Only 150,000 shares. But in actuality, because of the option to buy, the company issued 200,000 shares. So this 50,000 shares, these are free shares issued by the company because of the option. So what am I going to do with this 50,000? For the rest 150,000, I have received the appropriate amount of money. I have received 1.2 million. Okay. The concern is with the 50,000 that is free share. So I will account it by adding it to the opening balance. Okay. So let's say I had 1 million shares in issue in the opening, and after these options have been exercised, I'll just add this 50,000 more. Okay, more. apart from the shares issue, so that I can get a proper view how much it has been diluted. Find dilutive difference is 50,000. Okay, add 50,000 to denominator. Got it? Now there could be some instance, but by default, if you've been given in the question that there are convertibles, so by default, don't check whether they are dilutive or not. They are by default dilutive. But in some cases, if the EPS increases significantly, okay, so that it is more than the basic EPS, but it won't happen in that much. But if in a case the interest saved is so much that the EPS increase that it surpass the basic EPS. So that's called anti-dilutive. So you don't have to account for that. For example, for bond one, individual EPS was 35.3 cents. Basic EPS benchmark was higher, so dilutive. Basic EPS benchmark was lower and individual EPS got to be 68.6. I mean, this was higher, so this is anti-dilutive. Diluted EPS is calculated using only the dilutive instruments to show the maximum possible reduction. In case 2, when they are anti-dilutive, you do not account for that. Bond 1, this case is for because of the prudence concept. Now, EPS as performance measure. If you look at the absolute view, just compare the profits. Year 1 profit has been 10,000 and year 2 profit has been 19,000. Plus 90% profit nearby doubled. But if you look at the calculations, the EPS calculations, definitely if the I've made investment in the company has bought more assets and then only they were able to generate profit. Okay. So year 1, when I earned $10,000, my EPS was 0.1. But after I issued a number of shares, I got some investment. And then though I reached to 19,000, but my EPS felt slightly. So efficiently, we have declined. Although profit increased, the new capital introduced did not generate proportionate earnings. The efficiency of shareholder investment has declined. Okay, so that is important from investors' perspective. What should we disclose in case of earnings per share? Statement of profit and loss, basic and diluted earnings per share should shown with equal prominence, presented for continuing operations and total profit, reconciliation of numerator, reconciliation of denominator, and disclosure of any potential dilutive instruments. And what is the limitation? It is a historical measure, heavily affected by accounting policy choices. If profit is higher because of revaluation, so on and so forth, it's gonna be misleading. Ignores future investment requirements. EPS is a powerful lens for viewing efficiency, but it's not one dimension of company's total performance story. All right. So let's just do some questions, MCQ questions for this sessions. All right. Okay. Hmm. On 31st March, DT received an order from a new customer, XX, for products with a sales value of $900,000. Okay, received an order, and XX enclosed a deposit with the order of 90,000. Okay, he has made an advance payment. On 31st March, DT had not obtained credit references of XX and has not determined if it will meet its order. So DT is not sure whether he will be able to satisfy the performance obligation. Which two of the following indicate how DT should record this transaction in its financial statements for the year ended 31st March? Okay, let's see. Include 900,000? Nah. Why should we include? We have not received completed the performance obligation, and we are not sure we can be able to. um, we have not even received the credit references. So, which means mm, the chances of probable out probable inflow are not there. Okay, include 90,000. the 90,000 deposit as revenue? No, I cannot record it as revenue. Okay, why so? Because I have not delivered the performance obligation related to that particular thing. I'd record it as deferred income or deferred liability if I am supposed to be carrying out with the operation. So this is also not included. Do not include any amount in revenue for the year. Yeah, sounds good. Recognize a trade receivable for 8-10,000. No. Why so? Because I have not completed the performance obligation. Create a contract liability for 90,000. Yes, because I have received money, but I have not yet performed. So C and E are correct. Got it? Tell me. See, on April 1st, 2023, Jolly Tar negotiated a contract with Sandy Beach to provide it with 100 units of raw materials per month for 6 months. All right. The contract price was $2,000, which Jolly Tar invoiced to Sandy Beach at the start of the year. So this is my price, total contract price, right? 2,000. Now, Sandy Beach can claim a 5% prompt payment discount if the invoice is paid within 30 days, and based on past experience, it is highly likely to do so. So what amount of revenue will be included in profit and loss clause for the year ended 30 June 2023 in respect of this transaction? Now, if you look at this carefully, this was for 6 months. Okay. So what does that mean? And the contract price was 600. Now, it was since April, and then it was from April. We've been asked about June. So April, May, and June, 3 months. All right. So if we look at this, if I divide 2,000 by 6, so it would be over a period of time, right? For 6 months. So 200 divided by 6, as and when I satisfy performance obligation. So I'll get 3,333. Okay, that's for 1 month. So how many months have passed? 3 months, 999, almost 100,000. And it's 99.99. This is the return. So that's basically 1,000. And Sandy Beach can claim a 5% prompt payment. Okay. So what does IFRS 15 says? Ki whatever is expected to be received. Now it has been a past practice that they are going to make a prompt payment. So they are going to get that discount. So if I discount 5%, how much am I going to get? 950. So A is the right answer. Okay. Got it? Are we clear? See. Repro, a company which sells photocopying equipment, has prepared its draft financial statements for the year ended 30 September 2024. All right. It has included the following transaction in revenue at the stated amounts below. Which of this would be included in revenue? All right. Agency sales of 250,000 on which Repro is entitled to a commission. No, this won't be included. Sales proceeds of 20,000 for motor vehicle no longer required by Repro. This is an asset disposal. Okay. Sales of 150,000 on 30 September 2024. This amount invoiced to and received from the customer was 180,000. Okay. Which includes 30,000 for ongoing service work to be done over the next 2 years.
Okay, this looks fine. Sales of 200,000 on October 1st to a customer who has stated they hope to be able to pay in full before the end. Now, their hope, okay, there's no probability, probable cash flow. So, C is the right answer. This should be included, okay, by the end of 20x5. So very less probability. I cannot be sure. Should I be recognizing revenue? I should be probable enough that economic inflows are going to be there. So C is the right answer. See, a lessee is required to recognize the ROU asset initially at cost, which two of the following amounts will be included in the initial cost. See, the amount of the lease liability. Yeah, definitely. Total interest expense over the period of the. No, that's a lease liability part. Initial direct cost incurred by the lessor. Initial direct cost incurred by the lessee will be included, not the lessor. Okay. An estimated cost of dismantling the asset. Yes. So A and D is the right answer. Got it? ACCA leases a new machine. The interest rate implicit in the lease is 13% per annum. All right. The initial amount recognized for the ROU asset is 1.75 million. And for the lease liability is 1.230. The lease is for 4 years and anchor is required to make 4 annual payments of 520,000 with the first payment due commencement of the lease agreement. Now the important thing to know here is lease liability is a PV of future payments only. Okay, so keep in mind with the first payment due on commencement of the lease agreement. Now, ACCA's policy is to depreciate similar machinery over 5 years on straight line basis. What is the total expense up to profit or loss for the first year of the lease? First of all, lease liability is 1.230. All right. And so that has a 13%. So that gives me 159,900, 159,900. All right. ACCA's policy is to depreciate similar machinery over 5 years, but the lease term is of 4 years. Okay. And there's no extension option. So I'll be depreciating it over the lease term. So what is the ROU asset? 1.75 million. That gives me 437,500 per year depreciation. Okay. So the total cost comes around to be 597,400 in the PNL. Okay. So this is an interest cost, financing component, and this is depreciation, operating expense for the ROU asset. All right. I've depreciated it for 4 years because the lease term is for 4 years. So total would be 597,400. D is the right answer. All right. Z entered into a lease agreement on 1st November 20x2. The lease was for 5 years. The present value of the lease liability was 45,000. All right. And the interest rate implicit in the lease was 7%. The annual payment was 10,975 in arrears. Okay. What is the non-current lease liability? It's pretty simple. The present value was 45,000. Okay. So add 7% plus 7% gives me 48,150. And out of that, I will deduct the lease payment of 10,975. That gives me 37,175. 37,175. This is what I'm standing in year end. I want non-current lease liability at 1st October 31st October 20x3. All right. How much years have passed? 1 year has passed. So from this split, if I go on, the non-current liability part would be, this would become my opening liability. Plus I'll add 7% to this. 175 plus 7%. That gives me 39,777. 39,777. Once again, I'll make a lease payment of 10,975. So that gives me 28,802. So if you look at this carefully, the difference between these two would be my current liability. I'm standing with this balance, and the difference between these two I'm gonna pay in the next year, and this is what the balance would be left. So this eventually becomes my no non-current lease liability. Got it? Aqua has correctly calculated its basic earnings per share for the current year. Which two of the following items needs to be additionally considered when calculating diluted earnings per share? See, diluted earnings per share. A 145 rights issue equity shares during the year 1.2 when the market price. Okay, it's a right issue. Diluted. Potential shares. Keep in mind, the issue during the year of a convertible to equity share. Yes. The granting during the year of directors share option exercisable in 3 years' time. Worst case scenario, they're going to convert. So yes, equity shares issued during the year as a purchase consideration for the acquisition of the new. No. B and C, dilutive, we are concerned with. Got it? Now comes the functional currency of Fargon is currently the crown. Fargon has grown substantially and for the last 2 years ending 31st December 2026 has exported most of its goods with a large growth in dollar sales. Alright, more than 90% of its trade is now denominated in dollars. Okay, and as I mentioned in foreign currency, that the functional currency could change. Which of the following is correct in relation to the functional currency of Fargon as at 31st December 2026? You have been reported. See, it should be changed to dollar if underlying business conditions have changed. Seems right. It should be changed, no, not respectively. It remains the round because the functional currency does not change. It has changed. It remains the crown, but the presentation currency should be dollars. It doesn't make sense. A is the right answer. Okay, because underlying business conditions have changed. Now comes the last question. On 28 November, Patter purchased some goods for crown 220,000. On 17 December, Patter made a payment of crown 110. Alright? At 31st December, Patter's year end, all the goods remain in inventory and crown 110,000 still outstanding. So if you can see, 110,000 payable is monetary. Okay, what does that mean? That it needs to be retranslated. All right. So we'll look how to. And inventory is non-monetary, so no retranslation needed. Okay. So first of all, what is the exchange gain or loss? So on 28 November, when I booked the receivable, 220,000 divided by 5.5. It would have been $40,000. All right. This is my trade payable standing. And when I paid, how much did I pay? 110,000 and 17th of December. Okay. And at that time, the rate was 5.3. So that gives me $27.54. This is what I made. But if you look at it closely, how much? You see, how much would 110,000 cost me at the spot rate? 20,000 because it was 40. And when I made a payment for 27.54. So there I got a loss, okay, of 754. Now comes year end. Year end, I have a receivable left of, payable left of 110,000 and it is monetary. So I need retranslation. And at that time, 5.6 is the
spot rate. So that gives me 19,643. Okay, $19,643. This is what is outstanding. But when I compare it with cost, it was 20,000, right? Based on this rate, 5.5. So I am having a gain of 357. And if you look, when I paid, I got a foreign exchange loss of 754. So net I did incur a loss, but not at net effect of 754. It was 754 minus 357. Okay. So 398 net loss. The B is the right answer. Got it? Let's begin with IAS 12. All right. So before we begin, in your 12th standard, or let's say in your previous papers, you might have come up with this term, provision for tax. All right. And we have learned what is provision. Liability of uncertain timing and amount. All right. So what's going to happen is this is provision for tax. Simple. You got to the tax authorities. You calculated the tax amount and you made a provision for the probable outflow that's going to happen. Okay. So this is provision for tax. You deduct it and then you get net profit. Now the thing is, there are two things that we are dealing with. One is accounting profit and one is taxable profit. All right. What does accounting profit mean? First, you will get revenue. You would have deducted cost of goods sold, and then you would have arrived at gross profit. Simple. Less admin expenses. Less depreciation. Okay. So there's nothing wrong. You might be using straight line method. Let's say, for example, straight line method. So you will be deducting the depreciation accordingly. And then you'll have operating profit. And then over that, some finance cost, if any. And then profit before tax. Okay. And over that, I'll be deducting provision for tax. And then I get net profit. Okay. So this was the wholesale story of what is accounting profit. Now, you will be like, you will take a statement of profit and loss and go to the tax authorities. What they are going to check? Okay, I've got my profit. Okay, they are going to see that I have deducted depreciation. All right, at, for example, $25,000 as per straight line method. Okay, so there's nothing wrong. IAS 16 allows that. You're nothing wrong. But yeah, you've arrived at the profit as per the accounting standard and you've deducted depreciation at 25,000. All right. Now what's going to happen? Bank is going to review your finances. Okay, depreciation has been deducted at 25,000. Now the bank says that as per our will be allowing $50,000 as allowance for depreciation
That means you can deduct 50,000 in the first year, right? Bank says that you can, deduct this $50,000. Okay, so what's gonna happen? If bank is allowing me 25,000 worth of additional depreciation, my income is going to be low, which means I'm going to pay less taxes. It sounds very good, right? A very good deal. But future, I still have to pay taxes because at certain point after, as per the tax authorities, would be less depreciation. I would have to pay more taxes. Getting it? So this is the whole sole reason behind deferred tax. It is about timing differences. Am I going to be able to deduct these taxes, or the tax authority is going to charge me? Just look at this logically. We'll have one proper example for this so that it's more clear. Hmm. Let's say, for example, from the following information, prepare statement of profit and loss for 2 years. Accounting income before depreciation and tax. Before depreciation taxes to $50,000 and to $50,000. All right. So what does this mean? Is basically they have not deducted depreciation and tax over this, nothing else. As on first day of year one, company purchased a machinery for $18,000, on which depreciation is charged at 50% per annum. Okay, so company will be deducting 40,000 in year one and 40,000 in year two on straight line basis. As per tax law, 100% depreciation is allowed on such kind of asset in the year of purchase. So what does this mean? So they are going to deduct the entire 80,000 less. Okay, so my taxable profit, I'm talking about the taxable profit, would be less by 40,000. I would have already deducted 40,000 as per my normal standards, but it would be even more less because the tax authorities deducts 80,000. So that means net, I'm going to pay low taxes. Okay, based on my accounting income. If you will try to match the accounting income and the tax provision for tax that I've created, it won't match. It's not like you directly multiply the tax rate from the profit before tax and you get the taxable amount. No, it's not like that. Tax authority is going to review that, okay, depreciation is allowed this much, and over that, you will have taxable profit. And tax is always charged on taxable profit. So, how are we going to deal with this? So, accounting income is 250, 250. Yes, this is before depreciation. I will deduct depreciation. All right. 40 40 because straight line basis. So profit before tax I'll be having as 210,000 and 210,000. Yes. So what does that mean? This is my profit before tax. Now I'm going to get to the tax authorities to find my taxable profit. Calculation of current year tax provision. Profit before depreciation was 250. Now, see, depreciation as per tax law, they are going to deduct $80,000. All right, that is 100%. So my here account taxable profit would become 170,000 because tax authorities are going to deduct the entire 80,000 amount. So tax rate is 30%. So current year provision for tax is 51,000. All right. Now, if you look at the accounting income, 210,000. If I straight away multiply this by 30%, how much am I going to get? I'm going to get 63,000, right? But is this the case? My current year provision is not 63,000, right? It's not 63,000, it's 51,000. Why so? Because the tax authority deducted more depreciation. Okay? They said, please claim all the 80,000. But what does that mean? But I'm claiming 40,000 as per my accounting income. That means that, okay, you are going to pay less tax this year, but more tax in the future. We'll look into this. See, calculation of deferred tax. I'm having These are called temporary differences. If something is not allowed, we'll discuss this further. If something is not allowed as per the tax authority, we are straight away not going to consider that for deferred taxation. Like tax authorities, for example, do not allow penalties. So that won't be considered for the calculation of deferred tax. Okay, they are straight away disallowed. The opening temporary I didn't have. Now, what was the temporary difference arising? 80,000 by the tax authorities, 40,000 as per. So this is 40,000 and this is taxable. Then it's called taxable temporary difference because eventually I have to pay tax on this 40,000. That's why I'm gonna book it in my accounting profit in coming year. Okay. So what's this gonna mean? 40,000 into 30% is gonna get me 12,000. This is deferred tax liability. Listen to me very carefully. Why is this liability? Paying less tax now, but I have to pay more taxes in the future. Future obligation to pay more taxes. That's why more tax in the future. So that's why deferred tax liability. Now, this is deferred tax liability, 12,000. So now if you look at this movement, what's going to happen? This is taxable income, provision for tax. So if I deduct expenses that we have calculated at 51,000, how am I going to show this deferred tax liability? Debit P&L, it's a liability, and credit DTL, it's a deferred tax liability. That's why I'm debiting P&L and crediting DTL by 12,000. Okay. Now if you look at this, can you see 51 to it makes up 63,000? Yeah. Why is this happening? Because of the temporary differences. And then what's going to happen in the next year? I'm going to pay more tax. Definitely. I'm going to get to the tax authorities and say, I'm claiming this 40,000 depreciation. They're going to say, no, we provided you with the full allowance in year one, right? So we are going to disallow this time. But what did I do? I already had one deferred tax liability considering that scenario. So what does that mean? In year two, I'm going to reverse my deferred tax liability. So, okay, for less confusion, let's just calculate the year two taxable profit. What's going to happen in year two? Same, profit before depreciation is 250,000. Is the bank
going to allow me any depreciation in year two? No, because they have allowed all the depreciation in year one. So what does that mean? It's going to get me the same 250,000 as taxable profit. So if I multiply it by the rate, it's going to get me 75,000. But if you look at it, my profit before tax is 210,000. Okay. So even if I multiply, let's say, for example, this by 30%, once again, I'm going to get 63,000. Agree? Normal logic, what does it say? You have profit before tax, just multiply it by the tax rate, you'll get the tax payable, but it's not like that. But here I have paid a tax of 75,000. I've created a provision. Paid, it's the next thing, it'll get deducted. But assume that I've paid the tax of 75,000. So this 75,000 is what tax authorities charged me. And this is basically movement of deferred tax liability. Why so? Because after this asset is not going to be that, and I have to also make an adjustment. So this 12,000 is basically reversed. How it is reversed? Debit DTL and credit PNL. Okay. So that would be in plus. So net profit after tax would be same. Got it? So this is the PNL approach and the logic behind deferred taxation. All right. But ACCA suggests us to use the balance sheet approach. Now let's take one more example. From the following information, prepare statement of profit and loss. My accounting income is 100,000 and tax rate is 30%. Okay. During the year, company charged bonus expenses of $20,000 on the basis of accrual concept, but as per law, bonus expenses is allowed on payment basis. So what, as I was suggesting, I would have gone to the bank authorities and showed my income statement and deducted the 20,000 bonus there and there. Okay. And what bank authorities would have done? They would have disallowed this. They would say, okay, that's fine. We'll allow this. But when the bonus is paid. Okay. When the bonus is paid. So what does that mean? So I'll be thinking, okay, fine. They have disallowed me this time. But whenever I'm going to pay, I'm going to get the benefit of tax deduction. So logically, it makes sense that it will create deferred tax asset because I have to pay less tax in the future. Okay. In the current year, company did not make the payment of bonus. So how am my accounting income is going to look like? 100,000 less tax. So this is after deducting bonus, the accounting income I have arrived after deducting bonus as per the accrual concept, and that is fine. Okay. What the tax authorities would have done? See, they have disallowed my bonus. So that increases my taxable income by 120,000. And if the tax rate is 30%, I have to pay a tax of 36,000. So that's why current year provision is 36,000. But if you look at it carefully, this is deductible temporary differences because I'm going to get the benefit later on. How much is the deductible temporary differences? 20,000 is disallowed and 30% is the bank rate. So basically, I'm going to get a deduction of 6,000. Okay, I'm going to be getting a deduction on this, claiming this, and the tax rate is 30. I'm going to get a deduction of 6,000. So how's the journal entry going to look like? Because it's a deferred tax, debit deferred tax, and credit SPL. So in the current year, if you look at it carefully, I'm gonna reduce this, and eventually provision of tax would look like 30,000. The profit after tax 70,000. Got it? Hmm. Now take above example and assuming in year two accounting income is same 100,000. No bonus expenses charged in SPL. Bonus of $20,000 pertain to year one has been paid. What's that? What does that mean? That now I am eligible for that disallowance. I am eligible for that deduction. Okay, of $20,000. So what's how it is going to look like? I will get my 100,000 of accounting income. Okay. And the tax authority will say, okay, we will allow you 20,000 because you have paid it. So the my taxable profit would become 80,000.
See, 80,000. And over that, I'll be having 30%. I have to pay 30%. So current year provision would be 24,000. Okay. But now, though this hasn't claimed, okay, because I have received the deduction, I'll be reversing the deferred tax. How is that going to look like? Debit P&L and credit deferred tax asset. Okay, if I'm debiting PLL, that's going to increase with the current year provision. So the total provision for tax would come out to be $30,000, giving me profit after tax for $70,000. Okay, so this is the P&L approach and the logic behind why deferred tax exists. It is for it is for the temporary differences that arise because of the different profits. First is accounting profit and there is taxable profit. Okay. But the thing we discussed was the P&L approach. Now ACCA suggests us to use the balance sheet approach. What does that mean? Let's say there is an asset. It will be having an accounting base and a tax base. Hmm. So let's say my asset is valued at 120 and the tax base is 100. So what does that mean? I have to eventually the the tax authorities will deduct this, the 120 amount, which means if the carrying amount in case of an asset is more than the tax base, then it creates a deferred tax liability. Got it? See, the timing mismatched. Why the numbers diverge? Example, a machine costing rupees 10 lakh. I depreciated 1 lakh, 1 lakh, 1 lakh, 1 lakh on straight line. Now the tax allowance was this. So what does that mean? Just look at this. At year one, at the end of year one, what I'm trying to make you understand is the balance sheet approach. At the end of year one, my carrying amount would have been 9 lakh, and what the tax base would have been reducing to 7 lakh 50,000. So there's a taxable temporary difference here in this case of 1 lakh 50,000. Okay, this taxable difference into the tax rate, say 30%, would create a deferred tax liability because it is taxable temporary difference. Bank is going to charge me. If they are allowing more in this year, they're going to charge me. Okay. If we ignored this timing difference, the tax expense shown in the financial statement would look completely inconsistent with the accounting profit. Okay. Straight line expense 10 years and tax authorities use 25%. So that is why we do this. The current tax is the immediate reality. Current tax is the tax payable on taxable profit for the current year. This is calculated using tax laws, not accounting standards. It represents the cash obligation to the government. For example, there's the accounting profit, less tax adjustments. Taxable profit now became 8 lakh and the tax rate is 30%. So current tax expense would be 2 lakh 40,000. It won't match with the accounting profit that you are showing. That's why we have deferred tax asset and deferred tax liability. Okay. Under and over provision. Let's say you made a year one estimate, you made a provision for tax. Okay. But the actual tax paid was more. So that is basically under provision. Okay. So if you are under provision, so in year two, I am going to add it to the current year provision for tax in year two. Okay. So
For example, in year one, I estimated the tax to be paid to be 1 lakh, but actually it was 1,20,000. So in year twos, this was year one's, year two's SOPL, I'll be adding this 20,000 because it was under provision. And the reverse is true for over provision. I'll be deducting it from P&L. See, this is a change in estimate, so that's why it is dealt prospectively. Got it? Why exactly do we need deferred tax? Accelerated tax allowances mean we pay less tax now and more later. If we only report current tax, early profits looks artificially high. You see, if I'm getting more allowances as depreciation, my profit tax is going to be less and profit are going to look increased. So that's the problem. Early profits look artificially high, low tax expenses, and later profits look artificially low. Why so? High tax expense. The solution is deferred tax is an accounting adjustment. It recognizes the future tax consequences today, smoothing the timeline to match the accounting profit. Got it? So there are two types of differences, permanent differences and temporary differences. Like fines, exempt income, stop, do nothing, this never refers. Okay, and temporary differences like depreciation method, accrual versus cash, recognize deferred tax, these are timing differences. You're gonna get either you have to pay or you're gonna get the deduction. If you have to pay taxes, they are taxable temporary differences that create deferred tax liability. And if you're gonna receive the benefit, they are basically deductible temporary differences. Got it? Hmm. The balance sheet approach, that is what we are concerned with. IS 12 shifts focus from P&L to the balance sheet. The core question is if we recover the assets or settle the liabilities at their carrying amounts, recover, okay? What will be the tax consequences? That's why we have carrying amount. If the carrying amount is more than the tax base, we have DTL in case of an asset. So carrying amount minus tax base, temporary difference. It could be either taxable, and if it's taxable temporary difference, then DTL, deferred tax liability, and if it's deductible, then deferred tax asset. Got it? For example, non-current asset machine, carrying amount is 6 lakh, future tax deduction, I mean, on which I can deduct is 5 lakhs. Okay, so that is taxable temporary difference of 1 lakh. And whatever, let's say 30% is the tax rate that I am going to create 30,000 of deferred tax liability. Got it? Trade receivables, carrying amount is 1 lakh, tax base is 1 lakh. Okay, difference is zero, revenue is taxed on accrual, collecting cash has no new tax effect, so there's nothing to do. Interest receivable, okay, so interest receivable is taxed on received, right? So carrying amount is going to be 10,000 and tax base is zero because it is going to be taxed when received. So that is taxable temporary difference, revenue not yet taxed. When cash is received, it will be fully taxed. Got it? Provision, deductible on payment. So I'll be having a provision and tax base would be zero because it would be deductible on payment. Okay, so what does that mean? I'm having a carrying amount as 50,000 as my liability. So this deductible temporary difference. Okay, expense accrued now, but they are disallowed it. What's I'm gonna do? I'm gonna deduct 50,000. I'm gonna get to the bank authorities and they're gonna say we are disallowing it. Whenever you pay this, then we are going to allow it. So at that time, my taxable profit would increase and the profits would be distorted because of that. So to smooth those, we have this timing differences. So this is deductible temporary difference or deferred tax asset. Simple. If there's an asset, if you want to remember it, but I won't suggest it. But still, if you want to remember it, if it's an asset,
assets carrying amount is more than the tax base, then it is deferred tax liability. And in other case, if liabilities carrying amount is more than tax base, it's usually deferred tax asset, deductible temporary, and this is taxable temporary difference. See, look at provision. It's a liability. My carrying amount is 50,000. It is more than the tax base. Okay, so that means it is going to get me a deductible taxable temporary difference. So that is deferred tax asset. If assets carrying amount is less than the tax base, not a situation usually, but still, if assets carrying amount is less than the tax base, then deferred tax asset. If it is deductible temporary difference. And if liabilities carrying amount is less than tax base, it is deferred tax liability. That is taxable temporary difference. Simple, if it leads to future tax payable, liability leads to future tax savings, then it's an asset. See, this liability, it will get me the tax benefit when I pay the provision. Okay, future tax saving, deferred tax asset. Got it? So, what are the rules of recognition? A tax reduction is useless if the company never makes a profit to deduct it against. Therefore, we only recognize the deferred tax asset if future profits are probable. Okay? See, what happens is there are ongoing losses. So, because of that, what the company does is they create deferred tax asset. Okay? Because of the ongoing losses. But they can record the deferred tax asset only when future profits are probable, so that they can reverse it. See, tax deduction is useless if the company never makes a profit to deduct it against. Therefore, we only recognize a deferred tax asset if future profits are probable. Okay. That is basically carry forward or tax loss. Tax law allows losses to offset future profits. However, IS 12 assumes past losses indicate a lack of future profit. You must have convincing evidence of future income to book this asset. If you want to book a deferred tax asset because you think that it is going to benefit in the future in case of tax, you can do that. But if there's a tax loss of 1 lakh, company signs a profitable contract, then you, okay, which means company is going to be profitable. Then you can recognize 30,000 deferred tax asset. Okay. But company continues to make losses, do not recognize a deferred tax asset. Okay. Revaluation of assets. See, since the revaluation gain is recorded in OCI, the resulting deferred tax liability is also charged to OCI, not the profit and loss statement. What's going to happen? Definitely, let's say I was measuring the machinery at $1 million, then I revalued it to $1.5 million. What's going to happen? That 500,000 gain is going to get to OCI, and this is going to be my new carrying amount. Okay, and the tax base is still $1 million. So if you can see, my carrying amount, that is 1.5 million, is higher. So I'm having a taxable temporary difference of 500,000. Okay, let's say the tax rate is 30%. Okay, so this 500 into 30 is 150,000 is going to be attached to OCI as deferred tax liability, less 150,000. Got it? Face the same example. Original cost is 10. Now it has been revalued to 14 lakh. So the gain of 14 lakh goes to OCI, and then tax follows the transaction, and then deferred tax liability. How am I going to calculate the movement? So first calculate required closing balance. Compare with opening balance. The difference is the expense or credit for the year. Okay. So then I am going to have an opening balance. Movement through the year, that is P&L.
expense and required closing balance calculated via carrying amount versus trial balance. Okay. So the mid part is going to be a P&L expense. IS 12 act as a smoothing mechanism. Tax effects are recognized in the same period as the transaction. The balance sheet reveals future tax consequences. Without deferred tax, profit fluctuate artificially. That's the wholesale purpose. With it, the accounting world and tax world are reconciled. Got it? Okay. Okay, great. Now we'll begin with IFRS 9 financial instruments. Okay. Then we'll take a break and then finally cash flow statement. So tomorrow is going to be the last revision session. Only consolidation. Okay. IFRS 9 financial instruments. Getting back to this chart, you have an asset. One of the asset we classified as property, plant, and equipment. Non-monetary, having physical substance, so on and so forth, controlled by the entity. Okay, IS 16. And what happened? We also dealt with IAS 38, intangible asset, non-monetary, without physical substance, controlled by the entity. Hmm. We also had IS2 for inventory. And times I've mentioned about monetary and non-monetary. If I have monetary asset, which means I have contractual right to receive a set amount of cash. Okay. And always exempted IFRS 9. I mean, I said that this would be tilt under IFRS 9. What exactly is IFRS 9? Financial instrument. Oh, monetary asset. Yes. Financial instrument. We have financial asset, financial liability, and equity. If we look at the conceptual framework, equity is the residual interest in the net assets, basically after deducting all the liabilities. Okay, that's the equity. Financial liability, present obligation, probable economic outflow, and financial asset, monetary assets like cash, cash equivalents, equity instrument of other company. We'll discuss all of this in detail, but I'm just giving you a rough framework of what exactly is IFRS of other entity or debt instrument. I lended someone money. All right. Now, let's just take an example. let's say Mr. A had some savings. He had $40,000 saved, all right, and he took a loan of $80,000. Okay, now he has many plans with this given funds, $120,000. Okay, now he was a finance guy. He thought of many other factors and he kept on doing his math and all. And so from this $120,000, first he allocated to a debt instrument. Why? Because he thought that I will require a sum of 30,000 after 3 years. He was very certain about that. So he invested those $30,000 in a debt instrument. Okay. And what was his objective? To collect contractual cash flow. And the redemption amount. Just keep in mind what was his objective and the redemption amount. Okay. Now, he once again, out of this 120, he invested 30,000. He's left with $90,000. He once again invested other $30,000, same, with the debt instrument. Okay. But now, here, he's thinking, he intends to sell the asset, sell the debt instrument, or market traded basically bond when there's a good opportunity. Otherwise, collect contractual cash flow. All right. This was with the 30,000. And now we are left with 60,000 more. So 25,000 he invested in equity shares. But his intention here is to gain from the market ups and downs. He's risking this 25,000. Okay. So he has invested this from speculative purposes in the equity market. Okay. So now the remaining 35,000 he envisions in a startup. Okay. And he thinks that he's gonna stay invested in that particular startup for years and years to come. Okay. So he invested in the equity interest only. Okay. With a long-term vision. All right. Now, if you look at this, all the different scenarios carefully, in the first scenario of debt instrument of $30,000, he wants to collect contractual cash flow and then the redemption amount. So logically, I won't mind the fair value changes. Agree? So what's the logical step when I,
record this into my books of account at amortized cost. What exactly is amortized cost? I'll be accounting it as if I'm collecting all the contractual cash flow and effectively, earning the income using an effective rate of interest, and I'm collecting the contractual cash flow. And that is how I'm going to receive eventually after 3 years when the bond redemption date arrives. I'm going to receive the cash. Okay. So amortized cost method makes sense, right? That I should be accounting in that way. Now here, if you can see, he intends to sell the debt instrument when there is a good opportunity in the market. Otherwise, he'll collect contractual cash flow up until redemption. So here, I am concerned with the market. But logically, I'm only gonna sell it when there's a good opportunity. So unnecessarily booking the gains and losses in the P&L does not make sense. So what's the other route? OCI, other comprehensive income. Okay, so the users of the financial statements won't also be misled. Now let's talk about the third situation, equity shares. My whole and sole purpose is to be speculative and gain when there are markets up and down. Now, definitely, it's not going to be like I've invested in equity shares, I'm only going to gain. I'm also going to bear losses. So, to reflect that, it makes sense that I measure the fair value through profit and loss. Fair value through profit and loss. And now, this 35,000. I have envisioned in this company, I've invested and want to stay for the long term. Okay. So, I won't be mattering with the market ups and downs. So what does that mean? Same, fair value through other comprehensive income. But this is irrevocable. Okay? It cannot be recycled to fair value through profit and loss. It's a one-time decision that you have to make during the time of investment. Okay? So now does all this logically make sense? What are the intentions behind the investment? And if you can see, he also took a loan of $80,000. That becomes his financial liability. Got it? So this is what IFRS 9 financial instrument is all about. Got it? See, in the past, simple instruments, cash, trade receivable, trade payables, and bank loans, accounting was straightforward. Now we have convertible bonds, structured finance and derivative, complex preference shares. So measurement differences, cost, and realistic profit. So IS 32 deals with the identity, classification, and presentation, whether they are equity or liability. Okay, IFRS 9 deals with the treatment accounting, amortized cost, FATPL, all those. And IFRS 7, basically the disclosures. Okay. A contractual right to cash. A financial instrument is a contractual right, creates a financial asset. Listen to this very carefully. For one party and financial liability or equity instrument for other. Okay. So trade receivable, right to receive cash. Let's say I owe someone money. Mr. A owes Mr. B. Okay. So for Mr. A, it's a receivable, and for Mr. B, it's a payable. Mr. A has a contractual right to receive cash. So for Mr. A, it's a financial asset, and for Mr. B, it is financial liability. Debt securities are invested. Even equity interest in other entity also forms financial asset, and that will be equity for the company, definitely. And what is out of scope? Inventories IS2, property, plant, and equipment IS16, prepayments, right to services, income tax liability, statutory, not contractual. Got it? IS 32 that deals with the presentation, prioritizes economic substance over legal form. For example, the ordinary shares, the dividends are declared only at company discretion. So it makes sense to view that as equity. Okay. Redeemable preference shares must be redeemed for cash at a future date. Result liability. Substance is a debt. You have to redeem redeemable preference shares. You have to pay out cash. So, although on the balance sheet they are listed as preference shares, but in substance they are a debt. So they'll be presented accordingly. Mandatory dividend shares, dividends must be paid annually, result a liability. Okay. So any payment on liability is interest expense, dividends on equity is deduction from equity, not P&L. You know the statement of changes in equity. If dividend is declared and paid, it is deducted from that. Now comes compound instruments where debt and equity coexist. See, we'll do a proper question for this. But what happens is, let's say company A issues bond. So basic debt instrument for the subscriber, okay? For the company, it is a liability because company has just issued the loan bonds. Now the bond are convertible into equity instruments at the discretion of subscriber. I mean the bondholder. Okay. So what is going to happen? Let's say the market value for similar bonds is 8% market value. So all because the bondholders do have the option, they're going to say, okay, fine, we are okay with less interest rate. So these bonds are usually issued at a rate lower than the market value. Okay. So what's going to happen? What does IFRS 9 say? That you have to split at the inception. You're going to get the proceeds and you're going to have a present value of the liability portion. Now, to get things more clear, I'll just what happens in amortized cost method is you will have a liability, opening liability. Okay. And then you will be having an effective interest rate. Okay. And less you will be having the interest payment, contractual cash flow. And that will lead to your closing liability. Simple. Now you might ask why the effective interest rate is used. See what happens is, let's say you issue a bond for $100 at 6%. Okay. And it is redeemable at 110. So although you'll argue that 6% it's fine, I'll be incurring a cost of 6%, right? No. But this extra $10, this also needs to be spread, right? Among all these 3 years. So that's why there is an effective interest rate. Okay. Now you might ask, how is this calculated? So there is trial and error method, IRR. But for ACCA, you do have Excel for the professional papers, so you don't have to juggle up much. So that is basically what effective interest rate is. Now, just look at one proper question that deals with this. The compound instrument. See, an entity issued 2,000 convertible bonds with a face value of $1,000 each at par on 1st January 2017 at par.
Interest is payable annually in arrears at a nominal interest rate of 6%. This is where contractual cash flows will go with. Okay. At this date issue, the prevailing market rate of interest for similar non-convertible bond was 9%. Keep in mind, this is the market rate. Why this is less? Because the bondholders have an option to convert to equity. The present value of $1 receivable at each year end based on a discount rate of 6% and 9% is as follows. These are the discount factors given. What are we required to the amounts at which the convertible bond will be recognized in the financial statements on initial recognition, separating the liability and equity component and the carrying amount of the liability component at the end of first year of issue. Let's just see how to deal with this. What do we have? 2000 convertible bond of so 2 million would be the proceeds, right? Two thousand bonds of 1,000 each. That gives me $2 million, right? Now, see, I have to discount the liability portion at market rate. Why so? Because let's say if I discount it at 6%, there would be no equity portion. This needs to be done because the liability portion is basically what? The difference, okay, based on the market value and the bonds with no conversion option. So if I discount it at 9%, I'm going to be left with the equity portion. And that is what is required by IFRS 9. So how am I going to deal with this? What are going to be my cash flows for year 1, 2, 3? So on this 2 million, I am going to pay out. Okay. I'm calculating the liability portion, right? So what I'll be needing year 1, 2, 3 interest and the redemption amount. So in year 1, I'll be paying an interest of 12,000. Year 2 also 12,000. And year 3 also 12,000. Sorry, 120,000. Okay. And the bonds are redeemable at 31st December 2019. 20x7, 20x8, 20x9 after 3 years. So in year 3, I'll be making the full payment of 2 million as well. So for simplicity, what we can do is I want to discount it at market rate. Okay. So I can submit all the present values that comes out to be 2.531. Okay. Now this 2.531 is the cumulative discount factor and I want to discount the interest rate. So 120,000 that gives me 303,720. Okay. This is the present value of interest payment and present
value of redemption, basically 2 million into what's the discount rate at year 3? 0.722. So that gets me 1,444,000. 1.444,000. And if I add 303,720, this is the present value of interest payable. This is present value of redemption amount. That gives me a total of 174,720. Got it? Now this is the liability portion. All right. Now, if you can see, I have received proceeds of 2 million. And what is my liability portion? 1,747. So that gets me an equity portion of 252, 280. Got it? Okay, so this is how it would be split among the equity portion and the liability portion. Now, how are you going to get to? Okay, so there's a mistake. The present value of redemption is 772. Okay, so that gets me 1,544. 1,544,000. Okay, so that becomes 1,847. 1,847. So 152, 280 is the equity portion. Now, regarding this 1,847, how am I going to deal with this? This is at This will be dealt under amortized cost as usual because it's a liability portion. So I'll be adding the effective interest rate at 9%. Okay, so how much that is going to be? Plus 9%. 201, 230. 230. Less the contractual cash flow. How much is it? 120,000. All right. So that is going to get me a year-end liability of this is 720. Okay. Hmm. It's gonna get me a year-end liability of 1,894,015. Got it? So this was for compound instrument.
Hmm. There's one concept of treasury shares. What if the company buys back its own shares? What does that mean? So that is not an investment, okay? Because the company is basically buying out its own share. Okay, what could have happened? Let's say I've invested in the company and company offered me a buyback. So I would sell my share, and then the company's basically ownership will increase because they would have one cancelled out share. They have bought it back. So the concept is buying back own shares is not an investment, it's a rearrangement of ownership. The rules: cost is deducted directly from equity, no gain or loss is recognized in profit and loss. The reasoning prevents companies from manipulating profit by trading with themselves. So, the same. I've said, what is your intention? Okay, with the funds. So, from company's perspective, it's gonna look like that. If there's a financial asset, business model test. Is it to hold and collect? Hold to collect and sell when there's a good opportunity, or trading? So, if it's to hold and collect, so cash flow characteristics is solely payments of principal and interest. Are cash flows solely payments of principal and interest? Yes, then amortized cost. Yes, then FET OCI, and no, then FET PL. FET OCI, when there's a good opportunity, so you can sell the asset. You have the option. But amortized cost, you just want to collect till the redemption. That's why at amortized cost. Okay, so there's no effect in the PNL for fair value fluctuation. Got it? How is amortized cost? The lending model, example, bank loans and trade receivables. Criteria: hold to collect, cash flows, sold for principal and interest. Market value is irrelevant if the asset is held till maturity. That's why we have an opening balance. We add the effective interest, deduct the payments or interest receivable, could be both, and then we get a closing balance. Okay, so this is how amortized cost works. The fair value model. FET case, bonds held for liquidity but might be sold. Okay, so interest goes to PNL, and price change goes to OCI. But when the asset is sold, it is recycled. Okay, the gain is recycled. FETPL, the trading model. Use case: trading shares or complex derivatives. Its wholesale purpose is to get gain from the market. So any interest, price change, or dividend goes to profit and loss. The equity exception. An entity irrevocably can elect FETOCI for strategic equity. For this, gains losses are never recycled to PNL. Okay, it's a one-off decision. Effective interest rate reflects the economic reality, not just cash flow. Concept: interest expense must reflect the true economic cost, including premiums, discount, and transaction cost. For loans issued at discount, so cash interest it was 5%, but economic interest, why so? Because it was issued, let's say, at 95 and the face value is 100. Issued at 95, face value is 100, and would be redeemed at face value of 100. If you can see, on the face value, it earns an interest of 5%, but this discounted 5 needs to be spread, right? So that is basically effective interest rate. See, the difference between 8% and 8% expense and 5% payment is added to the carrying amount annually. That's what if amortization works, amortized cost works. Now comes expected credit losses. It won't be dealt that extensively in FR, but still, old model was to wait until the default event. Now IFRS 9 says you can predict future defaults immediately. For example, there's a provision matrix for trade receivable. The historical rate that they are going to default is 1%. So recognize small provision now. If any payable is overdue by 30 days, sorry, any receivable is overdue by 30 days, the chances become 3%. So increase the provision. 60 days overview, 10% significant provision. Prevents overstatement of assets by recognizing risk from day one. Now, derecognition, when instruments leave the books, financial liabilities removed when obligation is extinguished. Note substantial modification of terms, derecognition of whole liability with recognition of new one. Financial assets, when rights to receive cash or cash flows expire or risk rewards are transferred. The recourse trap. If sold with recourse, seller keeps the risk, the asset remains on the balance sheet. So there are two instances. Let's say you have a lot of receivables. Okay. And there's a third party. So you can with recourse and without recourse. So what you can do is contact a third party and say that these are my receivables, please collect some. So they'll have a commission or it'll be some kind of setting. But yeah, if you have receivables and you made an arrangement with a third party with recourse, that collect payments on our behalf. But the risk and rewards have not been transferred. If the defaulter remains, then it is my responsibility. Okay. So if it is with recourse, if it's coming back to me only, so I do not have to de-recognize that asset. But if it's without recourse, if he takes all the responsibility, all the risk and rewards, then I can de-recognize the asset in that case. IFRS 9 is disclosure and it is must disclose the significance of instruments, risk management policies, and sensitivity analysis. Got it? The contract creation, IS 32 for identity, IFRS 9 for measurement, recognize effective interest rate, gains, and OCI, disclose risk, and derecognition is basically rights and obligation end. Got it? We'll begin with the statement of cash flows. Now getting some nostalgia. Earlier, how do we calculate cash flow from operating activities? It's an assumed knowledge in your previous papers, or let's say even in 12th standard. So you've been given statement of cash flow. Why is this required? Because cash is the split line of business, right? Cash is the bullet line of business, and profit can be manipulated, right? So what does that mean? I just want to know out of the profits how much of cash inflow or outflow I am getting. Right? That's why even in investment appraisals techniques, we use discounted cash flow method. Okay, basically calculating the NPV. For that, we use projected cash flows. That's the importance of cash flow. Okay. Now, how do we calculate that? Simple. Profit before tax. I'm just assuming that you would have learned this in the sense, learned this format because that's how we used to do in 12th standard, right? Profit before tax, right? Add back non-cash expenses like depreciation. Okay. Huh. Till that we understand that we, let's say for example, might have deducted depreciation, but was there, did we pay anything for that depreciation? No. So that's why we add that back. Okay. And then we get cash flow
sorry, profit before working capital changes. Yes. And then we have a habit of just adding decrease in current assets. We add, right? If the inventory was, let's say, 5,000. Now this year it has become 7,000. So my current assets have increased. So as per my, what do we say, whatever I ratified in 12th standard, I should just deduct the increase in current asset. Okay? If I will just deduct this 2,000. That's what we usually do. And then if there's increase in current liability, let's say for example, trade payables increased by 2,000. Okay. So increase in current liability, we add, and decrease in current liability, we deduct. All right. So what is exactly happening behind this stage? So it is very easy. You just mug it up. Increase in current assets, we have to reduce. Decrease in current assets, we have to add. So, okay, this was the traditional view that we were having. Traditional view in the sense we were used to accustomed to it, that whenever a cash flow question comes, we will deal with it like this. But I just want to get behind the logic. We have cost of goods sold, right? In that we have simple formula: opening inventory, all right, plus purchases, all right, minus closing inventory. This is how I derive cost of goods sold. Now let's say here closing inventory is 2,000 and 3,000 in the current year. All right. So this 3,000 would be the closing inventory that I'll be using to calculate cost of goods sold. Now, in the previous year, when I deducted the closing inventory here, and when I did it here by deducting 3,000, definitely profit there when I deduct 3,000 would be higher, because that would reduce my cost of goods sold and increase profit, the closing inventory, right? Increase in closing inventory will do that. Yes or no? So, although my profit has increased, due to closing inventory, is there any cash element involved? Tell me yes or no. Is there any cash element involved with the closing inventory? My profits have increased because of that adjustment. Because of how I calculate cost of goods sold. But does it involve any cash element? Cash element I am talking about. It's just an adjustment, right? Minus closing inventory, it has increased. But has it increased my cash flow? Tell me, has it increased my cash flow? Nope. There is no movement in cash in this particular closing inventory case. But still, my profit increase because of the adjustment. All right. So what does that mean? So doesn't it make sense that when I'm calculating cash flow through the indirect method by reconciling all the items involving cash elements or not, to deduct increase in current assets? Tell me. Inventory increased from year 2000 to it went to 3000. Okay, but was there any cash element involved? But still, it boosted my profit. So I'll be deducting that increase in current assets. Got it? Now let's take another example. It will become more clear. See, previously my closing inventory was 2000. Now it has jumped to 3000. 1000 increase in closing inventory. So can I say it is an increase in current asset? Yes or no? Tell me. So by our rectifying logic, what does it mean? Increase in current assets should be reduced from cash flow. Hmm? That's what we've been mugging up since 12th standard. But we didn't infer it with the logic behind it. But this 3000, it has increased my profit. Why so? Because this closing inventory that will reduce my cost of goods sold. Okay, if cost of goods sold is less, which means profit will be higher. But is there any cash element involved? No, it is just inflating my profit. So when I'm calculating the cash flow since the indirect method, so I'll be deducting the increase in current asset, in this case is inventory, by 1000. Got it? Now let's take another example of trade receivable. Okay, I had a balance of trade receivable. Now it has jumped to 55,000. Okay, so don't you think it will form part, it will be a part of my revenue? Debit, trade receivable, credit revenue? Yes or no? Now this has increased to 10,000. And if it forms a part of revenue, profit will include this. Yes or no? The increase, because that's fine. I'll be booking my revenue. I've completed my performance obligation. So yeah, debit, trade receivable, and credit revenue. I've increased my current assets, right? Hmm. So what does this mean?
just look at the background. Although my current assets have increased, these are trade receivables. Have I received cash against it? Although my trade receivables have increased, my current assets have increased. I have included those in my profits. This is where I'm standing with the profit. This is my cash level. My trade receivables have increased. But has the cash increased in the same manner? No. So doesn't it make sense to deduct this from the cash flow because I haven't received cash? So increase in current assets should be deducted. Now getting the rectifying logic. Now we'll talk about current liabilities. Current liabilities. Let's say there are trade payables. Okay. Trade payables. They increased, say, from 10,000 to 15,000. This is, I'm talking about current liabilities. Trade payable increased from 10,000 to 15,000. So in this particular scenario, what I would have done, I would have deducted expenses and profit would have been less. Yes or no? But did I make the cash payment? No. So doesn't it make sense for me to add this 5,000 back that is increased in current liability, increase in current liability? See, I'm standing with my profit here. Okay, but my cash levels have not changed because I haven't paid them yet. Okay, if I have paid them, then it's fine. But I haven't paid them. That's why trade payables have increased. There's no cash element involved. See, it rose from 10,000 to 15,000. Okay, which means I owe them money, but I haven't, paid them. That's why there's no. But I deducted that as an expense in my profit and loss account, accrual basis, right? But I haven't paid them. So doesn't it make sense while I'm reconciling to add this 5,000 back? Tell me. See, there's trade payable. So what would have happened in profit and loss account? Debit expense. Yes. Profit would be less. Let's say the profit is 50,000. Okay. And 5,000 is trade payable. And this is after deducting that 5,000. Okay. So I have arrived at a profit of 50,000 after deducting all the expenses. Now, what is the cash flow? I want to know what are the cash flows. Now, if you look at it carefully, my trade payables have increased. I have deducted that from the profit and loss account. Fine, everything seems fine. But now what is happening is, did I pay them? Did I move out cash? So doesn't it make sense to add this back 5,000 because cash has not moved? Yes. So then I will be adding. So that's why increase in current liability is added. Got it? Let's take one more example. See, now similar. Trade payable only. We'll take trade payable. It was 15,000. Now it has become 10,000 in the current year. Okay. So what have I done? I have paid my previous balance, right? Now, if you look at this carefully, this particular payment might have occurred somewhere time, but I have already booked it in the previous year. Okay. From this balance only, I have paid it. So I would have booked it as an expense in the previous year, but I've paid it right now. So what would have happened? I would not have included this particular 5,000 of cash payment in my profit and loss, right? So let's say I arrive at a profit after deducting everything of 60,000. All right. But
I have also paid trade payables. That is decrease in current liabilities. So doesn't it make sense to deduct this 5,000 now? Now what about, let's now move to current assets. What about increase in current asset needs to be deducted? What about decrease in current asset? As per the rectifying logic, what were we supposed to do? Add this. Yes or no? Decrease in current asset needs to be added. Now, let's say I was having a receivable of 15,000. Now it has reduced to 10,000. I was having a receivable. It has reduced. Decrease in current asset. What would have happened? I would have already booked revenue in this, and then I might have received the payment, but it won't be reflected in this year's profit, right? The cash element. So let's say after doing everything, I arrive at a profit of 75,000. Okay, now there's a decrease in current asset. I was having 15,000 of receivable. Now I have 10. What would have happened? Would have received the money. So doesn't it make sense to add this 5,000 back? Now getting it? The core logic behind rectifying if it's current asset, increase in current asset, deduct. Decrease in current asset, add. Current liability, same. Increase, add, and decrease, less. Got it? So this is how the statement of cash flow is supposed to be done. See, the profit is an opinion based on the accrual concept, includes not cash items like depreciation, subject to accounting policy manipulation, a balancing figure, change in net assets. Cash is a fact based on actual liquidity required to pay obligations and dividend, harder to manipulate, trusted by creditors and risk averse investors. And why is this needed? For comparability, prediction, and modeling. Enhances comparison between entities by eliminating the effects of alternative accounting treatments found in the statement of profit and loss, like creative accounting. Prediction. Historical cash flows serve as the robust indicator of amount, timing, and certainty of cash flows. Allows users to develop model to assess the present value of future cash flows and checking validation. The cash flow statement links the performance, that is statement of profit and loss, with the position, statement of financial position, explaining the movement in cash balance. That's how you even check your answers in 12th standard, right? Opening cash and cash equivalents minus closing. And that difference, the movement, gets you there. Defining the liquidity pool. Cash equivalents are short-term, highly liquid investment, readily convertible to known amounts of cash. Insignificant risk of changes in value. Like bank overdraft are typically included here because they are repayable on demand. Cash on hand, and demand deposits. And exclusions, equity investment unless substantively equivalent, and long-term locked deposit because they are not liquid. Efficient cash management should not make an entity appear illiquid. The three pillars of financing activity: operating, investing, and financing. Okay. Operating is principal revenue producing activity. That's why cash flow from operating activities. Got it? Now investing. Acquisition and disposal of long-term asset. Cash flow from investing activity. Let's say there's a disposal. So that will increase the cash flow. You made an investment in property, plant, and equipment. That will reduce the cash flow. And that's why we also remove the gain part. SSS was a gain. So what it would have been credited to P&L, but that was a farm part of investing activity. It was a cash flow from investing activity. Let's say you sold a machinery for $15,000, costing 10,000, and you credited that gain 5,000 in P&L. But that was not supposed to belong here.
So I'll be reducing that from cash flow from operating activities. And in investing activities, I'll have a cash inflow of 15,000. Got it? Financing, changes in size and composition of equity capital and borrowing. It's basically the equity issues. You get some loan, you get proceeds from loan, you get proceeds from equity shares. All those are cash flow from financing activities. And you pay out dividend, cash flow. Cash flows out of the financing activity. Predict future claims on cash flows by investors and lenders. See, reconciling reality. Operating profit, then non-cash expense add back, add depreciation and amortization, reclassify to investing the gain part, and inventory payables, working capital changes is cash generated from operations. We start with profit before interest and tax and strip away non-cash items and accruals to reveal the actual cash generated uh, by the business engine. Got it? See, assets, inventory, and receivable, increase in balance, deduct from profit. Now getting the final chart. Increase in balance, increase in current assets, we have to deduct from profit. And decrease in balance, add to profit. Cash is released. What in case of liability? Increase in balance, add to profit. Cash is retained and delayed. Got it? And decrease in balances, deduct from profit. Cash is paid out. The inverse rule, asset up, cash down, the direct rule, liability up, cash up. Calculating tax paid, opening liability is current plus deferred tax plus tax charge less closing liability, current plus deferred tax. This is just a revision from deferred tax part. Okay. Investing activity. For example, there was a property, plant and equipment. It had an opening balance of 9,000. Okay. Depreciation and disposal of with a carrying amount of $100 was made, and we purchased machinery worth 2,100 and the closing PPE was 10,000. So if you remember the T type balance sheet, this is how it's done. For example, let's just make this. The debit credit, how much is the opening balance? Opening balance is 9,000. All right. And depreciation is 1,000. That would be on the credit side. And I disposed of with disposal worth a carrying amount of 100. All right. And after adjusting everything, my closing balance is 10,000. So what does that mean? If you look at this, 9,000 1,100 plus 10,000. The credit side is bigger, minus 9,000. So I'm getting debit purchases. This is how you deal with this. And this debit purchases, this will be cash flow in investing activities. Got it? Financing activity, funding the structure. There are inflows, proceeds from new shares, proceeds from new borrowings. That makes my cash inflow. And outflows, repayments of borrowing, payment of lease liability, and dividend pay. Okay, these are financing activities. Dividend pays is financing outflow, cost of equity. Dividend received is invest. See, make the difference. If you receive a dividend, that's because you invested in some company. So that forms a part of investing activities. So do not include in the proceeds from financing cash flows. Got it? So this is how statement looks like: operating net cash from operating after tax. Okay. So by adding up, add back depreciation, with that working capital changes, and after everything, after you deduct tax paid, you get net cash flow from activities. Then we have investing activities, purchasing of PPE, proceeds from sale, dividend receipt. Okay. Financing activity, issue of shares, debt, repayments, and dividends paid. Then net increase in cash and cash equivalents, cash and cash equivalents at the beginning period, cash and cash equivalent for the period. Okay, so this is how you reconcile it. Got it? Quality of profit. See, I can spike up my profit using creative accounting and all that. But if you look at the net cash flow from operation, it isn't that much. Okay. So what could be the possible reasons? Aggressive spike, aggressive sales recognition, bad debts. My profit look good, would look good. But am I having any uh what do we say? Cash element. That's why see increase in current asset. I have booked the revenue. It has jumped from 15,000 to 20,000. But it is gonna get deducted, right? The 5,000 because it's an increase in current asset. Do the rectifying logic or do the actual logic. It's gonna get deducted. So that means net cash from operation is gonna be less, and that's gonna reveal the reality. Inventory bloat, obsolete, poor demand planning, payable spike, artificially boosting cash by delaying suppliers. You're getting my point. So when operating cash must cover interest and tax, if not, the business is insolvent. Got it? Sustainability strategy, what could be the possible reason? Two contrasting scenarios, card side. The healthy grower, capital expenditure is more than depreciation, which means it's expanding base. Operation funds and management and divisions, investing outflows are high, which means growth. Now consider a distressed entity, asset sales, fund operations. Okay. I mean, I have to sell off my asset to just fund the operating activities. Borrowing used to pay dividends. Oh God, just imagine the situation. And capex less than depreciation, shrinking the asset base. An increase in total cash is not always good. Context is everything. That's why look at the source of cash. That's why we divide it. Got it? You might argue that, okay, I'm having a lot of good inflows in cash flow from financing activities, but that means that you are borrowing. Okay. And then you are funding the other sources. All right. Full disclosure beyond the statement, major non-cash transaction converting debt to equity that needs to be disclosed, acquiring assets via share issues, significant lease inceptions, restrictions, undrawn borrowing facilities, cash held in foreign jurisdiction. Okay. And voluntary value add split between maintenance, capital expenditure, and expansion capital. This is all discretionary, okay? Crucial for distinguishing defensive spend from offensive growth so that users of the financial statements would get to know where everything is allocated. Got it? Now we'll solve some MCQs. Uh, all right. What do we have this time? Deferred tax. See? Hmm. DF purchased its only item of plant on 1st October 20X1 for $200,000. All right. DF charges depreciation on a straight line basis over 5 years. Tax depreciation is allowed as follows: 50% of additions to property, plant, and equipment in the accounting period in which they are recorded, and 25% per year of the written down value in subsequent accounting periods except the year of disposal. What does this mean? The tax depreciation allowed by the tax authorities is like 200,000
of which 50%, which means 100,000, would be given as allowance in the first year. Okay, so that gets me a tax base of 100,000. And here, if you can see, I am depreciating it on straight line basis over 5 years. So 200,000 divided by 5 years. So that gives me a depreciation of 40,000 per year. Okay. So according to that, my tax base is how much is going to be my tax base at the end of year one? 200,000 minus 40,000. That gets me a tax base of, carrying amount of 160,000. Okay. At the end of year one. And then they are saying after 50% has been allowed and over the remaining value, we're going to have 25% of the written down value, which means 100,000 was the tax base at the end of year one. And over that, less 25%. So that basically means 75,000 is going to be my tax base. And here, as usual, I will be deducting 40,000. That is going to give me a tax base of 120,000. Got it? And what have we been asked? The income tax is 25%. What is the amount of deferred tax to be recognized in DF's statement of financial position as of 30 September 20x3? I'm standing at 1st October 20x1. Okay. So which means 1st October 20x2 year one completed and 1st October 20x3. Which means I want October 20x1, 20x2 to September 20x3 for the end of year 2. Got it? From October 20x1 to September 20x2, it is going to be 1 year. And to September 20x3, it is going to be 2 years. So based on that, I have calculated. This is for end of year 1. And this is also for end of year 1 from tax perspective. Once again, I'll depreciate with 40,000. I'm going to get my carrying amount at 120 and the tax base is going to be 75,000. So what's the taxable temporary difference? How much is it? 45,000. And if I divide it by the rate of 25%, I'm going to get 11,250. So this is the right answer. Got it? Now once again, following information relating to taxation appears in the record of Stapley. Description: balance on income tax account at January is this much. Income tax paid in full settlement for the year ended 31st December is this much. Estimated income tax, provision for tax for the year ended 31st December 20x2 is 7. What is the current tax liability to be included in Stapley's statement of financial position? Have they mentioned statement of profit and loss? No. As at 31st December 20x2. So just look at back at the basics. If they asked about statement of profit and loss, then where we would have done, okay, add it under over provision and then calculate the current year tax payable. But in the statement of financial position, we show provision for tax for current year. And how much is it? 137,600. So what is the current tax liability to be included in the statement of financial position for 10bx2? 137,600. Got it? Just look at the question, read the question very carefully every time. All right. Now, DZ recognized a tax liability of 290,000 in its financial statements for the year ended 30 September 20x5. Okay. This was subsequently agreed with and paid to the tax authorities as 280,000. They recognized for 290 and they paid 280,000. So 10,000 over provision. Okay, on 1st March 2026. The director estimates the tax due on profits for the year ended 30 September 2026. I mean, for this year, will be 320,000. And 10,000 was the over provision. DZ has no deferred tax liability. What's the income tax expense in the statement of now they are asking for statement of profit and loss for the year ended 30 September 2026. So they have estimated 320 and I made an over provision of how much? 10,000 and I paid less, right? So that basically means I will be deducting this 10,000. Got it? So A is the right answer.
हेलो
Yes, Madhav.
अंडर प्रोविजन रहेगा तो ऐड करेंगे सर
अंडर प्रोविजन हाँ तो ऐड करेंगे ये तो ओवर प्रोविजन था ना सी रिकॉग्नाइज 290 पेड 280 TS purchased 100,000 of its own equity shares now own equity shares in the market and classified them as treasury shares. At the end of accounting period, TS still held treasury shares. How should the treasury shares be presented in TS closing statements of financial position in accordance with IS 32? See, it purchased its own equity shares, buyback, treasury shares. All right. So, how are we have discussed it? How we deal with this? We have to deduct it from equity. So options are as current asset investment, no, it is not an investment. As non-current liability, no. As a current non-current asset, no. As a deduction from equity, yes. D is the right answer. Got it? How should the proceeds from issuing a compound instrument be allocated between liability equity components in accordance with IAS 32? Tell me. See, the options are the liability component is measured at fair value and the remainder allocated to equity. Yes, it is measured at fair value. Seems right. The equity component is measured at fair value and the remainder. Now, the fair values of both the components are estimated and proceeds. No. Remainder remains in equity portion. The equity component is measured at intrinsic value and the remainder is no. A is the right answer. Measured at fair value and the remainder is allocated to equity. That's why proceed minus liability portion. Got it? And then the remainder is allocated to equity. See, we have this one proper question. October 1st, 2023, Bertrand issues 10 million convertible loan notes, $10 million, carrying a nominal interest rate of 5% per annum. The loan notes are redeemable on 30 September 2026. So, after 3 years, X3, X4, X5. Okay. And X6. At par for cash and can be converted into equity shares. A similar loan without the conversion option would have required an interest rate of 8%. The present value of $1 receivable at each year end is this. We have been given the present discount factors. Match the amounts to be recognized on initial recognition as at 1st October 20x3. So it's a compound instrument. So I have to split it among liability portion and equity portion. Right? So how am I going to do this? 10 million worth of loan notes. So 5% per annum. So what is going to be my 5% interest. What is going to be my contractual cash flow on 10 million? 500,000 each year, right? 500,000 year 1, year 2, and year 3. And in the end of year 3, I'm gonna redeem them as well. Okay. So what does that mean? So I have to give 10 million there. And what's the year 3 discount factor? I'll be using the 8% discount rate. Okay. I've explained this to you that without the conversion option, the market value is 8%. To reflect the true economic reality, we are using 8% of the discount factor. Okay. Why so? Because users agree to the less interest rate because of the conversion option. That's why we have that equity portion. So 10 million into 0.79, that basically gives me 7.9 million. All right. And for simplicity, we'll just multiply the 500,000 off with the total of these three. That is 2.58 into 500. 1.29 billion. Okay. And plus 7.9 million. That was for the redemption. So that gets me 9,190,000. This is the liability portion. Non-current liability component would be this much. And if I deduct 10 million from the liability portion, I'm going to get 810,000. So that will be equity portion. Clear? Equity portion is 810,000. Got it? Now, on comparing the components of net assets of D at 31st December 20x2 and 31st December 20x1, the following movements were noted. A decrease in the warranty provision of $12,000 due to change in estimate. A decrease in warranty provision. I don't see any cash element here. An increase in property, plant, and equipment of $98,000 arising from a revaluation during the year. Okay. Which of the above amounts should be included in the reconciliation of operating profit to net cash flow from operating activities in accordance with ISLA? Now, if you look at this very carefully, 12,000 would have been changed. It would have been debited, okay, in the P&L. And for reconciling the cash flow, I would have added this back because there is no cash element involved, right? For reconciliation. Agree or not? I would have added this 12,000 back. And for this second case, an increase in due to revaluation. Revaluation goes in OCI. So there's no point of reconciliating that with the profit. So I'll be reconciling the option A. So B is the right answer. Start with business combination. Mergers, acquisition, the chunkier part in the financial reporting exam. Now what happens is, let's say company Alpha. wants to grow. Okay, so there are usually two methods. One is organic. Organic, that you use your retained earnings. Use the profits to reinvest. All right, so on and so forth. That's one way you can achieve growth. Or else, what you can do is, if you want to expand to some other business territory and you're not an expert in this, your business is not an expert in that category. So it would be very difficult to grow organically in that case. So what you can do? Merger and acquisition. Used simultaneously. And why they are used simultaneously? Because, as discussed in previous sections also, that IFRS and IS, International Financial Reporting Standards, they are principle based. Okay, so accounting is based on control. We'll dissect it. What is control? Why accounting is based on control? Why not proportionately? Why do we add line by line and not 80% of, let's say, subsidy? We'll discuss that. So there is merger and acquisition. So let's say Alpha Limited found that Beta Limited is a potential candidate for merger. All right. So what's they gonna do? They're gonna offer them a consideration that, hey, listen, shareholders of Beta Limited, we are offering you rupees, let's say 50 million. Oh, sorry, rupees and 50 million. Dollar 50 million. Okay. So what's gonna happen? They're gonna think, okay, we have calculated. If I consider all the assets that we have in the company and all the liabilities that needs to be discharged, and the net identifiable assets we have as 60 million, for example, huh? It's not going to happen like this in real life, because there's going to be extensive due diligence done by the Alpha Limited shareholders, and then they are going to put an offer. Okay, it's not going to be like they'll offer 50. They know that net identifiable asset, but the Beta Limited shareholders will see, okay, 60 million is my net identifiable assets. Why would I agree at 50 million? So they will ask for a counter offer. So they'll say that based on our expectation, we believe that 80 million is the right consideration. Alpha Limited put to its due diligence and say, okay, fine. So if you can see, 60 million is the net identifiable assets. What is the net identifiable assets? If you look at a balance sheet, is a balance sheet, there is going to be asset, equity, and liability. So either you look at this way, asset minus liability gives you net asset, okay, or you look at it directly. All right, so this is going to be the case. So they're gonna say that right now, if all these shareholders agree and they liquidate the company, they're gonna get 60 million. Okay, now the thing is, they are in the business since a long time. All the customer list, all the patents, all the methodologies that they are using for the business, Alpha Limited is gonna get that from day one if it acquires Beta Limited. And moreover, control is also going to be passed. Current shareholders would say that from if Alpha Limited acquires us, we won't be able to control Beta Limited. So there's also going to be passage of control. So they are going to say that we need extra for that, premium for control. Okay, that's basically nothing but goodwill. And it's not going to be like if it is 100% acquired, then there's no controlling. But let's say we acquired 80% of Beta Limited.
So what those 20% is called? They are called non-controlling interest. We cannot control them. They are the Beta Limited's existing shareholders. They're gonna stay there. Okay. So this was the wholesale story of what exactly is going on. Now we'll dissect each and every what is controlled, why is it happening like that, and what is going to be the accounting for that. All right. Let's take an example. For example, Alpha Limited acquired Beta Limited by offering one equity share for each share held in Beta Limited. Okay. So how many shares, existing shares does A Limited have? Let's say for 60,000 equity shares, and B Limited has 40,000 equity shares. All right. Now, A Limited acquired by offering one equity share for each share held in Beta Limited. So what's the offer? Beta Limited has 40,000 shares, and Alpha Limited offered one share for each share held, basically 40,000 A Limited shares. All right. So after acquisition, what is the scenario gonna look like? Total number of equity shares would be 120,000. Okay, this is the total number. Out of this, what's the composition? Oh, sorry, 100,000. What's the composition? 60,000 is held by A Limited and B Limited holds 40,000. So I can say 60% is held by A Limited and 40% is held by B Limited. So overall, I can say that legal acquirer, the one who issues the share, legal acquirer is A Limited, and the legal acquiree is also B Limited. Fine. And what's the substantial acquire? Substantial. That is where accounting is gonna change. Okay. The substantial acquirer is also A Limited because it holds 60%. And the substantial acquiree is also B Limited. Now the IFRS 3 and IFRS 10. IFRS 10 has consolidation. It has the definition of what is power exactly. All right. Now, according to if all the conditions are met, then A Limited is controlling B Limited. What does that mean? A Limited is the parent, substantial acquirer, and B Limited is the subsidiary. All right. So this was the case. Now let's change the scenario. A Limited, Alpha Limited acquired B Limited by offering 2 shares for every equity shares held in Beta Limited, B Limited. Okay. Now the current composition was A Limited had 60,000 in issue and B Limited had say 40,000. So how's the consideration is going to look like? A Limited offered 2 shares for every 1 share held in Beta Limited, basically meaning 80,000 of A Limited shares after the acquisition is going to be, look, this is how it is going to be like, looking like. So total number of shares would be, okay, 120,000
Now, if you look at the composition, $60,000 is held by A Limited. Oh, this is 140,000. And 80,000 is held by B Limited. Now, if you look at the math, percentage holding based on total number of shares, this gives me 42.85, and A's percentage and B percentage holding is 57.14. All right. So if you look at this category, here what's happening is on paper, as A Limited issued the shares, the legal acquirer is A Limited, and the legal acquiree is B Limited. All right. Now, substantially, if you can see, the substantial acquirer here would be B Limited. Why so? If you can see, they had 57.14% of holding, and the substantial acquiree would be A Limited. All right, because they had the remaining shares of 42.85%. All right, so this is the case scenario. This is the foundation. Then accounting is based on control. IFRS 3 is business combination. IFRS 10 is for consolidation. Okay, so what's going to happen? Say A Limited acquires 80% of B Limited. Okay, so at the time of acquisition, what do we have to do? We will consider purchase consideration. It could be in the form of cash. It could be in the form of shares. It could be a deferred consideration, or it could be contingent consideration as well. All right. So these are the four. And what are we required to do? We are required to calculate goodwill at the time of acquisition. All right. So this is what we are required to do. Calculate goodwill at the time of acquisition. Now, as discussed, goodwill is the premium for control, which means IFRS 3 says that you have to look whether control has transferred or not. And how can I say whether control has transferred? Power over the investee, exposure to variable rights and return, and ability to control. So it is not like you have to look at the absolute figure if it's more than, but it's a good benchmark to see if the ownership is more than 51%. But let's say I'm the sole investor, I have 40% ownership. Okay, but rest of the shareholders, they are fragmented. They are minority shareholders. Each hold 2%, let's say. So in this case, I am having the power over the investor. Okay, if I do not agree to one decisions, that thing is not going to happen. Exposure to variable rights and return. I have the exposure to the profits and the losses. For example, a fund manager, although he controls the fund, the mutual fund, but what he is going to receive a fixed fee, fixed professional fee. Is he having exposure to variable rights and return? All the market value changes? No. And you have to finally have the ability to control, I mean, make management decisions. Basically, you appoint management. You can appoint management to take decisions, basically improving your profits. And that ability that you should have, that is what control is. All right. So this is what. So at the date of acquisition, you will have to calculate goodwill. Now, if you can see, A Limited acquired B Limited for say $80 million, and at the date of acquisition, the net assets of B Limited were $60 million, and the NCI is measured at fair value of $5 million. And now what does IFRS 3 require to calculate goodwill? How are we going to calculate goodwill? Simple. Purchase consideration plus NCI minus net identifiable assets. Got it? So this is how we will calculate. So in this case, 80 million is my purchase consideration. 5 million is the fair value goodwill less 60 million of net identifiable asset. So that is giving me a goodwill of 25 million. Yeah, simple. Now, why have I calculated all this, did all this? See, goodwill is a premium for control. You are acquiring 80%. Okay. So by absolute figures only, you are the one who is having complete control over the subsidiary. So IFRS 10 requires if there is a parent and subsidiary relationship, so the financial statements must be consolidated on line by line basis. Now, if we look at the individual financial statements of the parent of Alpha Limited, how the individual financial statement is going to look like. See, it's basically going to look like under assets as non-current asset in the individual financial statement. Okay. Non-current assets, we are going to have investment in subsidiary as 80 million. Fine. Makes sense in the individual financial statements. Now, when it comes to consolidation, what does IFRS 10 say? Line by line consolidation, line by line consolidation, which means if A's revenue and B's revenue should be added to get group revenue. That's basically line by line consolidation. Now, you might argue that, okay, if we are owning 80% of the subsidiary, why not do it like this? A's revenue plus 80% of B's revenue. But time and time, accounting is control based. Okay? Not ownership based. All right. And why so? Why accounting is control based? Because of the principle. IFRS 3 says if you are having control, which means the group is a single economic unit. All right. So it makes sense to do line by line consolidation. So what about the 20% NCI part? We have not purchased the subsidiary at 100%. We still have 20% of other shareholders. So that is dealt under non-controlling interest. Right? Not controlling interest. This is not a liability, it's a part of equity. Okay. So this is what is going to look like in the individual financial statement. Now, when it comes to consolidation, consolidation requires line by line adjustment. Consolidation, revenue of A, revenue of B. All right. So this 80 million, this is not going to stay in the consolidated financial statement. It's going to open up into what? The net assets. Okay. So they are going to be distributed. Net assets part, the non-current assets would be consolidated, the current assets would be consolidated, the liabilities would be consolidated. But listen to me very carefully. In the consolidated financial statement as well, the share capital that you see is of parent only. Okay, rest of the balance that is remaining is the NCI part. We do not consolidate NCI, the subsidiaries share capital and that. All right. So net assets that would open up into net assets, basically the liabilities part, the current asset part, and further bifurcated into goodwill. So this is how it is going to open up, and this is not going to be shown in consolidated financial statements. So this was the backbone of what exactly is business combination and consolidation. See, the economic problem separated by law, united by control. The legal view, they both are separate entities. The economic views, they are single entity. Atlas Inc. controls Nova. So this is going to revolve around Atlas and Nova Limited. Okay, Atlas is controlling Nova. Legally, a parent and a subsidiary are strangers. Economically, they are one. Financial consolidation is the art of translating the latter into the former. Okay, as a single economic unit. Okay, definition of control. When do I do consolidation? Step one, as discussed, power over relevant activities, exposure to variable returns, and ability to use power to affect returns. Then control is established. Ownership percentage is a clue, not the rule, but a 80% threshold is crossed. So usually there's a control. From this moment, the two entities must report as one. Okay. Atlas own 80% of Nova. The 50% threshold is called. Result, Atlas is parent, Atlas is parent, and Nova is subsidiary. All right. Now comes what about acquisition? So let's say Atlas acquired Nova on 1st January 2025. Okay. So at the date of acquisition, what am I going to calculate? Net identifiable assets. At the date of acquisition. So anything pre-acquisition, the profits and all that will be included in net identifiable assets. And after acquisition, group history, profit here are revenue. And before that, they were part of retained earnings. Old shareholders history, profits here are capitalized, paid for. All right. Accounting must avoid recognizing profits twice. At last paid for the pre-acquisition profits in the purchase price, we cannot count them as income. Now comes the substitution logic. We swap the shares for the asset. In the single entity financial statement, how the investment is going to look? Investment in Noah at 1.2 million, for example. Investment shown as a single line item. After it is replaced by actual business component as property, plant and equipment, inventory, so on and so forth. The investment line item disappears. It is replaced by line Noah's actual asset and liabilities. This is replacement, not addition. The group investment did not buy a piece of paper, it gained control over a business. That's why accounting is control based, not ownership based. So for example, at the date of acquisition, we paid the shareholders of Noah Limited 1.2 million and we calculated NCI at fair value at 260,000. So adding consideration and NCI 1.56 million at that date of acquisition, the net identifiable asset amounted to 900,000, which gives us a goodwill of 560,000. The premium represents brand strength, customer relationship, and synergies. The premium for control. All right. So goodwill equal to total implied value minus fair value of net asset. And bear in mind, this is equity, not a liability in the consolidated financial statements. Now, any profit, 20% belongs to the NCI, that would be split in NCI. Fair value adjustment. Let's say at the date of acquisition, when we assessed the net identifiable asset, let's say for example, we revalued a property, plant and equipment and the fair value was more. So what is that going to result? The book value was 800,000 of net assets. Now fair value adjustment was of 100,000. So net assets would be at 900,000. And what is that going to result in? More depreciation. Noah's book was historic. The appraisal showed the machinery was worth more. This 100,000 uplift increase this net asset, including goodwill, but creates a future consequence of extra depreciation. Got it? It's gonna be deducted from NCI for that part. For their part. Okay. Post-acquisition performance, the first year. So Nova reported a profit increase of 400,000. So now I have to first adjust the fair value of additional depreciation. That is 10,000. Now the adjusted profit is 390,000. And from that 80% will transfer to Navy Atlas and 20% will transfer to the 20% NCI. See, the group bought the asset at high value, so our profit must reflect the higher depreciation cost. Now comes intra-group sales. It's very important. One is elimination and one is provision for unrealized profit. So let's say Atlas sold Nova. Goods were 200,000. Now there's a simple logic. You cannot earn profits by selling to yourself. As group is a single economic entity, you cannot earn profit by selling to yourself. So what's gonna happen is if Atlas sold to Nova, Nova would have recorded the revenue and the same would be the cost of goods sold for Nova at last would have recorded the revenue because they sold the goods, and Nova would have recorded cost of goods sold. Now the elimination concept says this is the intra-group transaction. So this 200,000 needs to be eliminated. All right. Now unrealized profit, the fake profit in the warehouse. For example, out of the 200,000 of goods sold to Nova, 50% was still left in inventory. Okay, now the total profit and sell was 40,000 and unsold portion remains at 50%, which means we need to make an adjustment. We have not realized it. The rest of the 50%, it was sold externally, which means it's realized, so no adjustment needed there. But what about this $20,000? They are sitting in my inventory. My inventory is valued higher, overstated. All right. And because inventory is overstated, if you know cost of goods sold, simple logic. I deduct closing inventory. Okay. Simple arithmetic logic. I deduct closing inventory. So if I have valued my inventory higher because of the unrealized profit portion, including the profit portion in the inventory, so definitely my cost of goods sold is going to be less. Okay. So if you can see, if the profit to eliminate is $20,000, so if I debit cost of goods sold by $20,000 and credit inventory by $20,000, it's gonna be adjusted. Debiting COGS basically means I'm reducing the profit, which shouldn't have been there because I've sold to subsidiary and inventory is still left and there is unrealized profit. They have not yet sold it to external parties. Okay, so this needs to be adjusted. So by debiting COGS, I'll be increasing my cost, reducing my profit, and crediting inventory, I'm reducing the value of inventory. Okay, see, at last recorded profit, but the goods haven't left the group. The profit is fake until sold to an outsider. We must reduce inventory and retain earnings by $20,000. All right. Now, intra-group dividends. As discussed, you cannot pay yourself. And intra-group dividend is basically moving cash from one pocket to another pocket. Okay. So when Noah, the subsidiary, pays at last, cash moves but stays within the group, left pocket to right pocket. Only the payment to the non-controlling interest is a real outflow from the group. Let's say, for example, what's gonna happen in this? Let's say if parent recognizes a dividend income. So definitely the subsidiary is gonna recognize a dividend payable. Okay. So let's say if 100,000 is the declared dividend, what's gonna happen? If I include dividend income, it would be double counting, right? Because eventually, what's gonna happen? I'm gonna get my subsidiary's profit of share, right? Look at this carefully. If parents record dividend income of 100,000, okay, we keep it as it is. Then what's gonna happen? From the subsidiary's profit, portion, I'm again gonna receive the dividend, right? So there would be double counting. So how to adjust that? All the dividend income and dividend payable needs to be eliminated. So how it is going to be done? Let's say Nova Nova Co declared a dividend of 100,000. So out of that, if you see 100,000 and its profits were $1 million. And out of that, they declared a dividend of 100,000. So if I split the profit, 800,000 and 200,000. It belongs to the NCI. Okay. Now what's gonna happen is this 800,000. They have declared the dividend from this itself. So this already includes this. So there's no need in double counting as dividend income, because when I receive this, I'm gonna get my dividend portion. Now what about this 200,000? If you look at this, this belongs to the NCA. Now out of this, 20,000 of the dividend. 20,000, 100,000 was declared. 20,000 belongs to the NCA. So they are going to take that dividend. So this will be reduced from NCI. Got it?
Yes, sir.
Now comes goodwill impairment. Remember IAS 36 impairment. Goodwill is such an intangible asset that needs to be reviewed every year for impairment. Okay, because it has indefinite useful life. So if there's an impairment in goodwill, so there are two methods we measure our NCI. Either at fair value or either at proportionate method. Okay, so if it is measured at fair value, what's going to happen? The impairment is going to be split, okay, among parent and NCI in their respective shares. But if it proportionate method, basically proportionate to the net identifiable asset. Let's say the net identifiable assets were 1 million and 20% belongs to the NCI. So 200,000 would be the NCI's proportionate value method. Fair value would be higher. Okay. So in proportionate method, only the parent bears the impairment loss. The loss does not pass to NCI. Simple. Goodwill isn't forever. If brand value fades, we write it down. Impairment. Since NCI owns a share of the fair value, they share the pain as well. If the goodwill is 560,000, impairment loss is 120,000, so parent shares would be 80%, 96,000 of it, and NCI shares would be 24,000. Got it? Now comes consolidated retained earnings. Parent's earning base, let's say share. I'm going to calculate group retained earnings basically. First, I'm gonna take the parent's retained earning as a base. Let's say whatever amount that could be. So that's 1.1 million. Okay. No, they've given 560. They have not. Let's see. Share of Noah's post-acquisition profit is 312,000. I have to take in account the unrealized profit. Remember 20,000 that we dealt. Okay. And 96,000 of my share, parents' share. That's how I'm going to arrive at 560,000. Let me just see what was the. No, the figure for. Parents' retained earning is 364,000. Okay, so if I have 364 plus 312 minus 20 minus 96, I'm gonna get 560. Okay, so this is how you calculate group retained earnings. Now comes non-controlling interest. So let's say from this share 312, 80% share is 78,000. Fair value as acquisition was 260,000. The share of impairment would be minus 24,000 because it was measured at fair value, and dividend paid minus 20,000 reduced from the equity. Remember? So closing NCI balance would be 294,000. Got it? Okay. Simple. The logic of consolidation is if it's internal transaction, we eliminate it. If it's pre-acquisition, we capitalize. Measurement difference, we have to adjust. Fair value adjustment, ownership difference, simply allocate. Okay. Got it with the revision?
Sir,
Hmm.
measurement adjustments means
Fair value adjustment after the extra depreciation. See here it was not listed, but if let's say there was an extra depreciation, that would be accounted. Got it?
yes, sir. When we acquire when we
Hmm.
जब हम लोग पेरेंट और जितना इन्वेस्टमेंट किया है तब जब जितना लेते हैं डेप्रिसिएशन
Hmm.
वहां
Hmm.
पर
Hmm. Hmm. Hmm.
ठीक है
Yes. Yes. Depreciation, the additional depreciation, let's say it's 10,000 post acquisition. So we have to account for that. तो वो हम reduce कर देंगे from the NCI's retained earning. Got it? तो हमारा शेयर भी कम हो जाएगा. Okay? Uh, Here if there was, see, Nova's book were historic. The appraisals showed the machinery was worth more. The 100,000 uplift increases net assets, reducing goodwill, but creates a future consequence. The depreciation will be charged on 900,000. Got it? Hmm. So extra depreciation is group retained earnings. Operating expenses would be increased by 10,000 because depreciation has increased. Remember, we did the adjustments. Hmm. Okay. So now this was all for consolidation. Now there comes a concept of equity accounting. And this is see till now we were dealing with parent and subsidiary. Okay, this was because parent had control over subsidiary. Yes, that's why accounting, we consolidated. Accounting is control based, not ownership based. We did line by line consolidation. Now, what if the parent does not have control, but it has kind of significant influence, like in between 20 to 50% of investment? Not as low, like they can participate, but cannot direct. Okay. Similarly, and it's not as low value that it could be listed under IFRS 9 as financial asset. So it's somewhere in between. Can you say that's we have significant influence? If this is the case, we have significant influence. And how do we account for this? Do we do line by line consolidation? No. There is IAS 28, equity accounting. Okay. So if we have significant influence in a company, that becomes our associate, not subsidiary. And if we have an associate, we do equity accounting. So the rough patchwork, I mean, the formula for equity accounting is basically investment in associate plus parents' share of profit less dividends. Okay, that's how you get closing balance. Now, what exactly is an associate? How do we know that we have significant influence, and how to do this accounting? Okay, see, the accounting treatment flows entirely from level of power held. The relationship control, subsidiary, full consolidation under IFRS 10. Significant influence, that is basically from 20 to 50%, associate equity method under IS 28. And no influence less than 20%, passive holding, simple investment, fair value at IFRS 9. Okay. So having a seat at the table without holding the gravel, that you have a seat at the table, but you cannot control. The definition, you can sit on the board, argue policy, share management, personal, trade materially, but you cannot decide unilaterally, direct assets, bind the company to agreements. So the 20% rule is, if it's more than or equal to 20%, it presumes that you have influence. Less than 20%, it presumes no influence. Facts always override percentage. If you hold 15% but sit on the board, you have influence. The word influence is important here. Okay. Why showing assets line by line would be a lie?
समझा नहीं क्या बोला
Okay.
50
Which part? 15%. Okay. Let's say you have a seat at the conference room. Okay. Conference room, I mean at the board meeting. So although you are holding 15%, but still you are having influence. Okay. So that means you have significant influence. So that will become your associate. Investment in that company will be associate. Dealt under IS 28. Got it?
20 to 50% na to have
Yeah,
the
usually it's 20 to 15%, 50%. But if the facts state otherwise, like you have influence, like if the question is trying to confuse at, let's say, 18%, you might think that it's not 20%, but you also have a seat at the meeting. You can, have your say at the board. So you have significant influence, although you do not meet the minimum threshold. Got it? So why showing assets line by line would be a lie? Consolidation is designed to show assets and liability you control. With an associate, you do not control the assets and liability because we have significant influence, not control. Therefore, showing them on your balance sheet line by line would be misleading. So the solution is IS 28 mandates equity method. We collapse the entire legal entity of the asset into a single economic representation. We are answering what is my share in associates net worth. The associate is legal entity, one asset line, economic interest. So equity method mirrors the economic life cycle of the investment. So at acquisition, you buy a claim in the net assets. Let's say you have 25%. So you just are buying a claim in the net assets. Then the associate earns profits. So your claim in the net assets increases. That's why we add associates parents share in associate. But if the associate pays dividend, so my claim in the net asset reduces, right? Because they have paid me out dividend. Okay. So I'll be deducting dividend paid. So that is how. And if there's an impairment in investment, that also reduces your claim. So that basically reduces the carrying amount of the investment. The output balance sheet, one line only, investment in associate, no goodwill line, no asset line, and no liabilities. Profit or loss, one line only, share of profit of associate. Okay. The simple formula for IS 28 is you have cost of investment, add share of post acquisition profits and OCI, less dividend received, cash out is value down, and less impairment losses gives me the carrying amount of investment in associate. Never consolidate assets or liabilities. This single number represents the entire relationship. All right. For example, 40% acquired at 240, retained earnings at acquisition were 100, retained earnings at reporting date were 220. So the movement is 120. So I'm going to get how much share? 40%. Say 120 total good. I'm getting 48. And I invested 240. I'm getting 48 and there was an impairment of 8. So I'm going to deduct that. So my closing investment in associate is going to be 280. Got it? For example, how the associate affects the group bottom line? The rule. Include one single line share of profit of associate calculated after tax sits in investing category of P&L. Okay. Example, if associate's net profit is 2000 and you own 40%, you recognize 800 in your P&L. And that 800 will translate to balance sheet. So investment in associates carrying amount would get increased. So do not touch associates revenue, do not include associates expenses and dividend receipts. Do not include balance sheet only. Okay. The dividend track. Distribution is not created. Dividends are distribution of profit, not the creation of new profit. Under equity method, we recognize the profit when it was earned. Recognizing the dividend as income would be double counting. So what you did, as this line suggests, you recognize 800,000 in your P&L. Now the company would declare dividend out of this 2000 only, right? So if you recognize, let's say, a dividend of 100 and then recognize 800, that would be double counting. So that is why we do not count dividend as dividend income. We reduce that from investments carrying amount, associate investments carrying amount. Okay. Hidden goodwill and holistic impairment. If costs are more, share of net assets, the excess is goodwill. Rule: never show goodwill separately. It is embedded inside the investment in associate line. That's why no goodwill, no consolidation. The impairment, because goodwill is not separate, you cannot test it separately. Impairment is tested on the entire carrying amount of investment. Any loss reduces investment line. Okay. Trading with associates, neighbors, not family. You can say that in group accounting, the subsidiary was family, but here in this case, they are treated kind of like neighbor. The golden rule: and associates is not part of the group, treat them as third party. So receivable, payable, no elimination. Sales, purchases, real row, no elimination. Loans. While we don't eliminate the transaction, we must adjust for fake profit. The PUP adjustment still stays relevant here. Okay. So you cannot make a profit by selling to yourself. The concept is, if goods sold between the parent and associate are still sitting in inventory at year end, the profit on the goods is unrealized, similar to group accounting. Okay. So it's going to be like if the parent sells to associate. So that's a downstream transaction. And if associate sells to parent, that's an upstream transaction. So what's gonna this mean? So if parent sells to associate, the fake profit is gonna sit with parent. Okay. So I'm gonna debit my earnings and credit the carrying amount of investment. But if associate sells to parent, the profit element is gonna sit with associate and parent is gonna have inventory. So debit associate shares and credit inventory. Will look, total unrealized profit is inventory in investor's stake equal to amount to eliminate. For example, there's a 40% associate. Total unrealized profit is 400. Group share to eliminate is 160. I mean, it's our share based on 40%. 400, 40% is 40. So what if when associate sells with parent? So parents hold the inventory. So inventory needs to be credited, right? So credit inventory by 160 because it was inflated because of the fake profit. Remember, inventory was inflated and it was sitting in parent's warehouse. So inventory was inflated. To crediting inventory would reduce its value, and debit share of profit in associate because that is going to be reduced. What about when parent sells to associate? Now we're going to debit associates inventory? No, we have no say in that. But we're going to directly crediting investment in associate by 160. It's going to have the same effect. And debit cost of sale. We're going to reduce our profit because we have sold the inventory to associate and we are sitting with a profit. So debiting cost of sale would rectify that. Okay, profit originated in the group, we reduce group profit and the investment value. And here profit came from the associate, we reduce our share of that profit and credit inventory. Okay. For example, how do I account
So facts, there's a 40% associate. Associate earned a profit of 1200 and downstream unrealized profit. Parent sold to associate. Downstream unrealized profit share is 160. Okay. So step one, recognize MA profit share is going to be 480. That is 1200 into 40% equals to 480. Debit investment, credit share of profit. I'm going to increase my carrying amount of investment in associate. Eliminate unrealized profit, debit cost of sale, credit investment. Investments value is going to drop by 160. So the final calculation is 2300. I added the share of profit and adjusted. So that's going to give me 2620. Got it? Simple. IS 20. Identify, influence, not control, no consultation, display. One line, balance sheet, one income, P&L. Movement, profit increases investment, dividends reduce investment, impairment hits entire balance. Trading, do not eliminate debts, eliminate unrealized profit only to extent of your share. Okay, so we have completed with IS 28. So now we will do some MCQs regarding this. Okay. So Harvick holds $70,000 B shares in SAL. SAL. Okay. SAL. These shares carry one vote each. So Harvick has $70,000 B shares. So total 70,000 votes. Okay. Now Flexistoe holds $18,000 one A shares in SAL. These carry 10 votes each. If you look at it carefully, they carry 10 votes. So 18,000 shares of $1 and 10 votes, 180,000 total votes. And here, if you can see, Harvey holds 70,000 shares. So that is only 70,000 total votes. So here I'm having more votes. So 100 share of the share capital of SAL is made up of the following: 100,000 B shares of $1 each and 220,000 A shares of $1 each. Now, by looking at it, it would feel like that Harvard has control because he holds more of B shares, right? And what are we required? SAL is subsidiary of which of the following required reporting entities. But if you look at it carefully, Flex is showing hold $18,000 one A shares. Okay, so total 180,000 votes he has because these shares carry 10 votes. But Harvey holds 70,000 of B shares, so total only 70,000 voting shares. So based on controlled, I can say Flex is showing only because he has more power. So C is the right answer. Now comes Sam has share capital of $10,000 split into 2,000 A ordinary shares of $1 each and 8,000 B ordinary shares of $1 each. Each A ordinary share has 10 votes and each B ordinary share has 1 vote. So A share would be having total of 10,000 votes, 20,000 votes. 10 votes each to 20,000 votes, and B ordinary shares have only one, so 8,000 votes. Both classes of shares have the same rights and dividend and liquidation. Tom owns 1,500 A ordinary shares in SAM. Dick owns 6,000 B ordinary shares in SAM. All three companies conduct similar activities, and there is no special relationship between the companies other than that they already stated. The shareholdings in SAM are held as long-term investment and are only shareholdings of and are the only shareholdings of Tom and Dick. Now, which companies must prepare consolidated financial statements? Who has control over which company? See, if you can see, Tom owns A, 1,500 of A shares. Okay. And the SAM share capital is split into A and B, right?
So Sam's capital is split into A and B. So if you look at it carefully, Tom has 1500 A shares and 10 votes each. So 15,000 total votes, and take owns only 6,000. So 6,000, 15,000 is the total vote. So basically, which means he has control. Now, which company? The company which has control prepares consolidated financial statements to Tom only. Got it? Now, which two of the following statements regarding consolidated financial statements are correct? Only the group's share of assets of a subsidiary is recognized in the consolidated financial position. No, we recognize completely. Under equity accounting, only group's share of the net assets of an associate is recognized in the consolidated financial position. Yes, the amount of share capital. The amount of share capital in the consolidated statement of financial position will include the share capital of both the investor and the investee. No, it will not. It will include only parents. Parents' share. Okay. A parent has a choice in how to measure the non-controlling interest for each subsidiary. Yeah, fair value or proportionate. So B and D are correct. Now, HX acquired 80% of SA's 100,000 equity shares on 1st July 2080 for 140,000. On 1st July 2080, the fair value of SA's identifiable net assets for 126,000. The fair value of the non-controlling interest on acquisition is based on SA's share price, which is 1.70. Which two of the following are acceptable as the initial measurement of goodwill in accordance with IFRS 3 business combination? What's the formula for goodwill calculation? Purchase consideration of 140,000. Add NCI. We have been asked two of the following. So we'll take one proportionate NCI and one fair value NCI. So first take proportionate NCI, 80%. So the 20% was NCI shares and 20%, which means they still have 20,000 shares, and the fair value is 1.7. Basically, so that gives me a fair value NCI of 34,000. What about proportionate method? If you look at the proportionate method, it is 126,000 is the net identifiable asset. If we multiply that with 20%, we get 25,200. This is under proportionate method. All right. Purchase consideration still remains the same. Less net identifiable assets. How much they are? They're going to be the same, 126,000 and 126,000. So that gives me 140 plus 34 minus 126. So 48,000 here and 140 plus 25.2 minus 126. That gives me 39,200 here. Okay, so D and C are correct. Now here comes where Varsity acquired 80,000 ordinary shares in Western some years ago. Extract from the statements of financial position of the two companies as at 30 September 2087 are as follows. Okay. Ordinary share Varsity Western retained earnings 90 and 40. On acquisition, the retained earnings of Western showed a deficit. I mean, at the time of acquisition, there was 10,000 loss. Goodwill has been impaired by $15,000 since acquisition. The non-controlling interest was measured at fair value on acquisition. So parent will get its share. Okay. So 80%. Varsity owns 80% of Vestra. So we'll get 80% of share. Was measured at fair value on acquisition. What were the consolidated retained earnings of Varsity on 30 September 2018? Now, if you look at it carefully, we have to look for post-acquisition profits when it comes to group retained earnings. So at the date of acquisition, there was a loss of 10,000. So it moved from 10,000 to 40,000 profit. So can I say I have a 50,000 profit?
because I moved from 10,000 loss to 40,000 profit. Yes. So that basically means the post-acquisition profits were 50,000. So they are going to be split among parent and NCI. What's going to be the parent's share? 80%, 40,000 here. And we are going to also bear goodwill impairment. That is 15,000 into 18%. 80%. That's 12,000. So parents' retained earnings are 90,000. I'm getting my post-acquisition share of 40,000 and reducing my share of impairment. So 90 plus 40 minus 12. So that gets me 118,000. Got it? Now Huge acquired 60% of Small's 500,000 shares on 1st January 20x2. Okay? The purchase consideration consisted an immediate cash payment of $3.45 per share. So they acquired 60% of 500,000. Okay, so they acquired 300,000 shares. So immediate cash payment of 3.45 per share plus a share exchange of 3 shares in Huge for every 2 shares in Small. 3 shares in Huge for every 2 shares in Small. Okay, so this was how share exchange looked like. At the date of acquisition, the market prices of each share in Huge and Small were 6.5 and 4.2. So we are going to be concerned with Huge shares. That is 6.5 is the market value. So this is how it is going to look like into 6.5. 1000 into 3 divided by 2 into 6.5. So this gives me 2,925,000 from this, and this gives me 300,000 into 3.45. All right. 5,000 plus 1,035,000. So my total consideration is going to be 3,960,000. All right. Which two of the following items should Tom include in the fair value of the identifiable net assets of Jericho when calculating goodwill in accordance with IFRS 3? Let's see. A contingent liability resulting from a present obligation which may result in an outflow of economic benefit. This has not been provided in Cherry's financial statement. But listen to me very carefully. At acquisition, we do record that and we do keep in mind, looking at all the probabilities. So we have to recognize this. So, okay, let's look at the other option. A provision required to cover the cost of reorganizing Jerry's department to fit in with Tom's structure. Okay, so that's post acquisition. A warranty provision in Jerry's financial statement to cover potential repair costs relating to goods. So yeah, that would be included at the time of acquisition, right? In the net cover. Goodwill included in Jerry's financial position relating to an unincorporated. So that is basically ignored any goodwill in the subsidiary's financial statement. So A and C are correct. Now, eighth, Mungo acquired 80% of the equity shares of share capital of Jerry on 1st January 20x2, paying cash of 1.2 million. Mungo has agreed to make a further cash payment of 600,000 if Jerry's share price increases by at least 10% each year for the next 3 years. The fair value of this contingent consideration 1st January is going to be 320,000.
Okay, so this is the fair value. So how do we calculate? There are different types of consideration. One is deferred consideration and one is contingent consideration. Okay. So what's going to happen? Deferred is basically after a certain period. Let's say after 2 years, I'm going to pay the subsidiary shareholder $2 million. Okay, so after 2 years. So I am going to be considering purchase consideration as the present value. Let's say at 10%, whatever is going to be the present value right now. And unwinding discount as finance cost. Now, what is contingent consideration? That is basically depending on a situation. Let's say we say the subsidiary that if the sale goes to 60% and above, we'll pay you this money. Okay, so based on that probability also, we are having a fair value. So reporting date to reporting date, let's say at the reporting date, when acquisition happened, the fair value of contingent consideration was $320,000. Now it has moved up to 400,000. So I am going to route it through profit and loss. Okay, the subsequent measurement. At 31st December 20x2, the fair value of contingent consideration was remeasured to 345,000. Okay, but the market expectation for the next 12 months are very poor and the market as a whole is expected to fall by 15%. If the market reacts as expected, the estimated fair value of the contingent consideration on 31st December would be 180,000. What amount will Mungo include the contingent consideration in its statement of financial position? They are asking about statement of financial position at 35. Now, whatever market condition would be, it would be recorded at that reporting period. We have been asked about 31st December 20x2 and at that time the fair value was 345. So I'll be recording at 345. Got it? Now comes, and Brim has owned 100% of the issued share capital of Stone for many years. Brim sells goods to Stone at cost plus 20%. The company's revenue for the year were Brim 460,000 and Stone 120,000. During the years, Brim, the parent, sold goods to Stone for 60,000, of which 18,000 were still held in inventory by Stone at the year end. What is the amount of revenue to appear in the consolidated statement of financial statement of profit and loss? If you look at this carefully, Brim sold to Brim sold goods to Stone for 60,000, of which 18,000 were still held in inventory. Okay, so if you look at it carefully, 60,000 was the good and 18,000 were still held in inventory. And what is the cost that they sold? Cost plus 20%. So if the goods were of 60,000, this is going to be the selling price. So my base of cost, simply my base of cost would be 60,000 into cost plus 20, so 120 and 20. Okay. And 18,000 of these goods were there. So I'll be considering 18,000. So out in this, what is going to be my profit element? 3,000. Okay. So what is the amount of revenue to appear in the consolidated statement of profit and loss? 460 plus 120 minus 3. Now this 3000, how is this going to be dealt to debit cost of goods sold? Right? And credit inventory. And we have been asked about revenue. What's the consolidated statement of profit and loss? So if I'm debiting cost of goods sold, that's a debit cost of goods sold part. So if I look this 60,000, it is intra-group transaction. Right? So if it's intra-group transaction, so 460 plus 120 minus 60. That is 520,000. Okay, so this was given for confusion. Got it? Cherry owned 75% of Plum for the year ended 31st December. 31st December 20x1. Plum reported a net profit of 118,000. During 20x1, Plum sold goods to Cherry for $36,000 at cost plus 50%. At the year end, these goods were still held by Cherry. What is the profit attributable to the non-controlling interest in the consolidated statement of profit and loss for the year ended 31st December 20x1? Now, we'll just look at how. Plum sold goods to Cherry for 36,000. Okay, so profit sits with Cherry at cost plus 50%. So basically, debit cost of goods sold and credit inventory. But this time, it will impact the NCI's share. So let's just calculate profit attributable to non-controlling interest. The net profit is 118,000, right? And goods to Cherry was 36,000 at cost plus 50%. So 50 by 150. So 12,000. This is profit on it because all the inventory sits with that. All the inventory is still there. So 118 minus 12 gives me 106. And if I calculate 25% of 106,000, it's going to get me 26,500. So this is the profit attributable to NCI. Got it?
हेलो सर,
Yes.
पिछले प्रॉब्लम में अपन सेल्स भी एलिमिनेट करे थे ना, इंट्रा ग्रुप है बोल के।
हाँ
तो
किए थे ना
36
60,000.
तो 36,000 भी एलिमिनेट होना चाहिए इस हिसाब से।
Which 36?
ये सेल्स नीचे का 36।
Which 36? Can you tell me? This, अरे दोनों अलग क्वेश्चन है. अच्छा, you are talking, but what have we been asked about group NCI को profit कितना जाएगा? I mean, how much are we gonna get to NCI? If you look at it carefully, देखो, 100,000 was the net profit of NCI. NCI, I mean the subsidiary. 100,000 was the reported profit. So I'm gonna first deduct the profit, unrealized profit. That is 36,000. That I deducted. 36,000 ka 50 into 150. Unrealized profit is 12,000. That I deducted. And I got 106,000 adjusted profit. All right. Now I'm gonna just simply multiply that by 25%. That is basically my NCI shares. So profit attributable to NCI would come to be 26,500. Got it? Look at the question.
मतलब सिर्फ एक ही डाउट था कि 36,000 क्यों नहीं लिए बस।
It would be eliminated from the revenue and cost of goods sold in statement of profit and loss. Look at the question what has been asked. We have been asked keep profit attributable to NCI. So this is how we calculate it. Okay. It is going to be eliminated from revenue and cost of goods sold. Got it?
ओके सर।
Now, which three of the following could provide evidence of significant influence? 51% voting power of the investee. Controlled. Asked about significant influence. Interchange of management person. Yes, this is significant. Ownership of 100% of preference shares issue. No, not significant. Participation in decisions about dividend. Yes, significant influence. Provision of essential technical information. Okay. Yes, because which means I have a say in the board. So PDN, owning 40% of the equity shares and having an agreement with another 20% of the equity shareholders that they will cast the vote as directed by you. So, but that basically means you have control because other 20% are at your discretion. Got it? So we're done with